To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
So for a summary to understand, in this standard we talk about the overall objectives of the independent auditor, and we tell that the auditor has to conduct the audit as per the standards on auditing. The entire standards on auditing are applicable only to statutory auditor, that is the auditor who will do the audit on the financial statements. So the auditor's primary objective is to examine the financial statements and to give an opinion on the financial statements. For the purpose of performing his primary objective, he will detect the misstatements and try to understand if there is an indication of fraud, because this will enable him to give an opinion on the financial statements. The second part of this standard talks about the requirements which the auditor should have. First one, they talk about the ethical requirements, that is the code of ethics issued by ICAI, which talks about integrity, objectivity, independence, professional competence, due care, confidentiality, professional behavior. Then we talk about professional skepticism, which is the attitude of the auditor to have a questioning mind, when he has to be alert for every assessment that he does, that is in short a critical assessment that he will take. Then you talk about professional judgment, because entire process of audit is purely judgmental from beginning to the end. Then we talk about sufficient appropriate evidences and the audit risk. When you give a reasonable assurance, the assurance should be based on the evidences that you have obtained, and your opinion should be based on the supporting evidences that you have. Audit risk is a concept where the risk says that you are going to end up giving an inappropriate opinion, or there is a possibility that you will end up giving an inappropriate opinion. Audit risk can never be zero because of the inherent limitations that are present in audit. These inherent limitations we talk about is balance between time and cost. We talk about audit procedure, the nature of audit procedure, the nature of financial reporting, and there are other matters which will make the inherent limitations to be present. And because of these, you can never have the audit risk to be eliminated to zero. Last point we talk about is the auditor is required to do the audit as per the standards on auditing. That means he should understand the text of every standard. He should understand the responsibility given by every standard. Every individual standard has to be taken into consideration by him. If he is departing from any standard, he should write about what alternative procedure he has followed in order to do the compliance. Most importantly, only relevant standards he has to take care of. Relevant standards are those which are not conditional. Like for example, if there are conditional standards like I gave you the example of 299 and 560, where only if those events happen, you will be responsible for it. Those cases you don't have to comply with them if the client does not have those kind of circumstances. At the end, if suppose the auditor is unable to obtain his overall objective, then you have to see whether this situation is making him give a modified opinion. If not, you have to check whether he has to withdraw from the audit engagement. Whatever the auditor does, he has to properly document about it. So this is all about SA 200, overall objectives of the independent auditor and conduct of audit in accordance with standards on auditing. Now, one piece of advice to all of you. SA 200 is a standard which usually students have a mindset that it's very simple or not required, it has so many things in it. No. What I would recommend is study SA 200 for two things. One is you will get introduced to all the terms that we will be having throughout the audit syllabus. So when you read it in the next standards or in the theoretical part of the subject, you will have an understanding of what this word is meaning. Second, very important is you will able to build up the language. The language used in the standard is the language that you require for the auditing paper. So all the other answers when you write, respective standards, respective theory topics, whichever answers you write, all these words you will come across, like professional judgment, skepticism, audit evidence, all of these when you are introduced, you will be able to write it effectively in the right places. So this standard basically will help you to develop your auditing language, and that is the reason I always call it to be a summary. so that you will understand everything about audit, and most importantly, it will help you to develop your writing skill, because writing is a challenge, we all know, okay, and language a bigger challenge. And in audit, we have a lot of terms which are required to be used as they are. So this standard will help you to improvise your language when you write the paper. So every word used in this standard is very, very impactful in your entire syllabus. So that is the reason, please study this standard effectively, properly, to gain utmost understanding of the words, of the language, and of the concept in the totality. So that is it with Essay 200. When we talk about overall objective, we always focused on to obtain reasonable assurance, right? But after forming an opinion, it is very important to report as well, right? So the objective is not only to obtain evidence and to give opinion on the financial statements. Objective is also to report on the financial statements. That means the auditor has to give a written report about the opinion that he has formed. And this reporting will also be done as per the standards on auditing. Now, in a summarized manner, let us understand in a very simplified language and in a nutshell everything about Essay 220. So Essay 220 talks about what? Quality control for the audit of financial statement. When we talk about quality control, we simply mean that the audit should be conducted as per the appropriate standards on auditing and the legal requirement. And you have to come up with the appropriate audit report in the given circumstances. If these three things are done, that means your audit is of a quality. Now, to ensure quality, this standard is giving you two set of procedures. One set of procedure is given for the engagement partner to perform it. Other set is given with respect to a quality control reviewer being appointed for the purpose of checking or reviewing the work of the engagement partner. So the engagement partner is given responsibility by the standard that he has to ensure quality at planning, performance, and reporting, all the three levels. For that sake, for that purpose, he has to ensure that he has been a proper leader to check that the engagement team is working as per the professional standards, is working or adhering as per the quality control policies, whether they have the ability to raise concerns without fear, and they are conducting the audit and coming to a conclusion which is appropriate in the given circumstances. Second, you talk about whether all the ethical requirements have been adhered to. That means the entire engagement team who is going to perform the audit together have everybody done the observation of the ethical requirement which is required by the firm. Then you talk about independence. Not only the engagement partner, but the entire team is also required to be independent while they are performing the audit. This duty is of the engagement partner to ensure that his team is performing with utmost independence. If there is a threat to independence, this threat has to be resolved, and if that resolution is not happening or the resolving is not happening, then they will take appropriate consultation from the firm and then decide whether to continue the engagement or to withdraw the engagement. Then you talk about what is the engagement partner's responsibility with respect to acceptance or continuation of the audit. In both the cases, you are going to study certain matters, come to a conclusion, and this conclusion should be such that you are sure that it will be right for the firm or to ensure quality, that if we take the engagement, it will be good for us or appropriate for us. And if we continue the engagement in case of recurring audit, that would be appropriate decision. With that, you take many other decisions, like you will study the background, you will understand the integrity of the owners, you will check your own capabilities, whether you have the resources, etc. Then the engagement partner has to ensure that he has properly directed a proper engagement team for the purpose of conducting this audit. Engagement team plays a crucial role in performing the audit. So directing, assigning proper people with proper capability is very, very important for the effective performance of the audit. Then you talk about on the field. That means when the entire engagement team goes on the field, that is the client place to do the audit. That time also, this standard is giving responsibility on the engagement partner. This standard says the engagement partner has to direct, not only direct, supervise also the work of every engagement team member. Along with that, he has to review, recheck, reperform, redo everything what the engagement team members are doing. You simply cannot rely on everything what the team members are doing. So even if you don't redo, you have to go through the documentation to ensure that the work performed and the conclusion drawn are appropriate or not. Whether the team is obtaining sufficient appropriate audit evidences to support their documentation or not, or to support their conclusion or not. Apart from that, the engagement team should also check that on the field, when the engagement team is performing, if they come across difficult matters, some significant transactions which they are not able to handle, which are you giving them proper consultation? Whether consultation has been understood by them and whether the matter is actually getting resolved amicably or not. This is the duty given to whom? The engagement partner, that is the leader of the entire team for a particular engagement. Then the standard talks about quality control review, which is conducted by the firm in order to ensure the quality of the audit conducted by them. So when a particular partner is assigned a particular engagement, the work performed by this partner along with his team is being rechecked or reviewed by the firm, another team, or maybe they have set off another individuals or a team together who will come and check the work performed by this engagement partner in order to ensure the quality of the work performed by him. This entire process where other team members or other firm members or the senior members or the partners of the firm review the work of this engagement partner, we call it to be engagement quality control review, where they are going to have the communication with the engagement partner about how the work was conducted, how the matters were resolved. They will review the financial statements, they will check into few documentations, see the conclusions arrived, whether all of these are appropriate. They will also check the proposed audit report, whether it is correct in the given circumstances or not. Apart from this, you also understand in the standard that a listed company compulsorily has to get the quality control review done. That means not the listed company. When the audit is of the listed company, this audit firm has to compulsorily conduct a quality control review for this listed entity. For this, obviously, you have to appoint the quality control reviewer. You will never sign the audit report before the review is completed, and the review has to be done with the evaluation of all the things which are given in this standard. After this, we do the monitoring process which is carried on by the firm in order to ensure that whatever policies they have set up, whether they are relevant, they are operating, and whether they are effectively be in process or not. And the engagement partner has to ensure that in the monitoring process, if there has been some deficiency, is that deficiency going to affect his engagement or not? And last, we talk about the documentation that you require. Unlike the other standards where you require only one set of documentation, here you have two sets of documentations to be maintained. One set talks about documentation to be maintained by the auditor, that is the engagement partner. Other talks about the quality control reviewer. The engagement partner is going to talk about all the reviews, all the documentation that is done with the course of the audit, that is ethical requirement, independence, all the other requirements for the conclusions drawn for acceptance and continuation of the client relationship, and also ultimately all the conclusions that he has drawn. On the other side, the quality control reviewer is going to document about the procedures that they have followed for the purpose of conducting the quality control review. Second, that they have done the review and started and completed the review before the date of auditor's report, and there is no unresolved matter which if they would have come across, they would say that it is inappropriate in the given circumstances. So this is all about SA'220 in a nutshell. So this standard extremely important at both the intermediate and the final level. At both the levels, this standard takes a lot of emphasis for the examination point of view. You will have a straight question or a case study kind of question at both the levels. So this holds a lot of weightage at inter as well as final. As I started the standard and I told you, one of the simple standards that we are going to talk about. Lengthwise, very small. Understandability wise, quite simple. And more of concept? No. More of procedure? Yes. So this standard for examination important. Learning wise also very easy. So I'll just help you with a quick recap of everything that we studied. Audit documentation simply refers to the working paper. This standard is telling you that the auditor has to prepare and maintain the working papers. What are working papers? A record of what? Procedures, evidences obtained, conclusions drawn. Okay? All of this you have to keep it in the papers. These audit working papers are very important because they will serve a basis for the opinion that you are giving, and it is a proof that you have planned and performed the audit properly. Then, because of these working papers appropriately maintained, you will be able to plan and perform the audit. You will be able to direct every member properly. You will be able to keep people accountable for their work. This will be a guidance for your future audits. All the reviews could be properly conducted. Be quality review, be external inspections by law or regulation. All of this documentation will provide them a basis to do their evaluation. After that, we understood the form, content and extent. So here we understood that the documentation that you maintain should be such that any experienced person, that is a chartered accountant who has a knowledge of how the audit is conducted and is not aware of the audit that I have done, just by looking at the working papers, he should understand what I have done, how I have done, what information I obtained, what conclusions I drew, what significant matters I came across, how did I solve it. All of this, just by looking at the working papers, he should understand. Along with that, when you talk about nature, timing and extent, you will always give about the specific characteristic. You will talk about who performed, when did he perform and when did he complete, who reviewed, when and when did he complete. Along with that, extra reporting, extra documenting that you have is with respect to discussions with the management, any inconsistency that you have addressed, any departure from the standard that you do, and if you come across SA 560 subsequent events, what about the events that you have encountered? Everything has to be documented. This entire documentation that you have charted along with entire engagement team members, you have to collect it and you need to assemble this into an audit file. This audit file will be separate for every individual client. This audit file will have to be compiled within 60 days from the date of your audit report. Once you compile, once you finalize the audit file, no addition, no deletion except for administrative purpose. You will be maintaining it for a minimum period of 7 years. The custody and the ownership of the working papers is solely with the auditor. He is not under the legal obligation to give these working papers to anybody. Even if the client is questioning him to show the working papers or any calculation if the client wants to cross-check, auditor is under no legal obligation to make it available to him unless it is required by law and regulation. Because we have some legal responsibilities, some regulatory responsibilities over us where we have to make them available to the regulatory bodies like the central government. Those situations only we are required to give our working papers. So that is all about this simple standard SA 230 audit documentation. Having understood the entire SA 240, it is now time for us to quickly go through everything that we have studied as a part of SA 240, because part by part when you study, when you collaborate everything together, you get a proper framework of what the standard is all about. So let us understand once again in a very quick manner, but in a very summarized and understandable way. Okay? Now, we talk about here is about the auditor's responsibility with respect to fraud in the audit of financial statements. Okay? So we are concerned about the element called as fraud while doing our audit of financial statements. First thing we understood what is fraud. It is a misstatement which is caused intentionally with a view to deceiving somebody. Then we spoke about who commits the fraud. It is management, TCWG, employees or third parties with an intention to deceive. Anybody could commit the fraud. Third, what are the types of fraud which concern the auditor? Obviously those frauds which are having direct or indirect impact on the financial statements. So we have fraudulent financial reporting and we have misappropriation of asset, which becomes a very important discussion for us as a part of this standard. Fraudulent financial reporting is basically when you alter, manipulate, falsify, intentionally omit some important information or the important accounting records. You misapply the accounting policies, all of which just to bring a misleading statement or just to make your financial statements look misleading or they are wrong in which they were presented. Here we see that the employees or the management is involved in manipulating the accounts by increasing or decreasing the profits based on their requirement. So here the intention is very clear of why are they moving the figures which are absolutely wrong. This is with an intention of some or the other kind of deception which is there. It could be deception to the banker, deception to the stakeholder, anybody. So this is fraudulent financial reporting where the accounts, financial statements are misleading by the very nature. Then you talk about misappropriation of asset, where you talk basically only about two assets, that is stock and the cash. Here there is a possibility of embezzlement, defalcation. There could be a possibility of using personally all the assets of the organization, that is the organization's assets are used for personal purpose. There could be mismanagement of the inventory. All of this is misappropriation of asset. For fraudulent reporting, you could also have an example of revenue being classified as capital, capital being classified as revenue. Ultimately, the reporting is going wrong. So these are the two set of misstatements or the indicators of fraud which are very, very important for the auditor. One is financial reporting fraudulently. Second is misappropriation of assets. Now, after understanding this, we got to know about why do people commit fraud. The reason that we are talking about are called as fraud risk factors. Fraud risk factors are those motivating factors which are going to make a person commit the fraud. Now, motivation looks very positive attitude here, but this motivation is for a negative angle, that is to commit a fraud, right? So we have three fraud risk factors identified by the standard. First one is the incentive or the pressure. Incentive is the greed that you have to earn more. Pressure is where unusual pressure is created on you, where you have to reach the target. So because of that, you commit fraud. Sometimes because you're aware of the loopholes in the organization, you take advantage of the situation and you commit the fraud, which we call it to be a perceived opportunity. Third, the very character of the person, the ethical conduct of the person, the way the person is brought up, the atmosphere in which he has lived in. So the very character or the nature of the person is that however good the atmosphere is, does not matter to him. His very attitude is to commit the fraud. So that is rationalization, that is his thinking capacity or his attitude towards everything. So these are the three things that will make a person commit fraud. Now, we know very well that the primary responsibility of identifying, that is preventing, detecting and correcting material misstatements due to fraud is with respect to that of the management. That is, it is the duty of the management. Because management will be designing the internal control, management is responsible for the preparation of financial statements, and therefore the prima facie requirement of identifying the misstatements connected to fraud or error rests with the management. So it is the management having the primary responsibility. The auditor is responsible to give reasonable assurance on the financial statements, and this reasonable assurance we require him to give higher level of assurance. Reasonable assurance we know because of the inherent limitations present in the audit. But because of the inherent limitation, we cannot just compromise with the work. We have to always, during the course of our audit, maintain the attitude of professional skepticism. That means we have to maintain the attitude of questioning, doing critical assessment every time we come across something which is suspicious, somewhere where the auditor feels a doubtful thing is going on, or the auditor's behavior or the attitude looks like there is some doubt happening in this particular area. So when something looks doubtful, the auditor cannot silently leave the matter. He has to apply professional skepticism, that is questioning mind, for him to come out and understand what exactly is the situation. So he will do investigation in the matters where he has some kind of concern or a doubt with respect to material misstatements being present. Then we talk about what are the three broad categories discussed by this standard. So this standard talks about three broad categories. One is the risk assessment procedure. Second talks about responses to the assessed risk. And third will talk about what if the auditor decides to discontinue with the engagement. In risk assessment procedure, we talk about those procedures where we are going to decide whether there is a risk present which is an indicator of fraud or not. Here we do inquiry with the management about their process of identifying the risk. Then we try to understand what is their method to decide about or responding on how did they respond to the assessed risk, or did they find out actually any frauds. Did the management communicate about these matters to TCWG? Did they inform the employees about the requirement of the ethical behavior in the organization? You also inquire with the part of management, that is the internal audit team, and ask them about any possibility of their understanding, or is there an understanding of a possibility that there is a material misstatement present due to fraud. So these are the methods which the auditor will apply in order to understand whether there is a possibility of error. Second you talk about is about inquiring with TCWG. TCWG form the upmost or the topmost position in the organization. So we are going to analyze whether they have supervised properly the management process and also directly communicate with the TCWG of understanding whether they came across any fraud, or in their knowledge did they come across any fraud which is an indicator or which is going to affect the entity as a whole. Then we perform the analytical procedures to find out if there are any unusual fluctuation which are going to affect the entity as a whole. So we could perform trend analysis, we could do the reasonableness checking by performing the analytical procedure. Then we could check if there are any other information which will be an indicator of the presence of fraud. Finally, we will see if there is a presence of the fraud risk factors. Is there incentive or pressure? Is there a perceived opportunity? Or is there the rationalization of the act of the employees for them to commit the fraud? With all of this, we'll be able to understand, are there areas which are attracting the risk of a material misstatement due to fraud or error? After we do the risk assessment, we move on to the next step, that is how are we going to respond to the assessed risk. Once we identify the risk, we are then going to employ people with their capabilities to go and check the matter. We will check if there is going to be any kind of misapplication of accounting policies done by the management. Here we will put an element of surprise check by increasing the nature, timing and extent. Behaving unpredictably, the management should not be aware of the next procedure that you adopt. In this way, we will be able to identify in that respective area whether really fraud has been committed or not. Very importantly, where we come across an area or an understanding that management is involved by overriding the control, we are going to consider it to be a significant risk, and based on that, we are going to increase the nature, timing and extent of our further audit procedures. Understand, risk assessment procedures, that is identifying and assessing of the risk, should happen at both financial statement level and the assertion level. That is, the transaction, account balances and disclosures should all be checked thoroughly to identify if there is a risk of material misstatement. There should always be a presumption by the auditor that there is going to be a fraud with respect to revenue recognition, because of which we will study the nature of the revenue, type of the revenue and also do the assertion valuation or the assertion validation. You also have to check the internal control system and also the internal controls, especially on the risky areas, to understand if there is a possibility of real fraud being present there in those areas which are identified by the auditor. And the last part of the standard talks about what if the auditor comes across a fraud or a suspicion with respect to fraud. So he will communicate this matter to the management, TCWG, and also check if he has some legal responsibilities. Like you also have to report based on section 143 subsection 12 of the Companies Act. You also have to report based on the CARO reporting requirements. Then you will also look into the consideration of withdrawing from the engagement. But when you withdraw from the engagement, you have to inform the management, TCWG, along with giving them the reasons of why you are withdrawing. Along with that, you have some legal requirements over you where you have to communicate with whom? The regulatory bodies. Regulatory bodies, I gave you the example of SEBI and ROC. When it comes to companies, when you resign, you have to inform them. And then the last part of the standard talks about the management representation letter and that of the documentation requirement. MRL is required with 4 categories. First, about designing, implementing and maintaining. The internal control should be the responsibility of the management. Second, whatever the management has come across during its management's process of assessing the risk and whatever results they came across, they have disclosed appropriately to the auditor. Third, if they know about any fraud which has happened during the year where the management is involved, employees are involved, they have to be appropriately communicated to the auditor. And last is that, is there any allegation going on against the client, or is there any suspicion of some kind of allegation regarding suspicion of the fraud? that also has to be informed to the auditor, that is disclosed to the auditor appropriately. By getting this representation letter, the management is telling auditor indirectly that, look auditor, about fraud and about assessment of fraud, there is nothing that we are hiding from you. All that we know about fraud, we have intimated you perfectly. And last talks about the documentation, where you talk about what are your risk assessment procedures, how did you respond to the assessed risk, what was your communication done with the management and the TCWG, and finally, why is there a non-applicability of the presumption as to the presence of risk with respect to revenue recognition. This is all that we study as a part of Essay 240, Auditor's Responsibility Relating to Fraud in an Audit of Financial Statements. Having understood the entire Essay 250 in detail, it is now time for us to understand a summary of the standard. In a summarized manner, we get a glimpse of the entire standard so that the process or the flow of the standard is properly understood. This standard is more of procedural aspect to be followed by the auditor, and here the concept is quite simple. It is only regarding the compliance of laws and regulation which the auditor has to check. So it is more concentrating on the procedural part while performing the audit, what the auditor is supposed to do. Alright, so now let us get on a quick understanding of the standard once again. First thing, compliance of laws and regulation simply means about the laws and regulations which are having an impact on the client that we are going to audit. Every client that we go to audit is subject to many laws and regulations. So it is a very important point for us to understand that they have to comply with all the laws and regulations which are affecting them as an entity. It is the primary responsibility of the management to check the prevention of non-compliance of the laws and regulations. In simple language, it is the management who is responsible to comply with the laws and regulations, put proper controls in place to ensure the laws and regulations have been complied with, to have proper legal counsel, proper monitoring facilities just to ensure that there has been a proper compliance with the laws and regulations. So that is the responsibility of the management, the primary responsibility of the management. But then what is the responsibility of the auditor? As per this standard gives responsibility to the auditor that, look auditor, when you perform the audit, when you are performing the audit, we are giving you a responsibility that you have to ensure or you have to check that the management has complied with the laws and regulations which are applicable to them as an entity. So it is the responsibility of the auditor to take into consideration all the laws and regulations which are applicable to the client have been fulfilled or not. But then here you need to understand that when you talk about any business, there are multiple laws which are applicable. You have so many laws which are like the labor laws, you have tax laws, you have the Factory Act, you have maybe the other licensing act, like you have the FDA if it is the food sector, or you'd be having some other kind of telecommunication sectors where you require licenses, real estate where you require government clearance certificates. So there are so many laws which are applicable to a client. So tell me, you as an auditor, will you be aware of every law? Are you aware of all the laws applicable to a client? Will you have knowledge of all the laws? Absolutely not. Therefore, here we are telling the auditor that, look auditor, you have to check and obtain sufficient appropriate evidences of those laws which are having an impact on the financial statements. Alright? So in this standard, we are giving a responsibility to the auditor that while doing the audit, he has to ensure compliance with those laws and regulations which have a direct impact on the financial statement. And he also has to check the non-compliance effect. That means if there is any indicator of non-compliance of other laws which are there. Alright? Now how to understand this? Very simple. Every organization has multiple laws governing them. There are certain laws which will have a direct impact on the financial statement. The classic example would be the income tax laws or the labor laws, like you have the bonus, EPF, gratuity, all of these. They will have a direct impact on the financial statement. On the other side, you have those laws which do not have a direct impact on the financial statement, but they are very much fundamental, or their compliance is fundamental to the entity's operations. That means if you don't comply them, there is a possibility that your going concern also will cease, or you cannot continue, or your ability to continue also will come to a problem. So like there could be the laws, like for example, there are certain licenses that you require mandatory for the purpose of you continuing the business. Or there are some kind of, laws which are required for pollution control. So you have acts governing on those companies which are responsible for emission of hazardous gases. So there will be a limit on them. So if they cross that, then what happens? The government can give a stay order on the business. So what happens is, these kind of non-compliance become very important to be checked, because indirectly they will impact the financial statement. Because if there is a stay order on your business, if your business is stopped because of some kind of non-compliance with other laws, okay, then in that case, when your going concern is going to get affected, don't you think your financial statements will get affected? Yes. So directly they are not connected, but indirectly their compliance is connected to our financial statement. So what happens is, you will be bothering about two different set of laws. First one is about the compliance, about those laws which are having a direct impact on the financial statement. So you as the auditor has to obtain sufficient appropriate audit evidences with respect to the compliance of those laws which have a direct impact on the financial statement, maybe reported amounts or disclosures. On the other side, of the other laws which directly have no connection, but indirectly their element or their non-compliance is going to have a serious impact on the financial statement. Like you could take the labor law also. Child labor banned in our country. So if suppose this particular client is employing child labor, now this is a non-compliance with the law? Very much yes. This non-compliance could become so serious that tomorrow there could be a problem with continuation of business by the client. The court may pass an order that this business needs to be stopped, or they cannot continue. It will cease to be a going concern because of the non-compliance of employing a child labor, or major sector, or the major employment is child labor here. So this is no doubt not directly connected to the financial statement, but indirectly it has a huge impact on the financial statement if it is not complied. Got it? So these are the two things that we have to concentrate here. Now, moving on, what we have to do if there is a kind of non-compliance identified or suspected. But before that, we need to understand what is the risk assessment procedure which the auditor will adopt to understand which are the areas where there could be a non-compliance. So the risk assessment procedure will be where the auditor will have a discussion with the management, try to understand the entity, try to understand the environment, check which are the laws and regulations which are going to be applicable on the client, discuss and communicate with the management to understand what other laws which are going to be applicable to the client. Having understood about all the laws which are applicable on the client, you need to also question to the management, how are they complying? What are the procedures? What are the controls that they have set? What is the framework that they have designed in order to comply with the laws and regulations? Once you understand this, then you will check into obtaining of sufficient appropriate evidences for those laws which are to be complied, which have direct impact on the financial statement. And you will also check for the possible indicators of non-compliance with the other laws which do not have a direct impact on the financial statement. Moreover, the auditor needs to be alert throughout the conducting of the audit. He has to be maintaining professional skepticism. He has to be alert, a questioning mind, always when there is a doubt with regard to non-compliance. And because prevention of non-compliance is the responsibility of the management, it is very important for the auditor to obtain management representation letter. That is, a written representation has to be obtained by the auditor. What representation? That they have complied with all the laws and regulations that have been applicable on the client. There has not been any non-compliance, and if there has been any non-compliance, they have properly disclosed it to the auditor. That means, according to this representation which you have obtained, there is no non-compliance which the auditor is not aware of. That means the management is not hiding any kind of non-compliance that they came across. Alright? So this is the risk assessment procedure that the auditor will adopt in order to understand or to identify the risk that is present. Second, after this we look into the matter. After you do the risk assessment, it is time for you to apply the audit procedure to identify the non-compliances. So there is a possibility that after applying your audit procedures, you come across identified non-compliance, or there could be suspicion of non-compliance. If you identify a non-compliance, like you could realize that yes, there is a clear indication, or clearly you understood that there is a non-compliance. That means there has been a kind of law which has not been followed. For example, bonus act not properly followed, gratuity not properly paid, okay, some other tax calculations not properly done, depreciation calculation not as per the law. So all of this, you came across a situation where you understood there is a non-compliance. In that case, you as the auditor will first understand what is the kind of non-compliance, what is the nature, why did they do this, in what circumstances did they do this, and most important, how is this non-compliance going to affect my financial statement or the financial statement of the client, which is my responsibility. Got it? So you have to understand in what manner this non-compliance which you identified is going to have an effect on the financial statement. Now, there is a possibility also that there could be a suspicion regarding the non-compliance. When suspicion is there, that means you have not established a fact, you only have a doubt. So when there is a suspicion, then what will you do? You will discuss this matter with the management. If the management is not giving you a proper answer, or you feel the management is involved in this kind of non-compliance, you communicate the matter with the TCWG. If management, TCWG both do not cooperate with you and they do not provide you with the enough information that you require, in that case, you will decide to go and take an expert advice. That means you will go to a legal counsel, you will take a legal advice, which we call in a technical terms to be an expert. And this expert will help you understand how this non-compliance is going to have an impact on the financial statement. After this, you then talk about reporting responsibility of the auditor. You will report the matters of identified or suspected non-compliance to the TCWG unless the TCWG is involved. And if they are involved, you will talk to the senior most authorities like the audit committee or the supervisory board. And if they are also not there, then you will go and take the expert advices, that is, you will take a legal advice. Then when it comes to the reporting in your audit opinion, in that case, what will you do is, you will check what is the non-compliance. Is it material and pervasive? If you are able to obtain sufficient appropriate evidences about the non-compliance, you got proper evidences by inquiry, by observation, by some kind of inspections. If you are able to obtain sufficient appropriate evidence, you will evaluate the evidence and understand whether it is material and pervasive. If material and pervasive, you will give an adverse opinion. And if it is material and not pervasive, you will give a qualified opinion. On the similar lines, if suppose while discussing with the management or while obtaining information with regard to the suspected non-compliance, no information is obtained by you, or they are not cooperating with you, or the information that they are giving is not enough for you to come to a conclusion, then you will evaluate and check whether it is material and pervasive. If yes, you will give a disclaimer of opinion, or you will end up giving a qualified opinion. So this is the reporting that you will be doing with respect to your audit report. That is, the opinion will undergo a change if there is a non-compliance like this. Third, if this reporting, the third responsibility for reporting is with respect to reporting to the regulatory body or the enforcement authorities, where you have some kind of legal obligations on you that when you come across non-compliances, you have to inform to the regulatory bodies. Like you have the ROC, you have SEBI, or you would be having the other regulatory bodies like the Comptroller and Auditor General of India, banking regulators. All of these you have to inform for the suspected non-compliance or the identified non-compliances. So these are the reporting responsibilities given to the auditor. And finally, documentation is very simple. All the discussions, all the communication that we have with the management, TCWG, even the senior boards like the audit committee or the supervisory boards, all of these we have to properly document. That is what is given by SA 250. That is consideration of laws and regulation in the audit of financial statement, which is extremely important for us to understand. because this standard gives an additional responsibility on the auditor, and more so ever, it is more of procedural. Okay, so when we come across suspicion, when we come across identified non-compliances, we have to apply additional audit evidences. Based on the additional audit evidences, we will come to a conclusion that whether non-compliance is really there or not there. Based on that, our audit opinion also could change, and because of which this becomes a very important part for us before we give the conclusion that we have to take into consideration the laws and regulations which are applicable to the entity. And understand one thing very clearly, because of the inherent limitations that are there in audit, there is a possibility that we would sometime go without detection of the non-compliance, because as an auditor, we are not expected to have knowledge of every law, every kind of non-compliance. And because of the inherent limitation, there could be certain non-compliance which we could not come across. But understand, preventing non-compliance is not our responsibility. Only reporting about the identified non-compliance or suspected non-compliance is the responsibility of the auditor. So if tomorrow, after the audit report is given and the non-compliance has been observed, in that case, if we have done the audit as per the auditing standards appropriately, then we will not be responsible for the non-compliance done by the client. So this is all about the standard SA 250, consideration of laws and regulation in the audit of financial statement. Having understood the standard in detail, it is now time for us to get a summary of the standard. As I told you, a very simple and a very interesting standard. SA 300 is focusing on the planning of the audit. This standard is talking about the responsibility of the auditor, about planning the audit to complete the audit in an effective and an efficient manner. Because audit is a responsibility, it becomes very important for the auditor to plan the audit properly so that the end result or the opinion is valid and having a reasonable assurance on it. Alright, now, here we talk about involving the key engagement team members for the purpose of planning. This standard very clearly tells that the auditor alone should not do the planning. He should take into consideration all the key engagement team members and should take up the planning. That is, take their insights, take their experience, do some discussion with them. This would make your plan even more efficient and effective. This standard basically focuses only on recurring audit, because initial audit we'll be discussing later on, but this standard, the entire framework, is only with respect to the recurring audit. Now, planning, when we talk about, before beginning, we need to first consider about the preliminary engagement activities. Because it is recurring audit, it is very important for us to establish 3 important factors. If these are present, only then we'll decide to continue with the client. Otherwise, there is no question of planning absolutely. So the 3 preliminary engagement activities that we take up here is, first we'll see, did we perform those procedures which are required for us to decide our understanding or our capability to continue the client relationship, which is given as per SA 220. Second, are we complying with the ethical requirements as required by SA 220, again including very important independence. Third, is there a proper understanding of the engagement letter as per SA 210? If these 3 things are present, then we move on with accepting the client, and then we talk about the planning activities. In the planning activities, we talk about basically 2, audit strategy and audit planning. Audit strategy is like an outcome or an outline of the entire audit that we are going to conduct. So basically the entire scope of the audit is been given by the audit strategy. In audit strategy, we are going to create a broader framework of the entire thing that we are going to take up. So basic idea is we are going to understand the overall things about the client. What type of business he has, how many locations he has, what are the financial reporting frameworks that he is using, does he has the internal auditor, what is the characteristic of his business, okay. Then we are going to try to understand regarding everything which will be required for us to decide how much resource will be requiring, how much time we require, everything to decide, all of this to understand which are the risky areas, which would be the important areas, all of that we are going to do as a plan of audit strategy. So audit strategy basically has 5 things to be taken care of. First, properly understand. First, we are going to talk about identifying the characteristic of the engagement. What is characteristic? What is the client all about? That is the characteristic. So basically understanding the structure, understanding the business, understanding the nature, understanding the environment, okay, all the important areas, the quantum, the length, the complexities, okay, the number of units, the expansion of the business, all of that is what we do as part of first one, that is identifying the characteristic. Does it have any controlling authorities? Is there a related party transaction? Do they have subsidiaries? Are they held by somebody? All of this is what we study as a part of identifying the characteristics. After that, we talk about is regarding a reporting responsibility. So, reporting objective we need to analyze. Once we understand the reporting objectives, we will be able to decide the nature of the time and the nature of communication that we require. That means we know during the course of audit, if we understand that we have to report every interim, or maybe that is 6 months, or maybe we have to give the report only on the final stage, then we will be able to, based on this, decide how many meetings should we conduct with the engagement team members. When do we organize the meeting with the management and TCWG to decide the entity of the audit procedures which are planned. We also need to decide about when and how are we going to communicate with the components auditors. So all of this we need to decide the timeline and what kind of communication do we expect. So what type of reports we need, all of that we are going to decide here. Like for example, if suppose you have a subsidiary, then you would require the report of the subsidiary. So what kind of reporting do you require from them? What is the nature of communication you are expecting? Correct? That also will decide as a part of strategy. Then the third thing that we talk about is identifying the significant factors, okay, which we are going to enable the engagement team to direct its efforts there. That means we understood a risky area is this, risky area is that. So based on that, we are going to direct, or we are going to focus the concentration of the entire engagement team on a particular area. Not entire, but maybe we are going to give a concentration or maybe a focus on that particular areas. Correct? So significant factors we need to find like that. Then fourth we talk about is the result of the preliminary engagement activities. What is the result? We performed all the 3 activities. Based on that, what is the result we got? And because it is a recurring audit, you would have some kind of prior understanding of the client. So that also you will take into consideration for the purpose of defining the strategy. Correct? Finally, the last one we talk about is the most important one. We are going to decide the NTE of the resources to be used. So how much time do we require? How many people do we require? What is the expense that we are going to undertake? Everything is what we are going to decide as a part of nature, timing and extent of the resources to be applied here. Correct? So this is what the audit strategy. Once the audit strategy is decided, we are going to move on with the development of the overall audit plan. Very simple. What is overall audit strategy? It is going to give you the scope, the time and the direction of the overall audit, based on which the plan will be designed. Correct? So in simple language, if I want to tell you what is the strategy, it is the scope of the audit. We need to understand this is the audit, what we are supposed to do. So that is coming where? In the strategy. From the strategy designed, we are going to now develop a plan which is going to be even more detailed. Very elaborately, we are going to make up a plan. In this plan, we are going to give a proper description of the planned nature, timing and extent of the risk assessment procedures that we have planned as per SA 315. So when we do 315, you will understand, by understanding the entity, by understanding the internal controls, we are going to design the risk assessment procedures. So those NTE, we are going to bring it in planning. Second, we talk about, once you identify the risky areas, we are going to respond to the risk. Correct? So this we will be doing as per SA 330. That is, when the risk is identified, you need to respond to it. So that we do as per SA 330. So these are called as further audit procedures or additional audit procedures, or we can call FAP, which we do as per what? SA 330. And then the standard also tells there are other audit procedures which you have to perform, okay, which are required by the other standards. So you need to decide the nature, timing and extent of the other audit procedures. Very importantly here, other very clearly talks about the nature, timing and extent of the supervision and the review which the auditor is going to conduct on whom? The entire engagement team members. Correct? So this is about the audit plan. Now, audit strategy, audit plan are not interchangeable, but they are interconnected. They are interlinked. From the strategy comes the plan. Correct? So here we need to understand that a change in one will result in the sequential change in the other. Planning is not going to be rigid. Planning is not going to be discrete. Throughout the process of the audit, every now and then, as and when we encounter circumstances, we are going to have a modification done to our planning. And when one thing changes, the other thing will automatically change. So strategy changing, plan changes, strategy will also change. Moving forward, we have understood regarding the documentation. Here we require 3 important things to be documented: audit strategy, audit plan, and any significant changes that are there, that also you need to report about. Correct? Then, moving on to the next one is what we talk about regarding initial audit engagements. So as I told you, 300 is with respect to the recurring audits. This audit will be applicable to initial audit as well, along with certain additional considerations that you have to keep in mind. What are the additional considerations? First, they give due regard to SA'220, where you have to apply the procedures to ensure do you have those conditions which are needed by you for the acceptance of the client relationship. Do you have the resources? Do you have that kind of ethical requirement that is needed as per SA'220 for you to take up the audit? Second, as we have the code of ethics prevailing over us, we need to have a communication done with the predecessor auditor, if any, and only then take up the audit. Then, apart from these 2 important points, there are other things that we could do as a part of our audit procedures. We could try to make some arrangements with the previous auditor, try to get some information by having some kind of access to his working papers, but only if it is not prohibited by law. Then all the major issues which we have a doubt or which we believe we need to question, we could communicate with the management, TCWG, and see if it is impacting any kind of audit strategy. Then we have SA'510, which is basically talking only about the initial audit. So we will refer the standard and see what procedure is that standard telling us with respect to the opening balance, and we will perform those procedures. Also, initial audit, we will see from the firm where I come, do I have any policy which is only made for initial audits? Like if I, for example, I gave you that if the strategy is ready, you cannot move on with the procedures or you cannot apply the procedures without getting it reconfirmed from the other senior member of the firm. Or maybe you do the audit, we have no problem, but before you issue the report, you have to give it to the senior engagement member or maybe the firm member for his validation. Correct? So these could be some extra things which are there in your firm as a with respect to initial audit, just to ensure the quality of the work done by you. So if like that, if there are any policies in your firm, see that you give due regard to that also in case of an initial audit. So with this, we have understood the overall audit planning. Here the most important point is audit strategy and audit planning. Very, very important points for us to understand. So with this, we close SA'300, audit planning or planning and audit of financial statement, because without planning, nothing can be done. If you do an audit without a plan, it is actually an audit which is going to be in a very wrong direction, very ineffective, absolutely not going to be correct. So that is the reason planning is indispensable. Planning is a major part of the audit process. Having understood the standard in detail, it is now time for us to get a summarized approach so that the flow of the thoughts will fall in place correctly, or the flow of thoughts will be in the right direction. To begin with, again the name 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment. Risk of material misstatement as per the standard is to be identified and assessed only. After you identify and assess, looking into the materiality level of that, we will move on to SA'330, which is going to talk about how we are going to respond to the assessed risk. So as per this particular standard, we are not applying any procedure which is going to give us sufficient appropriate evidences. Rather, it is only going to give information to the auditor to plan the further audit procedures. So this information is called as the risk assessment process, which will enable the auditor to design his further audit procedures. Correct? Now, this process of risk identification, that is risk of material misstatement, is simply telling us to identify and assess the inherent risk and the control risk. The inherent risk and the control risk, the combination of that, we call it to be ROMM, that is risk of material misstatement. So this standard simply tells us to identify the inherent risk and the control risk. To understand the inherent risk, we need to understand the entity, its environment. And to understand the control risk, you need to understand the internal control. And that is the structure of the standard, the way it is divided. First, we understand what is RAP, risk assessment process. So it is the process designed by the auditor for the purpose of understanding the entity, its environment, and the related internal controls, for the purpose of identifying and assessing the risk of material misstatement at both financial statement level and the assertion level. For this purpose of assertion, of financial statement assertion, the financial statements would mean those misstatements which is going to have a pervasive effect on overall financial statements, which basically we incline or we are going to give a direct emphasis to also the internal controls. Because if the internal controls are not strong, if there is going to be a deficiency or a weakness in the internal controls, or if the integrity of the management itself is not there, then in that case we cannot rely on the entire financial statement. So the entire financial statement comes to a doubt. So this we call as a misstatement or the risk of material misstatement at the financial statement level. Whereas when we talk about assertion level, we talk about specific assertions. Assertions as in, we could have valuation, we could have measurement, we could have occurrence, we could have rights and obligations, which we will be discussing at later point in time. So there are multiple assertions which we have to validate. So if there is any risk which is concerned only with a particular assertion or which is going to impact one or two assertions, we consider it to be going to be at assertion level. So basically we talk about the transactions, account balances and the disclosures. So P&L account items, balance sheet items or the notes to accounts. Correct? Then, here to understand the inherent risk, we need to understand the entity and its environment. So to understand the entity and the environment, we need to acquire the business knowledge. So the business knowledge basically here we talk about is the relevant industry, the regulatory requirements, including the FRF. Then we are going to understand the nature of the business, the kind of investments they are making, okay, what is the structure of the organization, how are they financed, all of this or their operations that they have, all of this is what we are going to understand as a part of nature, including the ownership structure, correct? Then we are going to look in for the accounting policies, whether they are consistently applied, what is the disclosure if they have not applied. Then we talk about the objectives and the strategies on the wider scale that we are going to talk. And finally, the most important aspect for us, that is the review of the financial performance, that is the balance sheet position and the profit or the loss that have been achieved during the year. So this information is what we are going to take as a part of our understanding of the client. With this understanding, we will be able to evaluate and understand the inherent risk. Then, we need to also understand about the controls. And to understand the controls, we have to study the internal control system. And we basically understand, very interestingly, that every control relevant to the audit is connected to the financial reporting. But every control on the financial reporting, though it has a consideration towards the financial reporting, will not be relevant to the audit. Correct? For that, the example that I have given you is about training, where you understand training is very important for the people to apply the accounting standards or the new technologies or the new concepts correctly. But that training as a control, will that not be very much relevant for us as the auditors? So we will be concerned about those controls which are relevant to the audit, relevant to the financial reporting, whether they are designed, implemented and maintained properly. Now, how do we perform and understand the inherent and the control risk? What are the methods? So these methods are basically, we are going to inquire as in communicate with everybody and try to understand how is the structure, how is the organization, who are the owners, what business line they are, which laws are governing them and all of that. Then we could inspect the documents, we could do some observation. Basically controls are understood by observation. When we do a walk-in of an entire process, when we understand the entire line of activities together by observation, you will get acknowledged to the risk. And then you could also perform the analytical procedures. So the data that is available with us, we could perform some kind of analytical procedures, build up certain relationship and try to identify if there are going to be certain risk. So these are the methods through which we will do the risk assessment. So basically in the risk assessment process, what we will do is, we will try to understand the entity, its environment and identify the risk. Then we will see how this risk is going to pervasively affect the financial statements. Are there any assertions also which are going to be affected by these kind of risk? So this basically will enable us to perform the entire risk assessment process. After that, we will also consider certain complex transactions, certain places where we could come across significant risk as the auditors. So the standard itself has given you certain ideas which risk you could consider it to be significant risk. Example where there is a complexity of the transactions, where you could have like there could be some kind of subjectivity involved, like the accounting estimates, the organizational structure being complex. Like for example, you are having subsidiaries, you are having associates, you have joint ventures. So there are going to be some intercorporate loans, intercorporate transactions, or intercomponent relationships. The recording of the transactions and all are going to be complex. So area of risk, correct? There could be multiple areas where we could consider to be significant. Related parties, okay? So these are all the areas where we will consider it to be what? Something very complex, and because of which we are going to consider it to be significant areas for our assessment. Moving on further, because we are required to even analyze or evaluate the control risk, for us to understand the internal controls also become very important. After understanding the inherent risk, only then we can assess the control risk. Because after assessing the risk, you should see whether controls are there in place. And if controls are not in place, that means there is the control risk. And together, we will be able to identify the risk of material misstatement, assess the risk of material misstatement. So to understand the control risk, we need to understand the internal controls. So for that, we need to first understand what is the control. It is a process which is designed, implemented and maintained by the management, TCWG and the other people in the organization. Why? To obtain a reasonable assurance that the entity achieves the objectives. What objectives we are talking about are the mnemonic CARE, C-A-R-E. C talks about compliance of laws and regulation, A, safeguarding of the assets, R, reliability of the financial reporting, and E will talk about effectiveness and the efficiency of the operations of the organization. Having understood, we need to know why controls have to be there. Because there has to be proper reliability of data, because there is a need that proper accounts, proper records, proper time, proper amounts, everything is recorded correctly. People who have been given the authority, they only enter the data. Special authorities, general authorities, see that only those people who are authorized can do the entries. There has to be safeguarding of the assets. Unauthorized access to any of the asset should be eliminated. And finally, what is recorded and what is actual should be matching, for which we have a control called as reconciliation. So all of these reasons is because we require proper prevention, detection and correction of the misstatements. Entity should be able to prevent all the possible errors. If they are not able to prevent, at least the control should be able to detect and prevent those things. That means they should be able to detect and correct the misstatements on timely basis. Then, what makes up the control? Controls are made up of 5 components. First, control environment, all the ethical culture, the governance, the integrity, all of this we call it to be what? The control environment. If that is not there, how is there going to be a control as such? Because ultimately people in the organization are going to put in the control, use the controls. If they are not there, there is not going to be a control absolutely. Then the entity's risk assessment process. If the entity cannot assess the risk, there will be no way in which controls can be addressed. Third, information system. Basically, our keen or our focus as auditors is about the information system. Whether data is being processed correctly, accurately, inaccurate data have been automatically understood, or maybe they are detected, or is there a possibility that unauthorized access is clearly denied. Okay, all of these things will be in your system. Whether proper recording is happening, proper outcomes are generated, whether process is correct, etc., etc. Then we talk about the control activities. Basically, what controls can you put in place? So there are performance reviews, there are physical safeguarding of the assets, segregation of duty. What is performance review? Basically the internal check. When a person is not having the entire control by himself, for example, purchase. So there would be one person who is going to make the purchase order, other person who is going to sanction or give the approval, some other person is going to actually make the placing of order to the vendor, and finally one person will be making the payment. So when you segregate the duty, there is going to be a proper review also and proper control so that mistakes do not happen. Correct? And last, only designing the controls will not be enough. You need to monitor the control. Monitor as in supervise the control, because maintenance of control is also important. If any of the components are missing or there is a deficiency, we call it to be weakness in the internal control. This standard only tells you to identify and evaluate the controls. But then we have another standards, 265 and 260, which are talking about your responsibility with regard to you communicating these matters to TCWG and the management. So when the auditor comes across any deficiency, which is material, which is significant, then he has responsibility to communicate to the management and TCWG as per SA 260 and 265. This standard has also introduced you to some of the risk to a CIS environment. So there is a possibility that you have put in controls. Even then, the controls can be overridden in the CIS environment. There could be unauthorized access, there could be unauthorized access to the master files, tampering of the data, data getting lost, people getting unauthorized access to more than that what is required. They could delete the data, edit the data without any authority. And finally, in the standard to end with, we talk about the documentation. And documentation very simple. We talk about what discussions we have, all the risks that we have assessed, then what are the levels, that is financial statement level or the assertion level. Then we are also going to check about the internal controls. Any risk if we have identified, what are the related controls along with it. So with this, we have actually understood the entire concept of SA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment. Understand, both at inter and final, this standard is considered to be extremely important. And as I told you, you will be getting introduced to many of the audit terminology, and because of this standard, your language will be improved with respect to auditing. I have purposely focused upon the auditing language, and I've tried using very minimal simplified language. Reason being, this language is the basic requirement in your audit paper, and because of this, I would recommend when you study this standard, you study the auditing language. This will help you throughout the syllabus of audit and for you to understand all the concepts in detail. Having understood the SA 320 in detail, it is now time for us to move on with the summary so that the flow of the entire concept is again right in place. So materiality as a part of the concept which I was explaining, I told you that because we have a limitation on our time and because genuinely every item in the financial statement will not be that impactful, we as the auditors will be concentrating only on those matters which are going to be material. Material as in something which is going to have an impact on the decision making of the users. This concept of materiality as per this standard is used at all the places, that is planning and the performing. So the name comes as planning and performing because materiality is a concept where you apply at both these levels of the audit. Alright, now first we need to understand how the auditor will decide the materiality level. Two ways of understanding. One, where the FRF, which is applied by the management, that itself gives an understanding of what should be material. If that particular FRF is silent, then auditor is going to use his professional judgment, and based on that, keeping into mind certain criteria, certain considerations or certain factors, he will decide what would be material in the given circumstances. So the factors that he would consider is first, what misstatements, whether individually or collectively taken together, would have an impact on the economic decisions of the users. What items or what amount would be affecting the economic, the financial decisions of the users. If a particular statement or a particular item is going to change the user's decision, then that is going to be what? The material information for us or a material misstatement for us. While considering materiality, you have to give regard to the surrounding, that is the industry and all. You have to give regard to the nature, the size, everything. The example where I give you about Reliance, Tata, there even a lakh will be immaterial, but for a mediocre firm, 1 lakh would definitely be important. So depending upon the size and nature, we are going to consider the materiality. Finally, there are multiple users of the financial statements. Because we are telling that material is something which is going to impact the decision making of the users, does not mean we will be in a position to take care or understand every individual user of the financial statement. Therefore, we will be choosing materiality level, keeping into mind the common financial information needs. So that item or that element we are going to pick up, which is going to cater majority or most of them. Individually, we cannot, right? Then, materiality is a concept which at the planning we are going to fix a level, which we basically call it to be the material level. So when we begin, we keep a standard format, maybe it is 1 lakh, maybe 5 lakh, maybe 10 lakh, sometimes 15 lakhs, sometimes 50 lakhs also, depending upon the size of the organization. That we call it to be material level. But while we perform the audit as well, there also we are going to fix in a material level. But this will be below the materiality, that is which we have fixed in for the financial statement as a whole. In my example, let us take 50 lakhs. So this, while we actually perform the audit, we will keep a performance materiality which will be below the main materiality. Let us take the example of 35 lakhs. So then what I will do is, by keeping some kind of percentage calculation, like maybe 50% of the materiality, 75% of the materiality would be my performance materiality. That means what will I do? While I actually start doing the audit, I will not check only those transactions which are above 50 lakhs. I will start checking some which are below the 50 lakhs also. So this another level which is below the main materiality, I would call it to be performance materiality. And I would actually begin my audit from that level. Reason is very simple. These would be some uncorrected misstatements which in individuality would not be material. But when you collectively aggregate, put them together, they could materially impact the financial statement, the decision of the users of the financial statement. Correct? So this level, which is below the materiality level, which we are going to fix on the overall financial statements, this level which is lower, we call it to be performance materiality. Now, performance materiality could be mentioned separately for different transactions, for account balances separately, for disclosures separately, depending upon the risk involved, depending upon the statutory obligations involved, depending upon the type of industry and which element would be very important, or depending upon the user's focus where it could be. So like that, the performance materiality could be shifted up and down depending upon what would be the information needs. Correct? Now, materiality and performance materiality, the overall concept of materiality becomes important everywhere. Be planning, that we understood, performing understood, including conclusion, because in conclusion, if we have to modify the opinion, we will consider only the impact of those statements, misstatements which are going to be material in nature. So this plays a very important role in all the three stages of the audit. Now, the next part is how to choose the material level or how we fix a materiality. For this, we have the method of a benchmark. Benchmark is going to be that element or that particular item which in fact is going to have a considerable impact on the user of the financial statement. Keeping into mind many factors like what is the stage of the life cycle the entity into, which element would be more important to the user, what is the structure of financing, whether it is equity or debt, or maybe what is the nature of the entity, the industry that it belongs to. Okay, all of these factors we will consider and come to an appropriate benchmark. This benchmark is a very important understanding of the auditor. On this benchmark which we choose, we will be applying a percentage which is going to be purely the judgment of the auditor. And this percentage which you apply on the benchmark will become your material level. And this will be to begin with what we fix the material level for our beginning of the audit. When I say beginning of the audit, I simply mean initially to begin the audit, we need to keep a material level and this benchmarking will help us there. Then, when we fix a material level, it does not simply mean that you cannot change it. Be material, be performance materiality, as and when the audit progresses, as we encounter new circumstances, as new situations come across, new misstatements we identify, new understanding which we were not aware earlier, we will change the material level. And that we call it to be revision of the materiality as and when the audit progresses. And this is very much acceptable because the ultimate conclusion is what? To bring the probability of the risk to an acceptable lower level. Even performance materiality is what? It is to bring the probability of the error to a lower level. Correct? 0, it cannot happen. But can we bring the probability down, the risk down? Yes. Correct? Then we have then to understand how is planning and materiality connected. Understand, a change in materiality is a change in plan. Because if the materiality level undergoes a change, the nature, timing and extent of the audit procedures also undergo a change. So they are connected, very closely connected. A change in one will impact the another, obviously. The extension, the increase in the NTE will be dependent upon the materiality as well. So you revise the materiality level, the planning also undergoes a change. The last concept that we study here is about audit risk and audit materiality. Where I told you the relationship between them two is about the inverse relationship. Higher the audit risk, materiality level will be lower. Lower the audit risk, materiality level will be higher. Why? Because ultimately our effort is to bring the audit risk to the acceptable lower level. So when we believe risk is low, we will check fewer items, so we keep the material level high. When we say risk is high, we would check more items, because of which material level will be lower. So there is inverse relationship between audit risk and audit materiality. Finally, to conclude, the documentation. This standard talks about the documentation where we tell that you have to mention about the material level which you have set at the planning stage. Then you will talk about if there is any particular item, only because the nature of that item you have kept a different material level, then you write about the nature of that item, that is whether it is account transaction, balance, transaction or disclosure, and what is the material level which you have fixed it. Third we talk about is the performance materiality, and on that note, if there is going to be any significant change or maybe the revision in the materiality level or the performance materiality, you need to document about the same. Alright, so this is the overall understanding of SA 320, that is materiality in planning and performing the audit. For exam point of view, one of the important standards that we have to discuss. This is a standard, examination very important, conceptually very important. If you try to by heart, you will not be able to retain it for a very long period. So I request everybody to actually understand it and learn it like a concept and not a theory. Very simple standard, at the intermediate level, a very highly concentrated standard, and the first part of the discussion that we had, highly relevant for the intermediate people. But when you talk about CA final, the last part that we covered about the management's expert is the highly focused area. So overall, this standard plays a very important part of examiner's point, that is very important for the examination as a whole. Having understood the entire standard in detail, it is now time for us to understand the standard in a summarized manner. This summary will enable you to understand the flow of the standard in a perfect direction. Alright, so we begin with SA 500, audit evidence. What is evidence? It is the information collected by the auditor for the purpose of drawing opinion on the financial statements. Now, when you talk about information, what constitutes an audit evidence is what we talk about in the standard. Evidence, we always use the word sufficient and appropriate, where sufficiency we connect it to the quantum and appropriateness refers to the quality. Quality means the audit evidence that you get or you collect should be relevant and it should be reliable. Relevant as in, for the appropriate assertion or for the appropriate transaction that you are checking, the data that you correlate to it should be relevant enough. For example, when you check the telephone expenditure, the corresponding invoices of the telephone or the telephone bills should be appropriately checked. So what information you collect should be relevant in the scenario. And reliability is what we talk about is more reliable. Only then we call it to be appropriate. So we have two terms, sufficient and appropriate. And sufficiency, the quantity simply talks about how much evidence should be obtained in order for us to draw a reasonable conclusion. Then we talk about is the reliability of the audit evidence. The concept of reliability tells that where will the auditor believe that the quality of the evidence would be better. Very simple to understand. First, external evidences will always be more reliable than the internal evidences. Evidences in the written form will be more reliable than the oral evidences. Evidence which the auditor will obtain directly will be more reliable than obtained through the client. Internal evidences would be more reliable only if the internal control systems are strong. And the last, we say that the original documents would be more reliable than the photocopies or the films or the digitized formats that we have. Alright, so this talks about the reliability. Now, understand when we have to perform the audit, performance of the audit is nothing but performance of the audit procedures. Why do we perform the procedures? To obtain the audit evidence. And what kind of evidence do we require? Sufficient appropriate audit evidences. Now, when you talk about what procedures are we following, we broadly have two types of procedures. One we call it to be RAP, Risk Assessment Procedure, and the other we call FAP, Further Audit Procedure. Risk Assessment Procedure we will be doing by understanding the entity and its environment, and will identify all the risky areas in this procedure. Then, based on the result of the risk assessment procedure, we will then do the further audit procedures, that is, the compliance procedures and the substantive procedures. Compliance procedures we do for the test of controls, that is the internal control checking, whether they are present, if they are present, are they operating, and if they are operating, are they effectively operating throughout the year. Then we talk about substantive procedure, where we are going to do the test of details, where we check all the transaction and the account balances. Then, these are the procedures we follow to obtain evidence. Now, when these procedures are followed, what are the methods that we are going to use to follow these procedures? The first method we talk about is inspection, that is examination of the records, documents, tangible assets. Then we talk about observation, that is visually the auditor will be observing the process, the physical counting, etc. Then we have the recalculation, basically to check the arithmetical accuracy, where I gave you the example of depreciation calculation. Then we have the reperformance, where any of the procedure already performed by the client, you will reperform it just to ensure it is sufficient and appropriate evidence for you. Then you have analytical procedures, which will help the auditor to draw some kind of understanding of whether there is kind of unreasonableness between the data that is given. Then we have the external confirmation, where the auditor will be directly getting the responses from the external parties, which we will consider to be very reliable. Then we have the last one, which we call it to be an integral part of the audit, which is an inquiry which will be conducted. Inquiry is an integral part of the audit which will be conducted throughout the course of the audit. From the beginning of the audit to the end of the audit, continuously there will be a conversation struck by the auditor with every personnel in the organization. This inquiry could be either oral or it could be written. But the best part of the inquiry is that it would give an indicator to the auditor which he was not getting it while he was obtaining the other audit evidences. So there could be a possibility that a conversation with one of the employees gave you an idea of something which you were not able to get through the other evidences that you have obtained. So this is one of the very important things that you do as a part of the methods. So that is what inquiry. Now, the next part of the standard talks about inconsistency in the audit evidence. Meaning of this is, suppose for one particular item, the evidences that you have obtained are maybe 3 or 4 in number. But all the 3-4 evidences, different evidences that you have obtained are all giving you the different answer. Like for example, if you talk about inventory, when you look at the stores ledger, when you look at the accounts, inventory valuation, or when you look at the closing stock figure, or when you try to get some kind of confirmation from the creditors or the debtors for understanding the sales and the purchases, for us to do some kind of reverse calculation, all of these evidences which we corroborated together, they are not giving you an uniformity in the answers. So in that case, what happens is, we call it to be inconsistency. So here what happens is, the auditor will have to modify the audit procedure. So he has to check whether he requires to perform additional audit procedure to resolve the matter. Or is it required for him to increase the quantum of the evidences that he has obtained. This is possible when there is an inconsistency, or there is also possible if the auditor believes that the evidence that he has obtained is unreliable in nature. If suppose additional audit procedures also cannot be followed, in that case the auditor is going to think about what will be an impact on the opinion that he is going to give. The last part of the standard, which is considerably very important at the CA final level, is about the management expert. Management expert are those which have been employed or which have been hired by the management who are going to assist them in the preparation of the financial statement. But they are the experts other than experts in accounts and audit. For example, you could have an architect, you could have a chartered engineer, you could have an advocate, you could have a company secretary, it could be anybody or an actuary for that purpose who would help you in the valuation of certain items appearing in the financial statements. Now, there is a possibility that the auditor decides to use the work of the management expert. But because the sole responsibility of the opinion rests on the auditor, it is important for the auditor that before he uses the work or the information provided by the management expert for the purpose of serving it as an audit evidence, he has to do some kind of evaluation. So the evaluation that he will be doing is with respect to three things. First, we talk about the competence, the capability and the objectivity of the management expert. Second is we talk about is regarding how are we going to understand the work of the expert. Third, whether the expert's work is relevant or appropriate for the purpose of our audit. After understanding all the three, we then come to a conclusion whether the information given to us by the expert, are we going to use it as a relevant audit evidence or not. Finally, there is also a possibility that the auditor could obtain information from some things which are within the organization. But when the information is obtained from within the entity, he has to double check it again. That means he will check the completeness, the accuracy of the information, and he will check whether it is precise and sufficiently detailed in order for him to use it for the purpose of audit evidence. Suppose if you take a purchase order, if the purchase order is not properly completed, if all the details are not properly appearing, then this purchase order will not prove or will not serve as a sufficient audit evidence. So this is all about SA 500 audit evidence, and as I told you, examination one of the highlighted areas. So now let us understand in a broader perspective about all that we have spoken about inventory as a specific consideration for the selected item. So what this particular part is telling you, that for first selected item as per SA 501 is about inventory. About inventory also, the standard is focusing only about which assertion? About existence and condition of the inventory. Here we talk about a normal scenario first, that look, auditor, you go ahead and attend the physical count of the inventory which is conducted by the management. This happens when on 31st March the year end. So when they are conducting, you present yourself that time, understand all about the count, their procedures, their monitoring controls, how they are maintaining the control over the counting. Then you would also be able to inspect certain documents. You will be able to inspect or do a test count by yourself. This will enable the auditor to ensure what is given in the records and what is really existing, whether it is correlating or not. Alright? But we also study about rare circumstances, which are 4. 1. Inventory count did not happen on 31st of March. Second, inventory count happened on the 31st of March, but the auditor could not attend. Third, impracticable for the auditor to attend the physical count whenever you conduct. Fourth, if the inventory is lying with a third party. In the first, we understood very easily that when the auditor, if the management is conducting on some alternate day, the auditor has to attend on that particular day, and then he will do the reverse calculation for all the intervening transactions that have happened. So he will do a reverse count and come to a figure of closing stock as on the 31st of March. Second, if the auditor could not present himself because of maybe accident, emergency, any other thing, and when they were conducting he was not present, then he would request them to conduct at some other date. But if the management does not listen, you will perform alternative audit procedure. In alternative, there could be a possibility that management is conducting on some other day as well. So attend that and do the reverse calculation. If they are not conducting any other physical count, then you perform alternate procedures by inspecting certain documentation. But if that also is not possible, then you will have an impact on the audit report. Third, if it is impracticable, dangerous, hazardous, very risky for the auditor to reach the location of the physical count, then in that case obviously will not reach. So what will happen here? You have to perform alternate audit procedure. But if the alternate audit procedures are not reliable enough, in that case, you are going to modify the opinion as per SA 705. And last, when the inventory is lying with a third party, you first obtain a direct confirmation from them. But if you believe the third party is not reliable, you have a doubt as to their integrity, their objectivity, you believe they are not competent enough to reply back to you. Okay, in that case, what will happen? You will perform additional audit procedure. Additional here would be, you could appoint another auditor to go and physically inspect there. You would obtain their audit report, that means they have their own auditors, so obtain their audit report. You would obtain the confirmation from the third parties like the warehouse keepers. You would also request the bankers to give you a confirmation regarding all the inventory which has been pledged with them as a collateral security. Correct? You would inspect certain documents to ensure the existence. All of this is what you will do as a part of your checking regarding the existence and the condition of the inventory as per SA 501. So this was all about the first selected item, that is inventory. Now, having understood SA 510 in detail, it is now time for us to understand in a summarized manner. This will help you understand the flow. Also, if there are some kind of misconceptions in between, even they will get cleared. So with this, we'll start with the summary of SA 501. So again, the name of the standard, Audit Evidence, Specific Consideration for Selected Items. That means there are 3 selected items where it is required for the auditor to obtain sufficient appropriate evidence for some specific consideration. There are specific assertions. Alright, now the 3 selected items are: first, inventory; second, we talk about claims and litigations; and third, we talk about is the segment information. So let us understand first, that is about inventory. But before that, you need to understand that this particular standard is very clear about validating only certain assertions. That means when we talk about inventory, all the assertions connected with inventory we are not validating here. Here we talk about only 2 specific assertions. On the similar lines, claims and litigations, only a particular assertion. On that last one, which we talk about segment information, there also we have a particular assertion to be validated. So I would rather say it is selected item for a specific assertion as well. So in the inventories, the auditor has to ensure about the physical presence, that is physical existence, and the condition of the inventory. Second, claims and litigation, you have to check the completeness. And third, when you talk about segment information, you have to ensure about the presentation and disclosure of this information. So basically, we are going to talk about these 3 things in detail. So let us understand the first one, that is physical verification or the inventory. Alright, now inventory in those organizations where inventory happens to be material item, like for example for FMCG products, fast moving consumer goods, where inventory is going to be one of the major items of financial statements to be evaluated by the auditor. Usually, inventory to understand and to verify, the ideal thing is that you have to attend the physical verification or the physical count conducted by the management. This happens on the 31st of March every year, and this is conducted by the management. So the auditor has to make himself available on 31st of March and present himself or be present at the physical counting which is happening. If the auditor it is possible for the auditor to attend the physical count of the inventory, then there he has to very clearly understand, that is, he has to assess the management's instructions given to the staff for understanding how the counting process is happening. Second, he himself has to observe the entire physical process which has been going on, the physical counting that is going on. Also, he need to inspect the inventory. Why inspection becomes important? Because there is somebody else who is doing the physical verification. So only if you observe, you would be able to understand physically they are present. But this standard also tells you that you have to check the physical existence, but along with that, you also have to check the condition as in the quality of the inventory. Because only the good quality inventories are valued at one pace, at one type, and when you are discarding or there is an obsolete inventory, there is a different valuation methodology. So in that case, you have to understand that if you inspect the inventory by yourself, you will be able to understand the condition of the inventory. And then you could also take up some test count. What do you mean by test count? You could participate physically by yourself in doing some kind of test checking of the inventory. So maybe if there are 5-6 godowns together, maybe one of the godowns you can actually have a physical verification conducted by yourself, and the remaining you could simply be an observing person to observe the count happening by whom? The management. So this is where you could be present at the time of physical counting conducted by the entity, that is on 31st March usually. But now in this standard, we have also covered rare or different circumstances or special circumstances where maybe the physical counting is not happening on 31st of March, or maybe it is happening on 31st March but the auditor is unable to attend due to some reasons, or there is a possibility that whenever you conduct the physical count, the auditor, for him it is impracticable to be present at the physical counting. So we are going to now discuss about 3 scenarios which are different, which are special. What is regular? One regular is where regularity means what? They conducted and you attended on the same day. So that point is quite simple to understand, where you will be checking about the management instructions, you would do the observation, you would do inspection, you would also do the test count, whereby you will be able to come to a conclusion whether what is given in the records and what is available, whether it is matching or not. But there are special circumstances. So let us take up the first one. The first one is where the management has not conducted the physical verification on 31st of March. Rather, they have conducted the physical verification on maybe a day other than the 31st of March. So it happened on 5th of April, 7th of April, 10th of April. In that case, if suppose the auditor presents himself on the later point of time where the physical verification is conducted, obviously we are going to give the opinion on the financial statement as on 31st March. So you need to understand the figure as it would appear or as it is accurate as on 31st of March. So on 7th of April, you will be able to understand the position as on that date. So what you will do as the auditor? You are going to perform the procedures wherein you will be able to do the reverse calculation and come to the position as on 31st of March. What is reverse calculation? Where all the sales which have happened, you will add it back to the inventory. All the purchases that you made in the intervening period, you will deduct, right? So you will apply some additional procedure and you would recalculate in a reverse order. That means you will go from 7th of April and you will reach where? On 31st of March. So in that way, you will be able to understand the position as on 31st of March. So this is quite understandable. Let us understand a situation second now, where the management is conducting the physical verification on 31st of March. But the auditor has started towards the office, but due to some unseen circumstances or maybe something beyond your control like accidents, emergencies, where he is not able to present himself on the date where physical verification is going to be conducted. So now the management is conducting the physical verification, but the auditor is not present. So what the auditor could do first is that he would inform the management, look management, please change the date of your physical verification. If the management agrees, then you would request the management and the management would shift the date on the data point of time. And then you come to the category 1 where you will do the reverse counting. But now, no guarantee that the management is going to agree. So in that case, the management says, no, we have to conduct it today itself. So the management will conduct the physical verification, but you are not present. That doesn't mean you are going to simply rely on the reports prepared by them. No. So what will you do is, you will perform alternative procedures. So you could see that if suppose management is going to conduct immediate physical verification after a week or maybe after a fortnight, you would be present at that point of time. But if suppose there is no physical verification conducted by them, then you would perform alternate audit procedures. What could be alternate audit procedures? You could check some documentation of sales, purchases, all of that. And through some alternate audit procedures, you could do reverse calculation and check it. You should ensure cutoff procedures have been properly followed by the management. But if suppose alternate procedures are not possible and you are not able to understand what would be the position as on 31st of March, then you are lacking a sufficient appropriate audit evidence, and this would definitely impact your financial statements or your audit report, right? Then comes to the third one, where it becomes impracticable for the auditor to attend the physical verification. Here, whether the audit client is going to conduct on 31st of March or 5th of April, 7th of April, 10th of April, does not matter. Any point of time the client is going to conduct, you as the auditor will not be able to attend. Why? Reason could be there is some kind of disturbance happening in that region. There could be some kind of chaos. There could be some kind of regional wars going on. There could be some kind of bandh. In India, we have this very common thing called as nation is bandh or it is lockdown. Okay, so maybe in those areas there is some kind of political disturbances happening or something, and for the auditor it has become very risky to go to that particular location. So what they are saying, whenever you conduct, the auditor, he will not be attending. So in that case, obviously, we will try to perform alternate procedures. We would inspect the documents, specific purchases, specific sales in the intervening periods. And through this, we will be able to give an opinion or come to a conclusion whether inventory is valued correctly or not. But if suppose alternate procedures are also not practicable and we are not in a position to give sufficient appropriate audit evidences, that means we are not able to obtain by the alternate procedures. In that way, we will definitely check what would be this impact on the financial statements. That means we could have be modified opinion as per SA 705. Now, these are three different categorizations where we understand that for physical verification we are not able to be present. But there is one more fourth situation which has been given here. When the inventory is lying with third party. So when the inventory is lying with the third party, it is your inventory. So obviously that part also should come where? In your physical count, in your valuation. So here what happens is, it is very important that you get an understanding of what? The presence as well as the condition of that inventory which is with the third party. Third party could be your agents. Third party could be a banker with whom you have pledged it like a security. Alright. So third parties could be your consignees. Anybody would be a third party, even the warehouse. So you are maintaining your goods in the godown. So the warehouse keeper, third party, right? So if your goods are with the third party, lying with the third party, to understand the physical presence and the condition, what are the requirements? So you need to obtain sufficient appropriate audit evidence. So what will you do? First, very importantly, third party. So you would follow SA 505. So you would obtain external confirmation about the physical presence and the existence. But if suppose we have a doubt as to the reliability, if we feel that it is not that reliable source to obtain, maybe the person who is going to give is not reliable enough, or maybe you have a doubt as to the integrity, then in that case we will go to alternate audit procedures. Here what would be the alternate procedure? You could send another auditor to that particular location to inspect it, or maybe you could yourself go and present and go and do the physical checking by yourself, or there could be a possibility that third party has their own auditors. So you could request for their audit report. Alright. So like this, you could obtain certain other methods, or there could be some other procedures through which you could obtain an understanding of the physical presence as well as the condition of the inventory lying with the third party. Ideally, we obtain direct confirmation. But if that is giving a doubt for us, in our mind there is a doubt as to the sufficiency or the appropriateness, then in that case we will go to alternate. Alternate would be you could yourself go, send another auditor, try to get some kind of inquiries, okay, or maybe they have their own audit report prepared by their auditor. So you could obtain a confirmation from them. You could get their audit report for cross verification. So all of this is what you do as a part of what? Doing the alternate audit procedure for understanding the inventory lying with the third party. You could also inspect certain documents like the warehouse keeper's records. That also would be inspected by you. So these are the alternate methods when you believe direct confirmation is not going to be supportive. So these are all the ways through which you will be understanding about the physical presence, that is the physical existence as well as the condition of the inventory. So physical existence basically means what? Physically it is present. Alright, that means actually it is there or not there. Condition refers to the quality. That means is it in good condition or is it obsolete, to be discarded, spoiled, what is it? These two assertions you are going to validate where? In SA 501. So very specifically you are going to come to a conclusion whether physically they are present and whether the quality of that inventory as given by the management is correct or not. Clear? So that is about what? Inventory. Now what is the next item of discussion here? It is about claims and litigations. And what are claims and litigation? The legal cases going on against the entity, that is our client, right? Now here we need to obtain sufficient appropriate audit evidence whether the management has disclosed all the litigations going on against the entity correctly to us. That means in the financial statements, all the provisions, all the contingent liabilities which are appearing, with respect to all the court cases, legal expenses, all of that, whether it has been properly disclosed by the management. So what you have to understand here, whether all the information regarding claims and litigations are completely given by the client, that is the management, to us, and also they are disclosed correctly where in the financial statements. What will the procedure be adopted by the auditor here? Very simple. You first have to communicate with whom? The management, the other people in the organization, and also the in-house legal counsel. What is in-house legal counsel? We could have hired the lawyers. There could be an integral part of the organization. We have employees working in the department of entire legal counsel, right? So who are going to particularly take care of all the legal matters going on. So you could have in-house, that means internally to the organization, a separate department altogether who is going to take care of all these kind of matters. So we could communicate with them as well. So the first thing we do is communication, that is nothing but inquiry. So we are going to first inquire about all the claims, litigations, what is the matter, how much is the provision to be created, if what is the provision created is relevant, reasonable or not. So all of this we are going to have a communication with them. Second, you would be reviewing the minutes of the meeting which has been conducted between whom? The TCWG, management with the legal counsel. So the legal counselors and all the people within the organization, that is TCWG and management, obviously they have meetings throughout the year. If there is any court case going on, you will definitely have meetings, right? So in these meetings, what has been discussed? What are the matters taken up for discussion? All of this will be registered through a minute. That minute you can have an access and you can review to understand what was the discussion that was happening. Understand, when you refer the minutes, you will also come to an understanding how many court cases are going on. Because there will be a discussion of all the legal cases which are going on against you. So if suppose the management is trying to hide any of the legal cases, any of the court cases against the client, then in that case, this will be the minutes which will help you to understand that yes, there has been some non-disclosure by the management, indication of something wrong, correct? Then, third would be again the review of the legal expenses. Now in the P&L account, you'll have the legal expenses. Now legal expense and the number of court cases going on, some reasonableness has to be there. When you go and communicate with the management, inquire with the management, they tell you we are expecting a compensation to be paid of 2 lakh rupees. So obviously the legal cases should be below 2 lakhs, right? Because when the ultimate compensation to be paid is 2 lakh, if you are going to expend about 2 lakh, what sense it makes as a businessman to you, right? But the legal expense account is having a figure of 20 lakh rupees. Something unreasonable, something very dubious, something very doubtful. So in this case, when the legal expense is having 20 lakh and the management is telling you only 2 court cases are going on, where an approximate figure that we are expecting is only so much. How can you expend 20 lakh for an ultimate loss of 2 lakh rupees? That is something unreasonable. So this will give a doubt in the mind of the auditor, something is going wrong, right? So here 3 audit procedures basically we follow: inquiring with the management, TCWG, all the internally legal counsels that we have. Second, you will review the minutes of all the legal counsels with that of the management and TCWG to understand the discussions and all of that. Third, we will also review about the legal expense account, properly analyze in detail all the legal expenses that have been accounted for. So for us to understand where is the expenditure done, which direction is the expenditure flowing, whom has the payment been made and why it has been made. All of that you will understand, and basically you will get an idea how many legal charges are actually going on against you. So is there anything which has been concealed by whom? The management, right? Now, suppose by doing all this, there comes in a mind of auditor that there is some kind of risk of material misstatement. If you get a doubt of a risk regarding material misstatement, then in that case, you will also do some additional audit procedures to come to a conclusion whether there is a misstatement or there is not a misstatement. So what you could do here is that you would obtain external confirmation from the external legal counsel. Who are external legal counsel? The advocates, the lawyers externally, the external independent firms which are looking after your court cases, right? So you could also talk to them, get an confirmation from them about the understanding regarding what is the case going on, what is the matter, what could be the expected liability, how much provision would be reasonable, is it probable for us to lose. All of this information we could acquire from the external legal counsel. But at some point in time, even the external legal counsel will not be able to reply back to you. Because these are independent bodies. They will have their own law and regulation. Like how we auditors have the concept of confidentiality over us, which is coming to us from the ICAI. On the similar lines, when we have a code of ethics governing us, on the same lines, we will be having those professional bodies also having their code of ethics. So suppose if the legal counsel, the external legal counsel, by their laws and regulation are prohibited to give us any information, then tell me in that case, will they be able to provide us with any confirmation? No. So in that case, we will move on for we will go for alternate audit procedure. Alright, alternate audit procedure could be checking some other documents, or doing some other kind of external verification. Maybe you could talk to some other third parties and try to do some alternate audit procedures. Alright, then there could also be a possibility that you have a doubt in your mind, you want to seek external confirmation, but management is refusing you. Management is not allowing you to communicate with the external legal counsel. Or maybe there is no alternative for us to get any kind of evidence. That means alternate audit procedures are not practically possible. There is no way out through which we are able to obtain external confirmation. We are not able to follow any alternate procedure to obtain sufficient appropriate audit evidence. So by any which way, we are not able to get sufficient appropriate evidences regarding the completeness. That means all our disclosures have been made properly regarding claims and litigations. So in that case, tell me, will you conclude just like that? Or will you look in for SA 705? First, you communicate with the TCWG and understand the matter. If it is not happening, then you have to communicate through your audit report and you have to get an understanding through SA 705. That means there is going to be an implication on the opinion on your financial statement, and we could end up giving a modified opinion as per SA 705. When you are not able to obtain confirmation, alternate procedures not possible, management not allowing you to obtain confirmations. So in that case, we would see or recheck what would this be impact over our opinion on the financial statement, and thereby we would see the consideration of SA 705. Now, one very important thing which I have already explained, that whenever something becomes a management responsibility, you have to get an acknowledgement of their responsibility through a written representation. Because written representation is also an audit evidence. Though it is not a sufficient appropriate evidence, it is basically a supporting audit evidence. So it is very important, when something is a responsibility of the management, you obtain the WR. So tell me, giving full information and giving full disclosure of all the claims and litigations is of whom? Management. So you as the auditor could obtain written representations or management representation letter from the management telling them to give an accountability or giving them a confirmation that they have disclosed all the claims and litigations which are known to them and they have been accounted properly in the books of the account. Clear? So you will obtain a written representation. From whom? The management. That they have disclosed everything regarding claims and litigation. If you do this, then you would be able to get you could be able to get a persuasive evidence, or you would be able to get an evidence regarding the completeness of the claims and litigation, which is required by SA 501. And the last part of the standard talks about is segment information. Segment information, as I already explained, those organizations which are required to report segment wise because of the accounting standards being applicable, AS 17 or Ind AS 108, they would be required to disclose or present the financial statement even the segment wise. So basically you have the industries in the FMCG, that is fast moving consumer goods, or you could have some which are diversified in multiple projects, or maybe those are geographically spread very wide, okay, they have multiple sectors, areas and all of those. They would be required to give their information even segment wise. So you have two accounting standard, you have an accounting standard called AS 17 and Ind AS is covered by 108, where they will give you a proper understanding of how the information has to be segmented, how you have to choose your segments, what is the criteria, and basically how do you present and disclose the segment information. So now, if suppose the particular entity which you are auditing is required to comply with these accounting standards, then in that case, you the auditor is required to obtain sufficient appropriate audit evidence regarding the disclosure and the presentation of segment information as per the applicable financial reporting framework. What is financial reporting here? That is AS 17 and Ind AS 108. Along with that, you would also check the methods that they have used or applied for dividing their segments. Also do the analytical procedures to understand whether the prior period and these segments are consistent. Also importantly, you can do the industry comparison. Two FMCG companies, what is the way they have bifurcated their segments? Do a comparison to understand the presentation and disclosure whether it is as per the applicable financial reporting framework. And the methods which the auditor can use to understand, or the examples through which the auditor can understand the methods that are being used by the management in dividing the segments would be, you could take the sales, the transfers, the inter-segment transfers that are happening, the charges that have been shown to understand the methodology that they are using to divide the segments. Maybe it is product wise, maybe it is location wise, where you could see just the departmental transfers that are happening or the segment wise transfers that are happening to understand what is the segment that they are bifurcated into. Or you could see the allocation of cost and the asset. How is the cost being divided into different segments? Based on that, how is the asset allocation done? So this would be also a method through which they could divide the segment. You could also check the prior period disclosure of segments, whether it is consistently followed this year or not. So these are the ways through which you will be able to understand whether the presentation and the disclosure of the segment information has been done correctly or not. So in a nutshell, this standard simply tells the auditor, look auditor, you have a responsibility of obtaining sufficient appropriate audit evidence about specific assertions of selected item. The three selected items once again are inventory, claims and litigations and segment information. The assertion about the inventory is about physical existence and the condition. About claims and litigation is the completeness, that is identification of all the claims and litigation that is to be disclosed by whom? The management. Third, we talk about segment information just to ensure the presentation and disclosure is as per the applicable financial reporting framework. So this is all about SA 501, audit evidence, specific consideration for selected items. Let us now have an entire summarized approach for the entire standard of SA 505. Alright. So SA 505 external confirmation, let us understand in a summarized manner. 505 external confirmation talks about written direct responses from the third party which the auditor is going to obtain and which is going to serve as an audit evidence to the auditor in drawing his conclusion. This is an audit evidence which we consider it to be very reliable because as per SA 500, when we speak about reliability and we do some kind of comparison between how a reliability is measured, external confirmation stands in all the categories. Like external is more reliable than internal, return is more reliable than oral, directly obtained by the auditor, more reliable than through the management. All of these if you check, or any confirmation or information requested directly from an independent third party outside the entity would be more reliable. So these are all the reasons that we give for reliability. And all of these qualities are present in the external confirmation, and because of which we call the external confirmation to be one of the reliable audit evidences. We have two types of external confirmation request. One is the positive confirmation, other is the negative confirmation. Positive confirmation tells when the auditor is going to send a confirmation request to the third party is required to reply whether they agree or whether they disagree. So whatever is the situation, they are supposed to reply back. That is called as a positive confirmation request. When you talk about a negative confirmation is where the auditor is supposed to send a confirmation request and the third party is supposed to reply only if they disagree. That means if they agree to the information questioned by the auditor, they need not reply. So their reply will be expected only in the case of disagreement. On the contrary, we have one more kind of a positive confirmation where the information sought is kept to be blank. And this blank has to be filled in by the third party, which we call it to be a blank confirmation, which is very much a part of positive confirmation. After this, we studied about the areas where this kind of request will be done. Very common or very much understandable wherever a third party is involved. It could be lenders, it could be debtors, creditors, inventory lying with the third party. It could be when investments are purchased by the entity or they're acquired by some third party. Or maybe it could be when you have your title deeds kept with the others, that is the third parties. All of these, wherever third party is involved, you will seek an external confirmation as an appropriate audit evidence. Then we understood about the procedure, how the evidence will be obtained. First, you have to first decide what is the information that you want to confirm, whether it is a number, whether it is going to be some kind of detail, whether it is a term of a contract, whether it is some kind of condition which you want to clear. So all of this is what you are going to decide on the following criteria. After you decide what information you want to confirm, you will then see the corresponding relevant parties to it. So if the information is about a loan agreement, obviously the confirming party will be the banker. So you will choose the appropriate third party with whom you are going to confirm the information. Then you will design the confirmation request. When you design the confirmation request, two things properly to be kept in mind. One, it has to be properly addressed. Second, it should give a clear indication that it has to be replied back only to the auditor. Then you talk about is, you send the confirmation request to the party that you have identified, and if they don't reply back, you are going to constantly follow up. Now there are certain factors that you are going to consider while designing your audit confirmation request. So which are the factors you will confirm? First, what would be the assertion? What are you going to check? Is it valuation? Is it going to be existence? What is the information that you want to confirm? Which is the assertion. If you believe there is a risk, go in for a positive confirmation rather a negative confirmation instead of a negative confirmation. Then you will design, think about what would be the layout, what would be the presentation. The better you present, the better you can expect the reply. Because if they are sophisticated and if they are properly drafted, the third party is very clear to reply back to you. Then, if there is a previous experience of the auditor where third party has not replied back, then in that case, we would recommend you go in for a positive confirmation request. Then, we talk about the method of communication, whether paper, whether through postage, whether you are going to get an electronic mail, what is it? Then, we will also consider whether third party is whether it is willing to reply back to the auditor or not. So we will see how is there going to be an encouragement from the management to authorize or to request the third party to reply to the auditor. And finally, we will be choosing those third parties who have the ability to reply back to the auditor. So these are all going to be the factors which we are going to consider while designing our external confirmation. Now, when we send the external confirmation, there are two possibilities on priority. First, you would reply, get the reply. Second, you will not get the reply. So if you get the reply and if the reply is reliable, no problem, accept the audit evidence. Accept the confirmation as the audit evidence. Sufficient, appropriate audit evidence. But suppose you get the information and the information is not reliable. In that case, you cannot accept the information. So you are going to extend the nature, timing and extent of the audit procedures. You will apply additional audit procedures to understand the same, and that means to obtain further audit evidences to confirm the matter. Second, if suppose the third party has not replied back to you, in that case, you will perform alternative audit procedures and obtain the audit evidence. But there comes a third situation, which is a unique one, where external party has not replied back to you and there is no alternative procedure which you can apply. So in that case, what you will do is, you are going to check the impact that this would have on the opinion. Is it an indicator of the possible misstatement? And this would have an impact on the opinion, and you would modify the audit opinion as per SA 705. Alright, now, what will happen if there is going to be an exception? What is exception? The information sought by the auditor or the accounting records of the client is giving an information and the party which has confirmed has given another information. These two are contradicting And when there is a contradicting audit evidence, we give rise to professional skepticism. So the auditor cannot keep quiet. He has to start questioning. And when we question, we are going to investigate the matter further. And this investigation will indicate if there is going to be a possibility of misstatement. I mean, if there is an indication of this possible misstatement, this investigation will help the auditor to ensure whether there is really a misstatement or there is not a misstatement. Thumb rule, do not come to a conclusion. You first have to investigate the matter, only then draw the conclusion. When you evaluate the audit evidences, that is, evaluate the external confirmation, check the reliability, and if really not reliable, you have to perform additional audit procedure and then only use it for the purpose of your audit. Now, there is one of the special circumstances in case of external confirmation. Sometimes the auditor wants to send a confirmation request, but the management will refuse the auditor to send the confirmation request to the third party. When the management is doing that, do not jump to a conclusion that there is a fraud, management is hiding something. No. Here we will first go and question the management. Why management? Why cannot we give or go and question the third party? So there could be a possibility that the management has a genuine answer for it. I gave you the explanation of a credit balance where you have tried to make the payment but the creditor is not traceable. So in that case what happens? Even if you want to send the confirmation, you will also not get a reply. So this is a reasonable justification given by whom? The management to the auditor. So in that case, the auditor will move in for alternate audit procedure. But if alternate procedure is also not available, then in that case we are going to communicate the matter with whom? TCWG, and will check the impact on the audit report and the audit opinion as well. Second, if suppose the management is refusing you and they also do not have any reasonable justification for the same, then you will communicate the matter with whom? The TCWG. Moreover, you would also check the implication on the audit opinion and check if there is a modification required as per SA 705. And the last part about the standard talks about the negative confirmation request. Not every time negative confirmation would be desirable, because negative confirmation is always going to be a persuasive audit evidence. That means it is always going to be a less reliable. But there are situations where the auditor could use the negative confirmation. For this, there are 4 conditions to be fulfilled. First, the area where you are seeking it for has a lower risk of material misstatement. That means what? The controls over that area should be effective. So the test of control results have turned out to be very effective. So the auditor believes that the risk of material misstatement would be what? Less in that area. Second, you have more confidence on the accounting records of the entity. So very less chance for you to receive an exception from the client or from the third party. That means what? You have a confirmation, you have a belief in the accounting records. So the exception expectation from you is what? Lower. So negative confirmation, fair enough. Third, there has not been any experience of the auditor where to that particular party he has requested information and he has failed to reply. So there has not been any kind of incidence where the auditor has a reason to believe that the third party would not reply, because always the third party has replied. And last one would be the population, the nature of the population. That means if all the items in the population that we are going to check are having similar characteristic, they are homogeneous in nature, then in that case, obtaining positive confirmation from all of them would be waste of time. So in that case, we would go in for what? Negative confirmation. Even if we can get few replies, we will be in a position to come to a decision. So if all the 4 conditions are satisfied, we would move in for a negative confirmation. Otherwise, we would stick ourselves only to external confirmation. So with this, we close the entire standard of SA 505. Understand? The knowledge behind this or the content behind this standard is pretty simple. Examination, you have questions coming from here. So according to me, is one of the bonus areas where you could score in the audit paper. So as you have understood, conceptually simple, language wise simple, And the procedure also is very, very simple in the standard. So one of the easy standards that you understand here. So with this, we close SA'505 external confirmation, which is one of the important audit evidences which the auditor will obtain. Having understood SA'510 in detail, let us now understand it in a summarized manner so that your concept will be even more clear, even more sharper. Alright, so SA'510 initial audit engagement, opening balances. So this standard is giving a responsibility on the auditor in case of initial audit engagements. So it is a conditional standard which very simply says if it is your initial audit engagement, then this standard becomes applicable on the auditor. And he has a responsibility in the standard with respect to the opening balance verification. Clear? Now, what do you mean by initial audit engagement? Very simple. Initial audit engagement simply means you are taking up the audit for the first time of this client where the previous year has been audited either by a previous auditor or the previous year has remained unaudited. But for the current year, you are doing the audit and it is the first time that you are going to do the audit. So obviously, your responsibility is with respect to the giving an opinion on the closing statement, that is the financial statement at the year end. Now tell me, when it is the closing balances which you are going to report upon, if you have not checked the opening balances, will you be able to obtain a reasonable assurance? Will you be able to give a reasonable conclusion and the opinion appropriately? Absolutely not. For example, if suppose you are doing the audit of 21-22, we understand that you have to report on the figures as reflected as on 31st March 2022. But these amounts are the reflection of the transactions which have happened during the year plus regarding the opening balance as well. So when you have not checked the opening balance, then in that case, how can you conclude closing balances are correct? Because closing balance is nothing but opening balances plus the transactions that happened during the year, which will ultimately give you what? The closing balances. So without checking the opening balance, you could never reasonably conclude the closing balance correctness, right? So if it is your initial audit engagement where previous year remained unaudited or it was done by some predecessor auditor, you as the auditor are required to check or understand or correctness of the opening balances of the current year. So in my example, from 1st April 21 to 31st March 22, when that is your responsibility of giving the opinion, all the transactions which have been present or which are reflected as on 1st of April 2021 will also become your responsibility. Because if the beginning is wrong, ending is absolutely going to be wrong. Because when you start a destination, when you start with a wrong pain at the beginning, that is the wrong route is taken by you and the very first, then you are going to end up in a wrong route 100%. So the destination is going to be 100% wrong. So it is very important that from the very beginning you are at the correct path to reach at the correct destination. Now, here we talk about the terms predecessor auditor, which is the previous year auditor, not from my firm but from some other firm, and he has been replaced by me. So that is called as what? A predecessor auditor. Initial audit engagement, initial, first time you are becoming the auditor of the client. That means previous year somebody else has done it or previous year they have not audited their audit accounts. Then we also talk about what is opening balance. Very simple. Closing balance of the last year is the opening balance of the current year. These closing balances are the reflection of last year events and transactions and the opening balances, and the closing balances. So all the events and transactions that happened in the last year are brought forward this year in the form of what? Opening balance. But only amounts will not be enough. Even disclosures as which are appearing on the beginning of the year are also your opening balances. Like you have the contingencies, you have the commitments which are appearing as a part of disclosures. Those also are the requirement of the auditor to check as a part of what? Opening balances. Now, what are the audit procedures given by the standard for the purpose of checking the opening balance? Very simple. First one, you will take recent year financial statements, audited financial statements or unaudited financial statements if they are audited with the audit report or unaudited if the audit has not happened or the previous year was not there only. Alright, then in that case when you take it up, you will first check what? All the documentation. That means you are going to check about the audit report and you will see if there is any kind of indication that is going to give me an evidence about anything which is wrong in the opening balance. Correct? But before that, it is important for us to understand what is the standard telling us. Why are the audit procedures we are going to follow? Two important things that we have to do here. We have to obtain sufficient appropriate audit evidences regarding two matters. First matter, that there should not be any material misstatement existing in the opening balance which is going to have an impact on the current year. Second, the opening balances are going to reflect correct accounting policies, and those accounting policies have to be consistently applied. If not, there has to be an appropriate disclosure for the same. So for these two things, we are going to perform the audit procedure. So the first audit procedures that we are going to check is for regarding materiality or material misstatement in the opening balance. For this, what we will be doing, we will first check the financial statements of the previous year, that is the recent financial statements, obtain the audit report and see if there is any content which would be of our importance to understand if there is something which would give an indication that opening balance would have a material misstatement. Then we have to ensure or we have to obtain sufficient appropriate audit evidence regarding the opening balance not to contain a material misstatement. This how can we do? First, we are going to check that the closing balance of the last year is appropriately brought forward in the current year. Simple language, copy and paste should happen correctly. Here we also give a due regard to the arithmetical accuracy, whether there is no being any error of commission and all, where you have wrongly given it, there has been a wrong carry forward of the amounts. That should not happen. So the brought forward figures have to be checked correctly. Closing of the last year appropriately brought forward in the current year, along with any prior period adjustments which are there in the statement of P&L are properly reflected or not. Second, you will see that the opening balance are reflecting the appropriate accounting policies. Correct? Third, they are giving you that you follow any of the following procedures for you to get an evidence that there is no material misstatement in the opening balance. So in the third pointer, we have subdivision of 3, which is telling you first, pursue the audit report and the audited financial statements, read them and understand them. They would somehow give you an indicator if there is a misstatement. Second, do not perform any specific audit procedure for the opening balance. You do your regular audit, but there are certain items which will give an indication to you about the relevance. That will be relevant for what? As an audit evidence for the opening balance. Like for example, about the creditors and the debtors and all of that. When you are doing the routine audit procedures which are required during the course of audit, when you are checking the bank transactions or any other transactions, you will automatically get an evidence for the opening balance. So specifically nothing you do for the evidences to obtain for opening balance, but during a routine process only you automatically get what? Evidence for the opening balance. Third, that will perform specific audit procedure. Specific are those areas where in the routine you are not able to obtain evidences with regard to their correctness, their existence, their completeness, their valuation, their rights, their obligations, you are not able to obtain evidence. So for them, specific audit procedures you have to adopt. You can inspect the documents, you can get third party confirmation. These are basically for whom? The fixed assets. They are for liabilities. So in that cases what you require is specific audit procedures on the respective items you are going to perform. Second, these are the 3 things that you will be doing. So basically we have 3. Pursue what? Audit report and the audited financial statements. Second, check the consistency of the accounting policies. And the third one we talk about what? The 3 things. 1, pursue the audit report. Second, you talk about is general audit procedures which we are going to follow in routine. Third, specific audit procedures. General are basically for current assets and current liabilities. Specific is for fixed assets and fixed liabilities or long-term liabilities which are ordinarily going to be specific audit procedures. Now after performing all the audit procedures, have a frame line clear in your mind. After you perform the audit procedure, you will obtain audit evidences. So you have obtained an audit evidence regarding a material misstatement being present where? In the opening balance. So you have to perform additional audit procedures as appropriate to understand whether really there is a material misstatement present, which is having an impact on the current year financial statement. If you conclude that yes, this is going to have an impact on the current year financial statement, that this is as good as what? Evaluation of misstatement identified during the course of audit. So you are going to communicate this matter to the management and TCWG as per SA 450. Correct? Then, this is all the audit procedure regarding what? Identifying what? misstatements in opening balances. But the second part of the standard is telling you what? Regarding accounting policies, whether they are appropriately used, consistently applied, and if not, disclosure requirement. So the auditor has to obtain what? Sufficient appropriate audit evidence regarding its appropriate application, consistently applied, and if not consistently applied, then the reason for the same has to be disclosed and accounted for. Then what we talk about here is regarding the audit report that you get from predecessor auditor, previous year auditor. So when the previous year audit report you read and you realize there is a modified opinion and the reason for modification you read and you understand that this is the reason for modification. So you will understand that this was the area, for example, debtors were misstated, salary was misstated. So there you understand what is an indication that there could be a misstatement. So in the current year, when you assess the risk of material misstatement, you will take into account this matter as well for you to check, put additional procedures and understand what was the reason for the modification and is that modification of the previous year. The reason for modification of the previous year, is it present even today? That is current year. Correct? So this you will take into account as per say 315. Last, suppose you have not able to obtain any evidences regarding the opening balance. You will end up giving either qualified opinion or disclaimer of opinion. You obtained evidences telling that there is a misstatement in the opening balance which are the reflection on the current year. In that case, what you will do? You are going to give a qualified or adverse opinion as which is appropriate. Then, if accounting policies are not appropriate or not consistently followed, in that case, you will give what? Qualified or adverse. That means no appropriate disclosure also has been done. So you will give a qualified or adverse opinion, whichever is appropriate. And suppose if the predecessor auditor had given a modified opinion and the reason for which he has given a modified opinion is not been corrected by the management even today, and that is impacting my current year financial statement also, in that case I will also end up giving what? A modified opinion as per SA 705. So this is all about SA 510, initial audit engagements, opening balances. A very simple standard, very logical, and it only gives responsibility of the auditor regarding you to understand that the closing balance would be correctly shown or would be clearly given as it is correct if the opening balance is correct. Understand, logic is very simple. When you are reaching a destination, that is to give an opinion, if the path that you choose at the very beginning is wrong, conclusion, that is the destination, will be wrong. So this standard is emphasizing only where you begin correctly, the end will be correct, right? And here we talk about which? Initial audit engagement. So it is a conditional standard. So if you remember, we had done SA 200 where we told that the auditor has to comply or do the audit in accordance with all the relevant standard. Relevant or what? If it is applicable in that area, that standard has to be followed. So if it is an initial audit engagement, here the relevant standard will be SA 510 as well. So in that case, auditor will be required to comply with SA 510 as well during the course of conducting his audit. So with this, we close SA 510, initial audit engagement, opening balance. Having understood SA 520 in detail, it is now time for us to get the understanding in a summarized manner so that you get the concept even more better. So SA 520 analytical procedure simply talks about a procedure which is to be adopted by the auditor during the performance of his audit. The meaning of the term analytical procedure comes with the very words analytical, that is to analyze. What is the procedure all about is here? Is that we are going to evaluate the financial information by developing certain relationship, by creating some kind of comparison between the data available with us. With this, we will be able to perform the audit more effectively and efficiently in order to understand that we have completed everything properly. This analytical procedure, in a very simple language, is establishing a relationship between the data which is available with us. As we already discussed few of the examples where we saw that you could compare some financial information, financial, non-financial information, and we could establish a relationship. Like we spoke about the ratios, we spoke about trend analysis, we learned about the reasonableness check. So all of these will enable you to develop a relationship, and with this relationship, you will be able to understand if there is something unreasonable, if there is something which is unusual. In that case, it will derive the auditor's attention to that particular area because that would indicate a risk of material misstatement. Now, analytical procedures could be adopted, and this can be done in the multiple ways. Like we could do the comparison with the current year with the previous year's figures. We could do the comparison with the anticipated results, that is the budget, the forecast, or sometimes the expectations created by the auditor in his mind. Or you could also do the industry standards. That means you could take the information from the industry, that is a similar line of business, and you could do the comparison there. Like we had done the example of a gross profit margin, where what we did, we had taken the client's information and we compared with the similar businesses in that industry. And we saw what would be the increase or the average increase of gross margin in every kind of business. And there we could do some kind of comparison and understand whether what is reported by the client, whether it is acceptable or not acceptable. Now, when you do a comparison or when you establish relationship, you could do it both financial data or financial and non-financial data. We have studied what you mean by the comparison, but just for your proper understanding, when you talk about financial comparison with another financial information, both of this comes from the financial statement itself. Like for example, when we do the net profit ratio, so the net profit also we get it from the financial statement, the sales also we get it from the financial statement. So when you do a comparison or when you establish a relationship like this, all the data that you require will be available through the financial statements. Sometime you could develop a relationship between the financial and non-financial information. What would that be? Like the classic example was about the salary verification. So when we did the vouching of salary account or when we were checking the salaries in detail, and there the analytical procedures that we adopted, they were with regard to comparison of financial and non-financial data. What was non-financial? The number of employees. Number of employees are never given in the financial statement. So obviously that is not a financial information. We categorize it as non-financial information. So number of employees, when you are going to multiply with the average salary which is payable to them and the answer that you get, that would be also a relationship that you have created, and this you compare with the data that is available with you. Alright. So this is the comparison that is possible, financial or financial and non-financial data. So this was about understanding regarding what is meant by analytical procedure. Understand one thing very importantly, analytical procedures are not going to give you sufficient appropriate audit evidence. They are going to give you a direction to get what? Sufficient and appropriate audit evidences. That means these are going to give you an indication. It is going to drive the force of the auditor or the attention of the auditor to the areas where he could not get into in the ordinary course of audit. So the other procedures when you are adopting, you could not understand about the unreasonableness regarding some kind of suspicion, some kind of doubt or some kind of fraud risk factors. But when you perform these procedures, these will enable you to understand some kind of the elements which are present which would drive the attention of the auditor. Now, analytical procedures, the standard gives two objectives to the auditor. First, it is telling the auditor has to obtain relevant and reliable audit evidences by using the substantive audit analytical procedures. Second, it tells that you have to perform the analytical procedures at the end of the audit in order to come to a conclusion that what you have understood about the entity and what the financial statement is reporting is actually matching or not. So these are the two objectives. So for the first one, we need to understand, first of all, we need to understand why are we using the word substantive analytical procedure and the word analytical procedure. First, we need to know that why are we referring to the words substantive analytical procedures and the next one, that is analytical procedures alone. Basically what happens is, in the planning stage, when you are planning to perform these kind of relationship construction or maybe establishment of some kind of comparison, this we call it to be analytical procedures. But as a part of performance of the audit, when you are performing the substantive procedures, and at that period of time when you apply the analytical procedures, we call them to be SAP, that is substantive analytical procedures. No major difference in the meaning, but it is depending upon the location or the place where you are adopting it. If it is planning, we call it analytical. If you're using it in the performance stage, we call it to be substantive analytical procedures. That's it. Otherwise, the meaning by the very word itself does not have any change. Alright, now we need to understand analytical procedures are performed at all the three stages of audit. The first stage is about the planning, second is performing, third is concluding the audit. So while you're doing the risk assessment by understanding the entity and the environment, at that time analytical procedures will become one of your risk assessment procedures. This will enable the auditor to design the nature, timing and extent of the audit procedures to be adopted. So when you do a comparison, when you try to study the trend of the information that is available, you will be able to understand which would be the possible area of risk, where have we to concentrate more of your attention there. So this will happen at the planning stage. So at planning also we will perform what? Analytical procedures. Why? To understand how much audit procedures do we have to perform. What kind of audit procedures should we perform? So the NTE of the audit procedures. To decide that, we are going to use the analytical procedures. Then, when it comes to performance, obviously we are going to perform analytical procedures to obtain what? Sufficient appropriate audit evidences. For us to identify if there is a material misstatement. For us to come to a conclusion whether the particular items are misstated or not. This will give an understanding to the auditor whether it is required for him to perform test of details or not. For example, if one of the components, like we have used one of the components and we have performed analytical procedure on that, then if the analytical procedures give us some kind of unreasonable fluctuation, like for example purchases. So when you are checking purchases and when you created some kind of relationship or you saw the trend of the past years, you realized there is some kind of unreasonable or unusual fluctuation. So here now you realize that purchases now have to be checked in detail. So this will enable the auditor to decide how much of substantive procedures, that is test of details, he has to adopt. And finally, at the conclusion stage. Why at the conclusion stage? Very simple. We have performed the audit by adopting n number of audit procedures. So we have inspected certain documents, we have inquired about something, we have obtained external confirmations. So like that we have the conclusion ready with us. But these are all the routine course of the activities that we perform. What analytical procedures are going to help you with us? What you could not understand with the routine course of your activity, you will be able to analyze with the analytical procedures. So maybe when you were checking the debtors and when you were doing the comparison, alright, so that time when you were doing the the verification of the debtors, in the ordinary course of your audit or in the routine checking what you were doing, you saw everything was perfectly alright. But then you decided, let me perform some kind of analytical procedure. On what? Debtors. So maybe you compared the previous 3-4 years debtors and saw what was the approximate amount appearing. Or maybe you compared with the provisions and the debtors you compared. Or maybe you saw the sales and the debtors comparison you did. With that you realized there is something which is very much different in this particular year when compared to the previous years. Or maybe when the relationship that I am trying to establish is not matching, it is not giving me a sensible answer. Alright. So in this case what happens is, you realize that when you calculated the debtors, it was all possible, it was all correct. So when you did the routine verification, everything seemed alright. But now when you did the comparison or when you established a relationship, you realized that there is something which I have to check even more in detail. So what happened? The evidence that you obtained usually while performing the audit now is contradicting with the analytical procedure you performed. So this, what you performed at the end of the audit, enabled the auditor to understand, is there any inconsistency that he could come across while performing or comparing the evidences that he obtained during the regular course and during the analytical procedures. So this comparison actually should match. If it is matching, we end up giving the opinion. But if it is not matching, then there is a doubt in the mind of auditor. My audit is still not over. I still have to do some more checking, some more additional procedures, some more investigation. So this is what the analytical procedures will help you when you perform it at the stage of conclusion as well. So we do it where? Planning, performance as well as in the concluding stage. Now, the main part of the standard, that is the audit procedure. How do we adopt the analytical procedures? We understood what, we understood where, but now we need to understand how. How do we perform the analytical procedures? So this standard categorizes this procedure in 4 stages. The first stage it talks about is determining whether analytical procedure is actually suitable on the component that we are checking. Like for example, suppose if we are checking about the liability and we want to verify whether the organization is really having the obligation on this liability. This here analytical procedure not useful. But suppose you want to check regarding the valuation, regarding the completeness, your analytical procedure would be useful. So we have already studied the different elements through which you would be able to understand whether analytical procedures would be suitable or not suitable. Like for example, for balance sheet items, they are not suitable. P&L account items, they are suitable. For those which are recurring in nature like sales, purchases, analytical procedures will be suitable. Non-recurring, extraordinary expenses, not suitable. Similarly, we have studied the other transactions and we have done a detailed discussion where you have come across multiple factors that we take into account for us to understand whether analytical procedure is suitable here or not suitable here. Then, second, after understanding that, we will then see whether the data that we require for comparison or for establishing the relationship, whether that data is reliable or not. And to evaluate the reliability, obviously we are going to check the source of it, from where it is coming up, right? Then we will be understanding whether it is comparable. Then we'll see whether a comparable data is available. Then we will also understand whether the controls over this data, that is the people who are maintaining the data, making the data, reviewing the data, are they all doing their work correctly or not? So whether there is adequate control over this data. If all of this is present, then we will decide to use the data which is available for the purpose of developing a relationship or for creating some kind of comparison. Third stage is that the auditor will now develop an expectation in his mind. Obviously, we are doing some comparison. Comparison with what will you do? You have the information available with the client, so that you have in hand. This you have to compare with something, right? So this expectation the auditor has to create. So as to pre-decide what is as per his professional judgment should be the amount. Now this obviously will be a calculated figure by some kind of professional judgment, some kind of calculation which the auditor will do. And he will come to an expected value. This expected value and the information that we have in hand, we will do the comparison. And in the fourth stage, after the comparison, if there is any kind of difference arising, we will then investigate it further. If there is no difference arising, or if there is a difference which is acceptable, then in that case, we will decide not to perform on that component the substantive procedure which is the test of detail. So you don't have to go again in detail, check each and every transaction, do the vouching, do all of that is not required. We could rely on the analytical procedure performed. But suppose if they don't match, then in that case, we cannot rely on that data and we need to investigate the matter in detail. So these are the procedures that you are going to adopt for the purpose of performing the AP, that is analytical procedure. Which are the 4 steps? First, we need to determine whether analytical procedure is suitable or not suitable. Second, if it is suitable, we have the corresponding data. Is the data reliable? Then the auditor will create an expectation in his mind, that is a reasonable expected amount or maybe a ratio in his mind. Fourth, the second one and the third needs to be compared. If it is matching, we are okay with it. If it does not match, we will then understand it is an indicator of a risk of material misstatement or a push to the auditor that at this area you need to perform substantive procedures, that is an additional audit procedures. Clear? So this is the audit procedure that we adopt. Now, after performing the audit procedures, we need to understand what will happen if what is expected by the auditor and what answer we get. If these are not matching, then in that case, what is the auditor supposed to do? Here now the auditor has to investigate on this matter. How will you investigate? 2 possibilities. First, you will be obviously extending your nature, timing and extent of the audit procedures. You will be performing additional audit procedure. 2 ways. One, you inquire with the management. The management will give you a response, and this I have given you the example of the casual laborers. where you will understand that the management is going to give you some kind of response, but that response we cannot simply rely upon. We have to perform additional audit procedure just to check what the management is telling and what they have done is actually matching or not. Correct? Second, you inquired with the management, but management is in no position to give you an answer, or the management is simply escaping from your question. So in that case also, you have to perform additional audit procedures and come to a conclusion regarding what is the reason behind this kind of unreasonable fluctuation. After all this, if you get a negative answer, obviously we'll go in for modification. If the answer is resolved, then obviously this would not be what? A kind of modification that we would require, right? So this is when things do not match. And now the second objective of the standard, which talks about analytical procedures have to be performed at the end of the audit. This I have explained you in detail, giving you an example that there is a possibility that what you are going to conclude upon and then suddenly you perform an audit procedure, which is analytical procedure. If they are not matching, then in that case it will investigate, or the auditor will have to extend his audit procedure, and he cannot conclude or cannot give an opinion. Here he will have to extend the audit procedures, increase the nature, timing and extent of the audit procedures, and only then he will be able to conclude. There is a possibility that there could be a contradicting audit evidences. There could be a possibility there is inconsistency in what you have formed or what you have obtained during the performance and what the analytical procedures are telling you. So in that way, just to come to a proper conclusion, to be able to give a reasonable assurance, this standard requires the auditor to perform the analytical procedures at the end of the audit. Now further, we need to now understand the methods or the techniques that we will be using for the purpose of applying the analytical procedures. We have four, that is, one is the trends, second is we talk about is ratio, third we talk about is reasonableness check, and fourth we talk about the modeling tools. Alright, now analytical procedures will be quite simple also in application, or you could have complex also. Alright, so based on that we have four different techniques that we could study about. First one is trend, which is quite simple to understand, where we take some years together and we do a comparison to establish some kind of relationship between them. So this kind of trend analysis when we do, if there is a sudden shift or there is a sudden downward shift or upward shifts, then we will be able to understand something unusual has happened. So this would be an indicator for the auditor to divert or to focus his attention upon. So first is trend. Second we talk about is regarding the ratio analysis, which we all must be knowing very simple, or we all study this also as a part of our syllabus itself, where we establish relationship in the form of ratios. Like there could be gross profit ratio, net profit ratio, then you have the inventory turnover ratios, where we do comparison between the financial data available with us. This will enable the auditor to understand if there is some kind of unreasonableness or if there is any unusual thing which is happening. Because ratios have to be reasonable enough, it should be satisfactory to the auditor. Then, third we talk about is the reasonableness check, very simple to understand. Your comparison will be done with the current year figures itself. Like for example, if suppose we have a interest bearing obligation, like a loan amount is appearing on the liability side, and we know that the rate of interest is 6%. So obviously we are going to calculate 6% of the liability, and that should be the interest amount for the period. But this is not matching. So here you realize that reasonably 6% of 10 lakh should have been so much, but it is not matching. So here you will be able to do some kind of reasonableness check, and this would enable the auditor to understand something is going wrong, or something needs to be inquired about, or there is a scope of misstatement, or there could be an indicator of fraud. So this the auditor will be able to understand by doing the reasonableness check. And then the fourth one is even more complex. When you enter into the practical life, when you start auditing in the practical scenario, you will come across these modeling tools. Like they are going to be statistical tools, they will be using some kind of scientific logic, and through that we will do some kind of study by creating a relationship between the data available with us. So like we have simulation, we have like linear equations, we also have some kind of statistical tools. Okay, we have softwares today in place. So all of this will enable the auditor to understand what is the reason for him to enhance the audit procedures. So all of these are the techniques used by the auditor. Now, To conclude with this standard, there is one important point you need to understand. Analytical procedures, as I already discussed, will not be suitable every time. That is with respect to every component. But you need to understand, analytical procedures could also not be suitable to every organization. Like for example, if you talk about a non-profit organization, that is non-business entities, or you talk about maybe about government sectors, that is public sectors. These entities, there is very less relationship between the expenditure and the income that they have. So the relationship or the kind of connect that you have between these two amounts is not always going to make some sense, because there is going to be unreasonable shift in the amounts. There is going to be lack of a connection between these amounts. So usually you will not be able to have an interlink or develop a relationship. So when you do the audit of NPOs, or when you do the audit of public sector, basically the government entities, where there is basically minimum, or you could say no correlation between the incomes and expenditures, so in that case analytical procedures would be of no use. So here you need to understand, it is important for you to know at what location it is important, or at what point you need to use the analytical procedures. So already in the standard we discussed about the components where AP may be used or not used. Like I told you, P&L account you can use, but balance sheet you usually cannot use the analytical procedures. On the similar lines, every business also analytical procedure would not be usable. Alright. So one of the examples for you to remember would be the non-business entities or the government sectors. Your analytical procedure is not an ideal procedure to be adopted by the auditor while performing his audit. So with this, we conclude Essay 520, Analytical Procedures. Extremely important for the examination, purely conceptual, and this has a real practical application in your life. With this, we close Essay 520. With this, it is now time for us to understand the summary of this particular standard. This summarized approach will enable you to get a proper framework again of the entire standard. So audit sampling is basically a technique adopted by the auditor where he will be giving opinion by doing the audit procedures on less than 100% of the transactions. So out of all the lakhs and thousands of transactions happening in the organization, given the limitation and the time and cost, the inherent limitations that we have, we will not be able to check all of them in detail, because of which we resort to something which is called as audit sampling, where we will pick up a few and we will give a result on the all. This concept is called as audit sampling. In audit sampling, some particular areas it is suitable, some it is not. Like all the risky elements, like where the related parties are involved, like for example bank reconciliation statement, a control like that, these places we will not consider a lot of usage of sampling because we believe in checking everything in detail. But on the contrary, when it comes to routine transactions which are kind of regularly happening, like purchase, sales, the bank transactions, the payments, the salaries, etc., which will happen on the routine courses, here we will resort to something which is called as sampling, where checking a few, we will give the conclusion on the total. Then, we understood the approach of sampling, which are two. One is statistical, other is non-statistical. Non-statistical is the traditional approach where the auditor will not use any kind of statistical devices, no mathematical calculation. Purely the judgment of the auditor, the professional understanding or the experience of the auditor that will enable him to choose the sample. But it has its own merits and demerits. Merits very simple to operate. But complexity is with the disadvantage of it. That is, there is going to be a bias of the auditor. There could be a possibility that he ends up choosing like items and all the others which did not get a chance of getting selected as per of his professional judgment would be ignored, and there could be a scope of misstatement. Correct? So basically it is purely based on the judgment of the auditor. So every item could not get an equal chance of getting selected. Correct? Then, moving on to the statistical sampling, here we are going to use statistical techniques. Here we are going to use mathematical calculation, the probability theories, a very scientific approach where every item in the population will get an equal chance of getting selected. The importance of this is very scientific, no personal bias, and every item will without any biasness have a chance of getting selected. On the contrary, it is difficult to perform, difficult to use, complicated for its approach. Right? So you require a proper knowledge to apply these things, only then statistical sampling is possible. But in today's world, we move in only with statistical sampling. Very rarely we see that there is a non-statistical sampling happening. Then, moving on to the next concept about sampling risk. A risk where the auditor will end up giving a wrong opinion only because of the reason of choosing a wrong sample. That means the sample that he chose has not proved to be the true representative of the population, and he understands that if the audit procedures which he has applied on the sample, if the same he would have applied on the population, the answer would be different. Correct? So this is sampling risk. We have two types of sampling risk. One, when we apply the sampling on test of control. Second, when we apply the sampling technique on the test of detail. In test of control, we say under-reliance and over-reliance. When you talk about over-reliance, you are placing more emphasis or more faith on the control than the actual ones. That means you believe the control to be very strong, wherein in fact, the controls are not very strong. Here you place over-reliance. Here you will reduce your substantive audit procedures and you would end up giving a wrong opinion. Correct? On the contrary, when you are placing under-reliance, you believe the controls are weak, whereas in reality, the controls are strong. Because of which, your substantive procedures will be large, more number of transactions you will check. This usually does not take to an erroneous conclusion, but obviously the workload on the auditor will increase, the efficiency will get affected. When it comes to test of details, we talk about incorrect acceptance or incorrect rejection. Incorrect rejection as in, you have rejected telling that there are misstatements, but whereas in fact, there are no misstatements. Correct? Here, your efficiency again will get hampered and you will perform more audit procedures. You will not end up giving erroneous conclusion, but your efficiency will get affected. Incorrect acceptance is where misstatements you have identified and you believe the population is misstated, whereas in fact, they do not have the misstatements. Correct? So this is going to be where you would end up either giving, in case of test of details, you would talk about incorrect acceptance or incorrect rejection. What is incorrect acceptance? That means what happened here is, you are believing that the transactions are actually correct, whereas in fact they are not. Okay? So you are accepting with a few selected samples that there are no misstatements, whereas in fact there are misstatements. Correct? This will end up giving an erroneous opinion and the audit report could be erroneous. Whereas incorrect rejection is where the transactions that you are checking have been chosen to be all manipulated or misstated. Based on those, you are telling that things are wrong. Whereas in fact, in the population, misstatements are not there. Because of this, what you do is, you will extend the sample size, you will check more of detailed checking you will do, where your efficiency will get affected, but obviously you will not end up giving a wrong opinion. So these are the ways in which the sampling risk will get affected. Correct? Now, what is non-sampling risk? Non-sampling risk is where mistake has happened, error is there, opinion is wrong, but not because of choosing a wrong sample. There could be other reason, like there could be audit procedure applied is wrong, interpretation of evidence has gone wrong. Okay, so there could be a reason other than what? The sampling. Okay, that's called as the non-sampling risk. Then we came across two different words, tolerable error, expected error. Expected error is that error in the sample which the auditor is ready to accept. Up till then, he will not have any kind of adjustments to be made in the financial statements, nor requires to change his opinion. Tolerable error is an error above the expected error, up to which the auditor is still able to bear the misstatement. So over and above the expected error, even up to certain level, the auditor is ready to accept. That we call as tolerable. Up to that limit, we are going to tolerate. That means what? Till that level in the sample, if the misstatements are identified, we are not going to project it on the population. Up to that, we will accept it. We have no problem with it. We are not going to say the population is having a misstatement. But if it is crossing that level, then this will have a projection on the population and we will consider the population to be misstated. Similarly comes the rate of deviation, where up to a particular level you are okay, which is called as expected. A little above that is tolerable, but over and above that it will have an impact on your deriving the population result or your deriving conclusion on the population. So up to the limit of your tolerable error, this will have no impact on the population. This is something similar to that of performance materiality, because this is the rate which is fixed lower than the actual materiality level. So if we consider the main population, this would be material, we would bring it little down, and some of the immaterial items will be checking, and if those total should not cross that limit. So something which we consider it to be what? Individually they could not be material, but collectively when we put together, we will fix up a level up to which we will be okay with it. And if it is above that, this immaterial items individually also could become what? Material. Correct? So this is tolerable as connected to what? Performance materiality. Then moving on to the next one, we talk about the sample selection methods. So there we spoke about random sample, which is having simple and stratified. Then we have a systematic sample where we have to give an interval. Then we have a monetary unit where we stratify the data based on the monetary values. Then we have haphazard where usually we don't have any kind of procedural aspect or any kind of proper understanding. But yes, it is still statistical because there is going to be equal chance of getting selected. In reality, we don't use it. And then you have the cluster selection where the entire population is divided into clusters. Using random numbers, we choose a cluster and then all the items of the cluster which I can detail. So that is called as what? A cluster selection. So these are the methods of selecting the sample that we come across. Then the way we apply the audit procedure will be, we will decide a particular audit procedure on the particular samples. When we start applying the audit procedures, if you come across a particular sample where the procedure cannot be applied, you replace the particular sample. And suppose if you come across a particular sample while doing the audit on which the procedure cannot be adopted because of maybe the lost data which is corroborative to it, then in that case you will perform alternative audit procedure. Correct? This is the way where you replace or you perform alternative procedure in order for the performance of the audit. After doing all that, you will then project the result of the sample on the population. But while you project the information from the sample to the population, you have to give due regard to the anomaly in the population or the sample. Anomaly is the representative or not the true representative of the population. It is only one of its kind, a non-recurring item, something which is unique, something which has a different characteristic. This is a different item which is not similar to the population or the majority of the population. So when you're projecting it, you will consider it separately. So the non-anomalous transactions and the anomaly will be considered separately, and together we are going to project the misstatements on the population. This will purely be giving regard to the tolerable errors. So if it is crossing the tolerable level of misstatement, then it is going to impact the financial statements, that is the population as the whole. And if it does not cross the tolerable limit, then that will have no impact on the population. This is the way in which the audit procedures will be performed. Now, one very important point is, suppose the auditor is concluding that sampling is not giving him the reasonable assurance that he requires, then whatever misstatements he has identified by performing the sampling procedure, this he will inform to the management, ask them to investigate the matter, ask them to check if there is any further kind of traces for similar misstatements to happen in the overall population and do the required adjustments. If that he will do it, along with that what he will do is, he has to extend the nature, timing and extent of his further audit procedures. He could increase the number of sample size, or he could perform alternative procedures. Substantive procedures could be different. So he would modify the planned audit procedures, and in that way he would try to obtain an assurance. Understand, anyway, without obtaining a reasonable assurance, without obtaining sufficient appropriate audit evidences, you can never give conclusions on the financial statement. One very important point you need to understand: size of the sample should be selected appropriately. Sample design very properly taken care of. The population from where you are going to choose the sample should be appropriately decided by you. The population, if it is correct, the sample will be correct. So based on what you are checking, corresponding population has to be correct. Then sample size should be such that the overall risk is brought down to the acceptable lower level. Choose such a method where every item is getting an equal chance of getting selected. Whenever you identify a misstatement, just do not project it further. You need to understand the reason for the misstatement, the nature of the kind of deviation that has happened. This would be sometime an indicator of some of the common features. These common features will enable you to do a detailed checking to obtain a proper reasonable assurance for you to perform your audit even more effectively. So if you identify a misstatement's common feature to be a timeline, then you will realize at this point in time the misstatements have happened. So in that point of time, all the other transactions also you will check in detail. This will enable the auditor to obtain a reasonable assurance, and then he'll be in a position to give an opinion on the financial statements. So with this, we understand and we close the entire standard SA 530 audit sampling. Having understood SA 550 in detail, it is now time for us to get the summarized approach of the standard. So let us get a very simple way of understanding it. SA 550, as I told you, talks about related parties. Related party transactions are something very normal in the regular course of business. We come across the related party transactions. So they are not something completely wrong. Only thing is that when there is going to be a related party transaction or there is going to be a related party, it is only subjected to a higher risk of material misstatement. So this becomes a significant area of risk, because of which the auditor has to be extra alert and have to be more careful about these relationships. So this standard basically gives a responsibility on the auditor that he has to check whether all the related parties have been disclosed, have been identified and accounted correctly as per the applicable financial reporting framework. More importantly, because if this is not done, then your financial statements will not give a true and fair view. They will happen to be misleading. Because of which, it becomes very important for us to identify, account and disclose all the related party relationship as well as the transactions which have been entered. Otherwise, RP is something very regular in businesses, and basically we have the RP transactions only because, or RP relationship we try to develop with somebody only because we want to have some kind of connection or transactions with them. Otherwise, what would be the purpose for creating relationships like that? Got it? So there is very clear that there are going to be business relationships like that. But here, the risk element will be high, so we need to be more and more alert. The regular terms of the business that we have, regularity of transactions which are there, may not be similar for RP. Like for RP, some of the transactions would be even without consideration. Got it? So there could be possibility of something which is unusual, something which is not regular in the case of ordinary business transactions which become applicable to the related parties. So this becomes an area where risk is involved and the higher area of risk. So the auditor has to be more alert and keep his mind professionally alert, that is skepticism has to be there for the purpose of identifying and checking whether all the RB transactions have been properly disclosed by the management or not. Because ultimately, accounting standards are for whom? The management, for the preparation of financial statements. So AS 18, whether it is followed properly or not, is the responsibility of the management. So the auditor is simply responsible to check whether the management has performed their duties correctly with respect to the presentation and the disclosure of the related parties. This standard first gives the introduction of what we mean by the term related party. It gives in a very simple understanding. If the FRF talks about what could be a related party for a particular entity, pick up as it is. For example, AS 18 related party disclosures talks about a related party. So when they are defining, we are going to consider them to be the related party for the client that we are auditing. But suppose if the FRF is not giving any information or a very minimal information, then this standard is giving you a guidance. The standard says, if your client is controlled by somebody or some other entity with the help of some supporting entities in between, intermediaries, then these will become your related parties. If your client is controlling another entity, then that entity will become the related party. Or if two entities have a common control, if they have a common ownership structure, or maybe they are close family relatives, then in that case, they also will be called as related parties. But very obviously, it gives an exception where there is a common control by the government. If the government controlled companies, if you look at them, all of them are controlled by the government, does not become related parties. Because if that is the situation, then our audit will be never ending. You have to assess all of them, correct? So because of which they very clearly given the standard that those which are controlled by the government, only because of control, we will not consider them to be related party. They would become related parties only if they are actually having some kind of exchange of resource amongst themselves. If that is the scenario, these two entities or two governmental controlled organizations will be considered to be related party. So here, as I told you, it is an area of highest risk. So the risk is going to be very, very high. So the first thing that the auditor will do is the risk assessment. So the risk assessment procedures which are given here would be something connected to SA 315 and also we take into account 240 because where related parties involved, there is going to be a possibility of fraud. So this is an area where there could be fraud involved, an indicator of fraud is also there. So we are going to take into consideration the assessment of risk as per 315 and also evaluating the same taking into account SA 240 if it is an indication of fraud to be present. So what are the procedures to be performed by the auditor to assess the risk with the related parties? So we did basically three. First, understand the entities, related party transactions, relationships. Maintain alertness as and when you do the audit for recording of the inspecting the documents, records, etc. And third, wherever you see that there are fraud risk factors, you have to be alert in those situations to analyze if they are frauds. When you do about understanding the entities RP transactions, you will talk about them to the management, question the management about who all are the related parties. Is there any change of the related parties from the last year to the current year? What is the relationship that you have with them? Did you enter into contract with them in the current year? Then you get an understanding of whether they have appropriately identified, disclosed and accounted for correctly. Do they have proper controls in place for approval, for authorization of these controls, for these kind of transactions? All of these you are going to inquire with the management and understand what are the related parties, their nature and how is the accounting done. Second, you are going to be very alert, professionally skeptic when you look into the records, the documents, everything. So you come across a loan agreement, a sale document, when you see there is a sale of asset that is happening. Okay, so when you are looking at the document, look whom are you selling the asset to? Is this asset going to a related party? So you will do a proper checking of every kind of document which you are coming across to ensure is it with a related party, is it indicating that there is related party involved. If it is so, it is an area of risk where you are going to do the assessment in detail. Okay, this we call it to be something which is outside the normal course of the business. Because if you are a trader or if you are a manufacturer, selling of asset is something which is outside the ambit, correct? So this if you are happening, then you will see whether this transaction is involving related party. If it is so, you are going to see whether, why, how, everything. Got it? So your documentations involved could be the income tax returns, it could be some loan agreements, it could be some intercorporate loans, okay? There could be some agreements, contracts entered into, okay? So these are all the transactions or the agreements that you could have a record to, access to, or maybe shareholders records, the register of the shareholder, the minutes of the meeting. All of these will give you some kind of indication if there is a transaction or is there any kind of relationship existing or something like that. Okay, you would also have access to the board meetings and all, which will give you some kind of idea, is there any kind of related party existing, correct? So these all information, records, documents, when you are going to check, you have to keep your mind very alert for any kind of information which will indicate, this is with related party or this is with related party. So you should come across situations or circumstances which is indicating related party is involved, correct? Then third, you will see if there is a fraud risk indicator. Usually this happens where you see that the major control of the company is going in the hand of one person or a group of people, a small group of people is controlling everything in the organization. So basically, like suppose a particular entity has taken a particular decision, but they are saying this particular decision can be taken forthwith only if it is approved by the related party. So here we see related parties involved. If the party is approving which is for the benefit of the organization, something is acceptable. But if they reject, then there should be an understanding for it, right? Sometimes their personal interest would be involved. There could be some kind of manipulation happening. So you should be alert where in the organization, when there is a group of people who is controlling or having a dominant influence, there could be a possibility that everything has been done of a particular contract. But the contract is only not getting executed because the RP is telling, no, we do not want it. Or the related party is coming up with a proposal and without any discussion the proposal is getting approved, or very little discussion in the organization and the proposal is approved only because it is coming from related party. So here you see that when such things are happening, some doubt is there, because when RP is telling something and it is happening very easily like that, they are having a dominance, and when things are happening just the way they want, there could be some fraud involved. Somewhere it is happening in the personal interest also. So where is the money going? What is the reason for this? All of this we need to try to understand, because these are the indicators of fraud. Correct? Then, after doing the risk assessment, we will then move in for whatever risk we identified as a part of risk assessment, how are we going to assess it? How are we going to respond to it? Correct? So in that case, first risk that we could come across would be where when you discussed with the management did not give you information about some related parties. This could be for two reasons: inherent limitation. One, management didn't know. Second, management knew but they're hiding. Both are possible. So in that case, if the auditor comes across a situation like this, that he comes across a related party which was not told to him when he was doing his risk assessment, and now he comes across. In that case, he will inquire with the management why about this, and then ask the management to record it. Also see whether why is the control failed. See whether any other matter like this comes across. If this is an indication that it was intentionally omitted to be told, then you will understand, is there a risk involved here? Understand, whenever like this you come to know, immediately, promptly communicate to your engagement team members. Tell them that look, something like this we have identified, you now be alert. Got it? Then, second risk could be a risk where you have identified something which is outside your course. That means the normal course of your activity does not involve a transaction like this. In that case, you now as an auditor will now become more alert. So you would then question why such kind of transaction, what is the reason, what is the rationale behind it? Is it done for some kind of fraudulent reporting, just to manipulate the figures? Are you trying to misappropriate the asset? Are you trying to do some kind of manipulation? What is the reason? Is it prejudicial to the interest? Then understand that whatever management is explaining and what has really happened, is it consistent or not? Most importantly, you did this agreed. Did you disclose it in the financial statements? That you will check. Also understand, when something is beyond the normal course, there has to be proper control over it. So you should see whether these transactions are properly authorized, properly approved. That means suppose if these transactions require the approval of 3 people, maybe senior manager, maybe a board of director and also the chairperson, then all of these 3 things approvals have to happen. Chairperson usually don't consider, the managing director maybe. So these 3 you have to take the approval. These approvals, authorizations, whether really they have been taken or not, for these kind of transactions you have to check. Obtain sufficient appropriate evidence. Correct? Then, third, we will see whether when the management is giving an assertion that look, we have valued the related parties or we have recorded the related parties or enter the transaction with the RP at arm's length price, then okay, you have told us we agree, but we will check it. We will obtain sufficient appropriate evidence that the transactions with the related parties have happened at the arm's length price or not. Correct? This assertion we have to validate. What is ALP? The way I am going to deal with an outsider. What transaction amount will I have with the outsider? The same should be with you. Okay, as a related party. That price we call it to be arm's length price. Unrelated buyer, unrelated seller. When they are entering into a contract, the price that they will exchange for mutual benefit of both, that we call it to be an ALP. Got it? So related parties have to happen at arm's length price, and whether it has happened or not, the auditor will obtain sufficient appropriate audit evidence for the same. Got it? So this is the way in which we are going to respond. Then last we talk about is, if suppose all the TCWGs are not involved in the management, then you will communicate with the TCWG about any significant risk that you came across with the related party. Moreover, documentation, very simple, only 2 things. You will talk about first, name of all the related parties identified and the nature of transactions that you have entered with the related party. So with this, I am sure you must have clearly understood regarding the related parties. So the doubt that you had in between, or maybe an understanding that you had in between in the beginning, where you thought related party means wrong or related party danger, cannot be done. So that is wrong. Related party transactions can be entered, related party relationship can be established, Only thing is the auditor has to check that whether they have been disclosed, accounted, identified appropriately as required by the applicable financial reporting framework. So with this, we have understood and completed SA 550 in detail. Related party, which I told you is extremely important for the examination point of view. Having understood SA 560 in detail, it is now time for us to get a summarized view of the standard, and this will enable you to get the flow of the standard more correctly and the understanding will be very, very clear. Okay, now SA 560 subsequent event. The very word subsequent means something that is happening afterwards. So the information available to us as the auditor for the purpose of doing the audit is up to 31st of March. So something happening after 31st of March, we will be calling it to be what? Subsequent event. Correct? Now, there is always very important understanding that you should know why is there any particular standard. When SA 560 is giving a responsibility on the auditor, obviously it is about checking something what the management is supposed to do. Because management is going to prepare the financial statements and we are going to recheck it. Correct? So when something is asked for me to recheck, about what have I to check? So that is given by the accounting standard 4. And accounting standards are to be followed by the management in the preparation and presentation of the financial statement. So AS4 talks about the events which are occurring after the balance sheet date, which is nothing but the subsequent event. So AS4 when gives you the understanding of an adjusting and non-adjusting event, management is required to identify the subsequent events, all the events which are happening after the balance sheet date. Some of them would be requiring an adjusting in the books of accounts. Some of them simply requires a disclosure. So they have to do the changes in the presentations and the disclosure requirement. So when management is given the responsibility of doing this in the preparation of financial statement, SA 560 is giving responsibility on the auditor. Look auditor, what the management is supposed to do is what you have to see whether they have actually done it or not. So that responsibility about checking whether the events which have occurred after balance sheet date have been properly accounted for or disclosed by the management is what we check in SA 560. So 560 basically gives an understanding of a responsibility on the auditor to identify and respond to those subsequent events which have any impact on the financial statements of the year of which we are of the audit that we are conducting. Correct? Now, 3 important dates for our understanding is year ending 31st of March, date of audit report, and then we have the date on which the financial statements are issued to the members, that is the third parties. These 3 are the important dates of our discussion. This standard categorizes the subsequent events into 3. Those events which are going to happen after the balance sheet date but before the date of the audit report. Second, those events or those facts which have become known to the auditor after the date of the audit report but before the financial statements are issued. Third, those factors which the auditors come to know or the auditor comes to an understanding after the financial statements or the audit report is already issued to the third parties, that is the intended users. Correct? So we are going to study in 3 categories. So let us understand the first one, where it is between the date of the audit, the date of the financial statements and the date of the audit report. Basic idea is where our audit has been continued or where we are carrying out the audit. So at that point of time, we are required to perform procedures to obtain evidences that all the subsequent events have been identified. First identify, then we'll think whether to adjust or not to adjust. First we have to see whether all of that we have identified or not. How do we do that? What are the procedures? You will discuss with the management, understand their procedure for identifying the subsequent events. Inquire with them if they already have any knowledge of any subsequent event. Is there any adjusting event, non-adjusting event? Question them, inquire with them. Understand the minutes of the meeting to understand if there is any indication of any subsequent event. Study the interim financial statement if the management prepares any. That will also give you an idea of any information that is there. After doing all this, if suppose you come to a knowledge of yes, there is a subsequent event. So for example, I gave you of debtor, or maybe I gave you example of a lawsuit, okay, a legal case going on against you, where now actually there has been a clear-cut indication that you have lost the case. So you could check the minutes of the meeting which you have with the legal counsel. So the lawyer's meeting, there will be a minute corresponding to it. So that minute if you read, you will understand regarding the outcome of the legal case. So whether you lost or you won, based on that there could be an adjustment required in the financial statement. Subsequent event, right? It has happened after the balance sheet date. Or maybe there was an inventory which was stocked up with you. Okay, that on 31st March it was there. But then after maybe some 10-15 days, suddenly a fire took place and the entire inventory is destroyed. So understanding the situation, will think whether it has to be adjusted or only a disclosure would be required. So first you will see whether you are able to identify it or not. So first you identify all of them. After identifying, using the principles of AS4, you will decide whether adjustment required or not required. If required, tell the management or understand whether the management has actually disclosed that was adjusted or not. You perform procedures to see whether appropriate adjustment is made or not. If only disclosure is required, see whether management is appropriately disclosed or not. Correct? Very importantly, it is the responsibility of the management. And whenever there is a responsibility of the management, the best thing is to obtain written representation. So obtain a written representation from the management that they have disclosed, identified, adjusted all the subsequent events which are present. Correct? So that is about the first category. Second is where audit report given to the management, but management has still not released it. In that point, in this phase, a fact is known to the auditor. But auditor basically has no responsibility, because once the report is issued, your duty comes to an end. But suppose the auditor believes, no, this information if I would have known earlier, the report would have been different. So in that case, the auditor will perform certain procedures. What? Sit across the table with the management. Ask them what is happening. What is all this? Are you going to amend the financial statement? Is it required? If so, what will you do? Are you going to adjust? Are you going to disclose? Question it to the management. If the management says we are amending the financial statements, then you perform additional procedures regarding those amendments which they are making. Then you come up either with a fresh audit report, with an EOM or OM paragraph, telling very clearly the additional procedures are only with restricted amendments that have happened. Or you do dual dating. Do not come up with a fresh audit report. In the old audit report only, you add one more date. And in that date, you give an understanding that this date is restricted only to the procedures for the amendments which have happened in the financial statements. On the contrary, the situation is different. Amendment required. Adjustment or disclosure is required. Management says will not do. In that case, if you have still not given the report to the entity, by chance it is still with you, modify straight away. But suppose you already handed over, then tell the management, look, do not release it to the third parties. Do not issue this report to the third parties, because we don't justify it. Even after that, if they release, then you would take all the actions to make the people realize not to rely on that particular report. Okay, and you can also take legal actions. Okay, then third category is where already the financial statements have been issued. That means when you give the notice of the general meeting, that time only you give the financial statements, audit report, boards report, everything. So already the people have got the audit report with them, or maybe even if they have not got, it has been dispatched to them. Then the auditor comes to know something. Basically, we have no obligation to do anything about that information, but the auditor is with an opinion, this I would have known earlier, my report would have been different. Then in that case, again the same discussion with the management, if they are going to do the amendment, how will they do all of that. If they are doing the amendment, you will perform additional procedures, you will come with a fresh audit report, where you are going to give an indication in the emphasis of matter paragraph. You are going to give a reference to that note regarding which the amendment has happened. Correct? So suppose it is with respect to some debtor, then you are going to give an indication in the EOM paragraph that this is with reference to the debtor appearing in the financial statement. Okay? So this is what you are going to indicate. Alright? In the EOM paragraph very, very clearly. Also understand, this has already been issued to the public, to the intended users, to the third parties. By whom? The management. So management has to take all the steps to tell those people about the situation that has happened. Don't trust the management just like that. You also have to perform additional procedures to ensure management has done their duty correctly or not. Whether those people have already received the audit report, whether they have been intimated about the existing situation or not, you have to review this particular action of the management. Correct? So this is the basic idea of the SA 560, what the auditor will do, how he'll identify, and how is he going to respond to the subsequent events that are there. Now just to give you a little understanding or maybe a little more exposure, like for example, we could say that when we have a discussion with the management, what kind of subsequent events could be there? Like there could be a situation where, there could be a complete new commitment made by the management, a complete new contract, maybe a complete new law case being filed against the client, your client. Maybe they have a plan of merger. There could be an acquisition which they are planning. They are deciding to discontinue a particular operation. They are planning to sell off an undertaking. A particular product line they are discontinuing. Okay, or maybe there has been a catastrophe which has taken place. Okay, there has been a natural calamity. There has been some kind of loss. Okay, there has been an exorbitant, a huge sum of money which is going, there has been a probability of the outflow. There is some kind of a contingency which has occurred, which could give rise to a outflow which is major. Correct? So these are all examples for where, we consider them to be subsequent events. These required some kind of adjustments or disclosures in the financial statements. Understand, if the condition is existing as on the date of the financial statement and corresponding to that an event has happened, then you need to adjust the financial statement. The numbers will change. But suppose if the condition is not there as on the 31st March, but the event has happened later on, then only disclosure will be enough. Like inventory example I gave you. Inventory already there on 31st March. Very good inventory, all set proper. Did you know that time that after 20 days fire will take place? Natural calamity will happen. There would be floods where all the inventory will flow off. Any indication was there that time? No. So this was a condition which was not present as on 31st March. So these things where conditions were not present, their adjustment is not required. You simply give what? Disclosure, which we call it to be non-adjusting event. So based on that, the auditor will ensure whether the management has complied with the financial reporting framework appropriately or not. Because if they have not done it, then if adjustment has been not adjusted, if non-adjusted gets adjusted, that means financial statement is not giving a true and fair view, and this is what? Not going to give a proper opinion. So because of which, SA 560 gives the responsibility on the auditor. How is the auditor required to obtain an understanding or obtain sufficient appropriate evidence regarding the subsequent event being identified and responded appropriately. So with this, we have completed SA 570 going concern. Now having understood the entire standard in detail, let us now get a summarized approach for it so that the entire understanding now will fall in the proper flow. Alright, now SA 570 going concern talks about the concept of the fundamental accounting assumption of a going concern, where we say that the entity is going to continue for a foreseeable future. That means the management tells that we have no intention to liquidate our business, or there is no need for us to liquidate our business for the coming period of 12 months. So it is the management who is responsible for the preparation of the financial statements. It is they who have to adopt the going concern assumption. And if the going concern is not appropriate, it is they who are going to disclose the inappropriateness, or there are other events which are going to be existing. So disclosure requirement is also of the management. So the management has to conduct an assessment, which we call it to be preliminary assessment, which is conducted at a particular point of time, taking into account the nature of the business, the condition of the business, some uncertainties which are existing, okay, a judgment which is made by the management at a particular point of time, where the management will decide whether the going concern would be appropriate or inappropriate. So these going concern, once it is appropriate, you prepare the financial statements based on the going concern assumption, where you will record your assets and liabilities at the historical cost, where we believe it to be realizing in the normal course of business. On the contrary, when the management makes the assessment and the going concern happens to be inappropriate, we will record them at the realizable value. That is, the assets will be recorded at the realizable value and the liabilities will be recorded at the payment value. The auditor, with respect to going concern, is required to ensure or to obtain evidences that the management's assumption as to going concern whether it is appropriate or inappropriate. For this, the auditor will have to conduct as a part of his risk assessment procedure in standard Sep'25 regarding the risk assessment. As a part of it, he will do the assessment of the risk connected to the going concern, where he will be professionally skepticist, alert to every situation which he is going to encounter, which will cast a doubt on the entity's ability to continue. On the similar lines, two important assessments here you do as a part of your risk assessment procedure. First, if the management has a preliminary assessment conducted, inquire with the management, understand what the events they encountered and what are the mitigation plans or the action plans. On the next, if they do not have any of these things, that is preliminary assessment, ask them on what basis did they give the going concern assumption, and are there any events or circumstances which they are aware as of today which could cast a doubt on the entity's ability. Then whatever management does the assessment, based on that we are going to do the evaluation of this assessment. This evaluation we are going to take into consideration regarding the period covered by the management. If the period is less than 12 months, we will request the management to extend the period. And if there are any events which have happened after the period of assessment, we will take into account even that. Very simple, all the information which the auditor has already obtained, you will be very careful whether management has taken all these events into consideration while doing the assessment of the going concern. Then, suppose if finally the the auditor has come to a conclusion that there have been events and circumstances which are casting a doubt on the existence of the entity, and there is material uncertainty existing, okay, then you are going to adopt additional audit procedures to validate this matter. Because when there is material uncertainty existing connected to these events, then you need to ensure whether going concern is appropriate or inappropriate. So for that you are going to perform the additional procedures. Additional procedures would include, the first one is that if they have not conducted the preliminary assessment, that is the management, request the management, please conduct the preliminary assessment. Then you will talk about the future action plans which they have decided and check how realistic they are and how reliable they are. If they give you the future cash flow forecast, check the source data and how reliable these future cash flows are. Then, if they are talking about any event which has happened after the preliminary assessment, the auditor should also take into account what is the impact of those events which have happened after the preliminary assessment. On the last, very important, you need to obtain written representation from the management to confirm the matters regarding their future action plans, and that will the management actually do what they are telling the auditor. So we will obtain written representation, correct? Then, when there are material uncertainties existing, okay, then there are disclosures that the auditor has to check whether the management has done it correctly or not. So on the assessment, if you identify the events and conditions, and if there are material uncertainties also existing, then the auditor can consider the going concern to be appropriate. But two important disclosures have to be done by the management in the financial statements. First, adequately disclose about the principal events and the circumstances which is casting a doubt, like for example the negative cash flow. So here you will write about that event and circumstance which has casted a doubt, and what is the action plan of the management, how are they going to better off the situation, correct? Second, if there is a material uncertainty existing connected to that, disclose the same. Along with that, also tell the users that because of this there could be a possibility that we may not be able to realize the assets and pay off the liabilities in the normal course of business, correct? So this is very important disclosure. Suppose if only events are there and material uncertainty is not there, then you give adequate disclosure of the event in the financial statement, and how are you going to react to it, the management. If that is given, then also we consider going concern to be appropriate. Then we talk about is the reporting. If suppose going concern is inappropriate and the management is prepared on going concern, we simply give an adverse opinion. Second, going concern appropriate, material uncertainty present, adequate disclosure made, you give unmodified opinion, but then you would have a separate section in the audit report which is called as material uncertainties connected to going concern, where two important elements you will disclose. One, you will draw the attention of the user to that note in the financial statement which is talking about this matter, and you also give a very clear understanding that because of this matter, the entity would not be able to realize the asset and pay off the liability in the ordinary course of business. Correct? Second, if suppose there is significant event identified, material uncertainty present, management is not ready to disclose. In that case, what you will do? You will give adverse opinion or qualified opinion. But in the basis for the opinion paragraph, you are going to give the reason why you have given the qualification. What was the element or what was the event because of which there has been a qualification or the adverse opinion. Then, if suppose the management has not performed the assessment or you are requesting the extended assessment and the management is refusing, then you will decide what implication will this have on the audit report. Then, moving on, the next part of the standard talks about communication with TCWG. Unless all the TCWGs are in the management, obviously if everybody is in the management, what will you talk to the people who have done mistake? Correct? So, you will talk to only those TCWGs who are not the part of the management. About some important matters, you inform them about those events and circumstances which have casted a doubt, how uncertain they are, how significant they are, what is their nature, you talk about that. You tell whether the management has used the going concern assumption, whether it is appropriate or not. And finally, before giving any wordings or any opinion in the audit report, you will have a communication with them to discuss about this matter. One more point of discussion here is, while approving the financial statement, if there is a unnecessary delay caused by the management, you will inquire regarding the reason for this kind of delay. This reason could be one of the indicators going concern is coming under a question. So, in that case, the auditor will evaluate whether this delay is because of some kind of indication that there could be a circumstance or an event which could cast a doubt on the entity's ability. If the auditor concludes that, he will perform the additional procedures and come to a conclusion. This standard also talk about certain indicators which will help the auditor to understand that this could be significant event or the circumstance which would cast a doubt on the entity's ability, which we consider it to be financial, operating and others. In financial, I told you like the negative cash flow, persistent losses, okay, there could be like a cash crunch, bankruptcy situation, unable to pay off your liabilities, you have all your significant ratios in a negative manner. All of these are the indicators that there is something wrong at the financial level. Operating at the operating level, like you have the labor strikes, you have discontinued a particular operation, or maybe a key person of your organization is leaving and there is no substitute for him. Okay, or maybe a major supplier or a customer is not there, correct? So, these are operating indicators. Others could be any material facts like maybe there could be change in law or there could be some catastrophe or there could be any other thing which directly or indirectly is impacting significantly the continuation of the business. So, we classify them as financial, operating and the others. So, with this, we have successfully completed a very important concept, that is going concern SA 570. Here, we simply have to take home a point that management takes the assumptions, makes the assumption. It is the auditor who obtains the evidences to support the assumption made by the management with regard to the ability of the management to continue as the going concern or the ability of the entity to continue as a going concern. And going concern is like a foreseeable future, where we say that the entity is having no intention to liquidate for the coming 12 months, because we have studied it as a part of accounts and today as a part of audit, a very important concept for our understanding, that is the going concern. Now it is time for us to understand the standard in a summarized manner so that you get a proper flow of all the concepts in place. Okay, now written representation, that is 580, is one of the audit evidences which the auditor will obtain during the course of this audit. Since it is a 500 series, and I already told you, the 500 series talks about what is the audit evidence. Now, written representation is a written statement obtained by the auditor, from whom the appropriate level of the management for two things, either to confirm a particular matter or it will be given for the purpose of supporting other audit evidence which the auditor has already obtained. Written representation comes from the management and hence it cannot be considered to be 100% reliable, so we cannot consider it to be a sufficient appropriate audit evidence by itself. Though it is very necessary for the auditor to obtain a written representation we cannot call it to be a sufficient appropriate audit evidence by itself. Logic behind it is very simple because it comes from the people who are responsible for the preparation and the presentation of financial statements. So if they only give us an information about a particular matter, how far can you have a reliability on only that evidence to give an opinion on your financial statement? So written representation, we consider it to be a supporting audit evidence or a corroborative audit evidence with the other audit evidences which the auditor has obtained. Now, written representation will be addressed to the auditor and it will be on the letterhead of the client. This particular standard makes a proper clarification that though financial statements, books of accounts, records, vouchers, some public documents like prospectus, etc. are all prepared by the management alone and they are only responsible for preparing it, they will not be amounting to written representation. Because though they only prepare it and hand over to the auditor does not mean these are written confirmations given by them. So they will not amount to written representation. Now, we will obtain written representation for two particular matters. One, to confirm certain things. Second, to support the other audit evidence. When we talk about confirming certain matters, there the standard very particularly mention about the three things. One is that the management has to confirm their responsibility that they have prepared and presented the financial statements as per the applicable financial reporting framework. They have provided all the information to the auditor as required and all the information have been properly recorded and disclosed correctly. Third, we talk about management giving a clear description of fulfillment of their responsibility. Now, these three things fall under the category of confirmation of certain matters. But this is not an exhaustive list. The standard has only given you certain places where you compulsorily require a confirmation in the form of WR. But the auditor, by applying his professional judgment, and if he wants to reconfirm certain other matters also, for those matters which he requires, he considers it to be important, he could obtain written representation for those matters also. So it is purely the judgment of the auditor. Wherever he believes he requires to obtain a reconfirmation or a double check from the management, he could obtain a written representation. On the contrary, to support other audit evidences also, if the auditor believes he requires one or more written representation, he could obtain for the same. Like for example, if suppose while the course of the audit, you have not come across any indicator of fraud. So you could also obtain a written confirmation from the management that according to them, when they did their risk assessment policy as well, during the year, they have not come across any fraud. So this would be just a reconfirmation that we could get. So written representation could be obtained for both confirming certain matters and for any other matter to support the other audit evidences. Now, we already discussed what would be the layout. Now, the other thing that we are going to discuss will be about the information which is already available on the public portal. That means when there has already been a public display of information about a client accepting the responsibility, for those acceptances again, we do not require a written representation. Now, written representation once you obtain, you simply cannot rely on it blindly. So there are certain things that the auditor has to assess or recheck before accepting the written representation as an audit evidence. So first, you will be checking or having a proper understanding about the integrity, the professional competence, the diligence of the management, whether they are in the position to give a reliable written representation. And if they are competent enough, you could rely on the written representation. Or suppose if the written representation obtained is contradicting with the other audit evidence that you have obtained, then this will also be a doubt as to the reliability of the audit evidence that you have obtained. So in these cases, we are not going to accept the written representation just like that. So what we will do in this case, we are going to perform additional audit procedure. Maybe we could set up some more inquiry. Maybe we could obtain or check some more other documents. Maybe we would obtain some external confirmation. Maybe we would do some other inspection that is required. Okay, there could be some other checking that we will be doing to resolve the matter. Even after all this, if there is a sufficient doubt as to the reliability of the written representation, the auditor could either withdraw from the engagement or he could give a disclaimer of opinion. Alright? And then, what will happen if the written representations are not provided? That means the auditor has requested on a particular matter a written representation and the management denies, does not give you the representation. So in that case, we are going to reassess and recheck the integrity, the reliability of the management. We will check whether they are reliable, do they have the enough integrity in them? And if yes, we come to a conclusion, we could look into performing some other audit procedure. But if we have a doubt on the integrity, if there is a sufficient doubt as to the reliability on the management itself, we would withdraw or give a disclaimer of opinion. But before giving any disclaimer of opinion or before even withdrawing, you first have to have a communication with the management, understand the reason behind it, try to communicate with the top level people, and only then we will end up giving a decision, either withdrawal or we will give up a disclaimer of opinion, which is like no opinion absolutely. So this is all about SA 580 written representation. That is it with SA 580 written representation, an important audit evidence which the auditor will obtain during the course of his audit. When do we obtain the written representation? The timing for obtaining the written representation would be either the date of the auditor's report or somewhere very close to the end of the audit report. That means the date of the audit report. Basically, when we are going to finalize the audit report, when we are closing the audit, at that point in time, for the reconfirmations, we will be obtaining written representation from the management. And the period covered would be the period covered by the financial statements that we are auditing for. So this is very important for us to understand that a written representation can never be obtained after the audit report is finalized. So the date of the written representation would be either the date of the audit report or just near to the date of the audit report, prior. It cannot be after the date of the audit report. If it is after the date of the audit report, it will not be considered as a valid audit evidence. Having understood the SA 610 in detail, it is now time for us to take the summarized approach of this standard. This standard, very lengthy. Okay, I do agree it is very lengthy. But this summary will help you to understand the most important and the relevant points of the standard. Alright, so let us get our understanding. SA 610, which talks about using the work of internal auditor. It is one of those conditional standards where the applicability of the standard will happen only if there is going to be an internal audit function. If a particular entity has this particular department or has this particular function called as internal audit function, only then we are going to have the requirement of the standard. Alright, now before we get on understanding, first thing we need to understand what you mean by the word internal audit function. Internal audit function is nothing but it is a part of the management's function, which the management has it in the place of its organization for the purpose of three things. One, evaluation of the governance structure. Second, for risk management, that is evaluation of their risk management policy. And third, evaluation of their internal control system. So basically for these three activities, to provide them assurance, to provide them consulting activities, management will have this kind of function in place. Some entities give it a very clearly name as internal audit function. Some entities could give it some other name, or they could also outsource this particular activity to some third party. So whether you are outsourcing it to the third party or the title of this function is something else, doesn't matter. What we require to see is if the characteristic of this function is having any of the activities, then that particular function will become an internal audit function of the entity. And based on that, for the auditors, SA 610 will become applicable. Got it? Now, what do you mean by these three things? First, governance structure. Basically, it is about the structure of the governance, the ethical values, the way the operations are conducted. Okay, all of these things we consider it to be one single word, which is called as what? The corporate governance or the governance structure. So here, when the management has designed the governance structure, The internal auditors will be appointed for the purpose of evaluation of whether these governance structures as designed by the management actually operating or not. So maybe there is a structure of an ethical conduct or maybe ethical values which the management has given to all the members in the organization, all the employees. So they are required to follow these rules and regulations. So whether really these things are happening or not, for the evaluation, there will be a separate function which we call it to be internal audit function. Second, management will have a risk management policy. So whenever every organization is exposed to risk, there could be external risk, there could be internal business risk which is they are exposed to. So the management will have the risk management policy in place. So whether this risk management policy is adequate, whether it is operating effectively, whether they are really able to capture the new risk, okay, all of this will be evaluated by the function which is called as the internal audit function. Correct? Then, third and one of the most important reason why you have this internal audit function is regarding the evaluation of the internal control. That means whether your internal control system, which is designed by the management, whether it is really implemented, and if it is implemented, whether it is operating effectively during the year is one of the important requirements of the internal audit function. So maybe the management has designed regarding the segregation of duty. They have decided there is going to be an internal check. The work done by one will automatically get checked or reviewed by another. So there is a proper internal control designed where accounting and custodial functions are not going to be same. Now these are what they have designed. But in reality, is it really operating? For this reviewing, we will have another function which we call it to be internal audit function. Now basically when you talk about internal control, 4 aspects is what responsibility is given to this function. First, to check the effectiveness of the internal controls. That means management is telling we have this control in place. But there will be somebody who is going to review and give a reporting on whether function is really operating or not. So that will be one function. Second, regarding whether the effectiveness of the information system, the operating and the financial information system, whether that is really operating effectively or not. Then regarding the operating activities, the operational functions, whether they are actually the way they are implementing, whether they are operating in the same manner or not. The evaluation of that. Finally, we know that the management is responsible for the compliance of laws and regulations. Now in that case, whether all the relevant laws and regulations have been complied or not, this checking also will be assigned to another function which we call it to be what? The internal audit function. So in a simple line, what it means? Internal audit function is a part of the management appraisal function. What it says? You provide us assurance, also provide us consultation. So consulting activities have been provided regarding 3 things: the governance structure, risk management, and the evaluation of the internal control effectiveness. If any of the function of the organization is providing these activities, then irrespective of what title you give it, or whether you outsource these functions to some third party, that will be considered to be internal audit function. So the determinants of the function are these characteristics. If any of the function is doing these, then we call it to be internal audit function. Got it? Now, having understood what is internal audit function, it is now important for us to understand what the standard is talking about. This standard, obviously, all the standards are applicable only to the external auditors. So the external auditor is given a responsibility by the standard that if a particular entity is having an internal audit function, basically if they have internal auditors, then you have to ensure, or you have the responsibility to check whether you require to use the work of the internal auditors. If so, what work will be that? That is the nature and the extent of the work. You should also evaluate whether the work which you are going to use is going to be adequate enough for the purpose of your audit. And the standard also gives you one more idea that if you are not wanting to use the work performed by them, you have one more option that you can directly take their assistance for the purpose of the audit. So you could require the internal auditors to directly provide you an assistance for the purpose of performing the audit. Correct? So this is the objective of the standard. Understand, there are certain important audit procedures that the auditor needs to follow before using the work of this function or before asking the internal auditors to provide direct assistance. Reason behind it is very simple. whatever you do, at the end, the responsibility of the entire opinion will rest only on the external auditor. The opinion that is given on the financial statement, whosoever work the auditor uses, whether it is expert, whether it is other auditor, whether it is internal auditor, ultimately the sole responsibility on the opinion will rest only and only with the external auditor. So this standard gives you certain procedures wherein you have to ensure that you are sure that the work that we are going to use, is it providing sufficient appropriate evidence to support our opinion? And if we are taking their direct assistance, can we really take their assistance for the work that we require? So that is the evaluation that you do throughout the standard. So we will be studying the audit procedures in two levels. First, if you decide to use their work, what will be the procedure? If you decide to use them as direct assistants in the work, what will be the procedure? So this entire standard we will study as procedural for two different ways in which the internal audit functions work can be used. Alright? Before that, three important things you need to understand. One is that how much ever you try to do not try to completely or excessively use the work of the internal auditor. Do not take unnecessary, undue advantage of the situation. You are required to apply direct procedures at some point. Wherever there is some assessed risk of material misstatement, where there is really a direct need of the auditor to evaluate, see that unnecessarily you do not use the work of the internal auditor every place where he has worked. So if he has evaluated information system, do not take all the report from him. If he has evaluated internal control, see everything you don't rely. You have to also perform audit procedures. Do not unnecessarily, unduly rely on him for every work that he has done. Second, see that whatever work you use, ultimately your involvement should be maximum. Get more involved in the audit. Do not have the kind of reluctant behavior that yes, we are using his work, so this is what we are going to do. And the standard is allowing, so we have only responsibility that we can use it. No. Keep yourself involved. Because always tell yourself that even the internal auditor, even if he is independent, he is never going to be as independent as you are. And that is the reason, somewhere or the other, his independence level is not going to be at par with that of the external auditor. So there are going to be audit procedures in addition to be followed by the external auditor. So you have to understand that you keep yourself equally involved, or rather I would say more involved in the audit, because you only are responsible for the opinion. And finally, one more point is that once you decide to use the work of the internal auditor or to take his direct assistance, you have to communicate the planned work and the nature and to what extent you are going to use their work to that of the TCWG. That means you have to communicate with the TCWG the planned usage of the work of the internal audit function. What work, what is the nature, to what extent, when, how, everything. The planned procedures have to be informed to the TCWG, and this is very much given in SA 260. So along with this, you also have to comply with the requirement of SA 260. Clear? Now, let us take up one by one the two options given. First option is where the auditor will be deciding to use the work of the internal auditor. That means the internal auditor has already done the checking of the internal control system. So the report regarding the internal auditor, regarding the internal controls is ready. I am not asking the internal auditor to help me assist. I am telling I want this report. So I am going to use the work of this internal auditor. So when I decide to use the work of internal auditor, as per SA 610, what is my audit procedure? Three things I will do. First, I will evaluate the internal audit function. So I am going to see if I am using the work of this function, is this function good enough for me to use it? If I get the answer yes, then I'll decide the nature, also to what extent I'll be using his work. If I decide that, finally, once I take both the decisions, I will see what other procedures have I to follow when I'm going to use the work performed by the internal auditor. Alright, then. Now let us take one by one. First, how do we evaluate the function? Three things we are going to give regard to. First, the objectivity of the internal audit function. Objectivity means what? No personal bias involved. They should be independent. Management should not have some kind of pressure over them. Management is not trying to limit their scope. They do not have any kind of direct relationship with any department whose work we are going to use. Correct? So in that case, you have to look into their objectivity. Second is about their competence. Do they have the required knowledge, the skill that we require? Okay, that means the work that we are going to use in that particular area, is there requisite knowledge, skill that they have. Correct? Third, you will ensure that the work performed by them is systematically done and disciplined approach was applied. Because understand, they are internal auditors. They also required to plan, review, supervise, do everything systematically. They also need to document everything correctly. There has to be proper communication between them. So you have to ensure whether the work is really performed well by them or not. If you believe yes, the work is disciplinedly carried out, systematically done, then in that case, okay, we are in the position to decide that yes, internal audit function is good, we can use their work. Once you decide this, you will then have to decide the nature and the extent of the work that you are going to use. So here you are going to see that whatever work I use, I will not use unnecessarily extensive work. Where required, I am going to perform my direct procedures. Second, whatever it is, my involvement is going to be there. Third, what work I use, okay, I will communicate that with the TCWG. There are certain areas where you could actually use the work of the internal auditors. Like there could be where, testing of transactions where limited judgment has been there. So maybe the internal auditors have already performed the substantive procedures, but here the transactions are involving limited judgment. Because if judgment is very high, then that area is highly risky, where we will perform the work directly, we don't take the work of internal auditor. Then regarding the operating effectiveness of the internal control. If they have already reviewed the work of one of the subsidiaries, and that subsidiary is a component which is not very significant, so that work we could use. So there are going to be areas where you could believe that yes, this work is performed by them. We have already ensured that the internal audit function is good enough. So we could decide of using a particular work which they have already performed. Now, once you decide that yes, you are going to use their work, then there are certain procedures that you have to follow. First, you discuss with them what is the level of the work that you are going to use, which area you are going to use their work. Discuss with them appropriately. Then take the reports from them and evaluate the report, understand the report. Through the report, you try to understand what is the nature of work, how have they carried on the work, whether the work was properly planned, supervised, reviewed, documented. See what is if they have really obtained sufficient appropriate evidences to support their conclusion. And based on that, you will ensure whether the work is being properly, the conclusion that they have got, the opinion that they are giving is actually consistent with the conclusions that they are drawing or the evidences that they have obtained. If you feel all these are correctly done, then we are going to use the work and that work will become our sufficient and appropriate audit evidence. But after looking into their work, there are certain decisions that we are going to take. How much more audit procedures we have to apply, that also will be dependent upon certain factors. That means if suppose the risk of material misstatement is really high, then in that case we are also going to perform extensive audit procedures. If suppose we don't have the confidence on the competence, or maybe we don't believe the objectivity is they are not free, depending upon the organizational structure, the policies and the procedures of the organization, you believe that no, they are not have the enough objectivity, then the work which you will perform will be extensive. Any area where significant judgments are involved, in those cases you are not going to use the work of the internal auditors, like assessing the risk of material misstatement, what will be the planned audit procedures, okay, then how are you going to evaluate the evidences. All these areas we would not be using the work, rather we would believe to use you to perform the work directly. All right, so these are the procedures with respect to using the work of the internal auditor. Now we are going to talk about using direct assistance of the internal auditors in the performance of the audit. Here again we have three things: evaluation of whether the internal auditors could be used for the purpose of our work. Second, if yes, determine the nature and to what extent the work can be used. And third, once we decide that we are going to use them to provide direct assistance, what audit procedures we have to follow. Got it? Now, When you are going to evaluate whether you can really use the internal auditors to provide direct assistance, you check two things. You will see whether there is any threat to their objectivity which is existing. Is there any significant threat to objectivity? Do you think any personal bias is there? Any personal relationship they have with the business? Do you think that if you take their direct assistance, will the work done by them will be, not unbiased? It is going to have some influence of the management coming over it. That. Second, we will talk about the competence of the internal auditors. Do they have the required knowledge, the skill to assist you in the area that you require? Got it? If you get a positive answer for these, then what we will do is, we will determine in which area and to what extent can we assign the work. So when we do the planning of which areas to assign them, that is the nature, timing and extent of which areas to be given to them, then in that case, we will give regard to three things. First, how much judgment is involved in that particular area, that means regarding the planning of the procedures which huge judgments are required by the auditors. So those areas we are not going to assign the task. So wherever there is going to be planning, there is going to be involvement of judgment, then those areas we do not assign. Then regarding the risk of material misstatement, if risk is high, we will perform the work directly. If the work is less risky or level of risk is less, we could assign the work. Third, depending upon their objectivity threats, depending upon the competence, we will decide how much work to assign to them or whether to really assign the work or not to assign the work. Got it? Now, one very important point covered by this standard is, there are certain areas where you are not recommended to use the work of the internal auditors. That means you cannot use internal auditors to provide you direct assistance. 4 areas very clear. First, where significant judgments are involved. Wherever significant judgments are involved, do not use the work or do not take the assistance of the internal auditors. Second, where the risk of material misstatement is very high, you cannot take the assistance of the internal auditors. Third, if suppose the work which is already performed by the internal auditors only as a part of management, if the checking of that has to happen, do not take the assistance of internal auditor. There is going to be self-review threat. Got it? And when you do the evaluation based on the first part, that is about threat to objectivity or maybe competence, whatever result you got out of it, if suppose the result is coming that they do not have that kind of competence or maybe you believe there is a threat to their objectivity, then in that case, you really cannot use them as providing you the direct assistance. Alright? Then, moving on further, whenever you decide to take their direct assistance, compulsorily you have to communicate this with the TCWG as per 260. That means, to what extent, what work, in which area we are taking the direct assistance. This has to be communicated to the TCWG as a part of the overview of your planned procedures to whom the TCWG as per SA 260. Got it? Then, once we decide which area to assign, then there is certain procedure to be followed. Before we start giving them the work or before they start doing the work, you have to get 2 agreements signed. You have to enter into 2 agreements. One agreement will be with the client, that is the management. So management means the authorized representative of the client. One agreement will be with the internal auditors. With the management, you would require an agreement to be signed that they are allowing us to use the internal auditors to provide direct assistance. Moreover, they are not going to interfere in the workflow that we are going to do together. Second, you take in writing from the internal auditors that whatever is told to them, okay, they will be keeping it highly confidential. That means whatever matters are instructed to them, whatever audit findings are there, they will keep it confidential. And anything that they have identified during the course of audit, they will be given what? Clear information to the auditor. Okay, they will inform all of this to the auditor and they will maintain the secrecy of the procedures being performed. So these 2 agreements you have to sign. Then, also very important, understand that when internal auditors are used to provide direct assistance, they will be completely under the direction, supervision and review of the external auditors. Got it? So this is the basic idea where you are going to use direct assistance of the internal auditors for the purpose of performing the work. Got it? Now last part is documentation, which is quite simple. You simply have to write the procedures that you have followed as a part of your documentation. So that is all regarding SA 610. using the work of internal auditor. I believe after listening to the summary also, you will have a crystal clear idea of what the standard is covering. Having repeated so many times during the entire session, I am sure there are going to be certain things which are now fixed in your mind, and you will be able to interpret the questions also very well. So for interpretation, now let us take few questions for a practice so that your confidence will be much more higher with respect to this standard. Please do not look at the length of the standard. We know the content is heavy. We know the content is lengthy. But if you understand it conceptually, it is interesting. And I focus a lot here because for examination, one of the important areas for you getting tested. Having understood the essay 700 in detail, it is now time for us to understand it in a summarized manner so that the thought process will be very, very clear. Alright? So let us begin with the summary of essay 700, forming an opinion and reporting on the financial statements. So this standard very clearly talks about two things. One is we are going to form an opinion on the financial statement, and second, once the opinion is ready, we are going to report it through a written audit report. Alright? Now, this standard basically the scope is about how are we going to form the opinion, then it's going to talk about the form and content of the audit report, and finally it is also promoting a consistency of the audit report. So before we move on with the first two pointers, third one is quite interesting to know that promoting the consistency, meaning is in India there are so many chartered accountants, so many practicing chartered accountants. If they do not have a standardized way of preparing an audit report, then how are you going to compare the different audit reports? How is there going to be a possibility of there being some kind of comparison, understandability, a better weightage to the audit report in the marketplace? So globally it has to get accepted, it has to have that kind of confidence, that kind of understanding, and because of which you have a standardized way of preparing the audit report so that there is a proper comparability, so that there is a proper understandability. So that is the reason this standard also promotes the consistency in the preparation of the audit reports. Correct? Now, the objective of the standard is obviously to draw conclusion from the audit evidences that we have obtained by performing the procedures. Correct? And once the opinion is ready, we are going to communicate our opinion through a form of a written audit report. Okay? Now, this standard first explains very clearly that this is with respect to the general purpose financial statements. General purpose financial statements are those which are for the wide range of users, that is for you and I, the financial statements that we refer, we call them to be general purpose financial statements. The specific purpose financial statements, the specific considerations regarding to that are covered by essay 800 and 805, which are dealt in separately. Reporting of that also is done through this standard only, but specific consideration relating to special purpose financial statements we look into in 800 and 805, but that is not a part of your syllabus. Alright? Now, when you talk about financial statements, general purpose financial statements, we have two categories there. First, fair presentation framework. Second is the compliance framework. Now, fair presentation framework, to understand, we can take a simple example of Schedule 3 of the Companies Act 2013, which is a classic example for fair presentation framework, where you are required to comply with the financial reporting framework, compulsorily obviously. Along with that, it also acknowledges you that you can either add on something extra or you could depart in very rare circumstances in order to achieve fair presentation. That means what is given in the Schedule 3 is the minimum requirement of disclosure. Minimum, this is what you have to give. But can you add something extra for the disclosure? Yes. If you believe that extra item or extra disclosure is required for the better presentation, for a fair presentation, then that can be added on. Similarly, in very rare circumstances, there could be a departure from the requirement. Only with one intention is to achieve fair presentation. So when a particular financial reporting framework gives this kind of acknowledgement that additional disclosure can be done or departure can be done if required to give fair presentation, okay, then that kind of framework we call it to be fair presentation framework. And in Schedule 3 we see additional requirement or disclosures can be done by the management, okay, and departures also could be done wherever required if achieving fair presentation. But compliance, the example would be like the Banking Regulation Act, which gives you under the Schedule 3 of the Banking Regulation the financial statements of banking company, where the compliance of what is given there is required. You have to comply with what is given in the financial reporting framework, and there is no acknowledgement like you can depart or you can have anything additional. So you have to comply with it as it is. So that kind of framework we call it to be what? A compliance framework. Alright. So these are two financial reporting frameworks, one fair presentation framework and compliance. Why we study it here in the beginning is to understand the language, because the word true and fair, we basically use it for fair presentation framework, and when we say they're complied with the applicable financial reporting framework, it is the compliance framework. So the language of reporting will change. Alright, now 700, when you talk about 700, basically talks about a report which is an unmodified opinion, so it is giving a true and fair view. When there is a modification, a part of the reporting happens from 705, modification to independent auditor's report. 701 is going to talk about key audit matters, and then we have 706, which is going to talk about other elements wherever required to be added in the audit report, which we give them as a heading, emphasis of matter paragraph and other matter paragraph. Clear? Now, when you talk about SA 700, the first part is forming an opinion. So to form an opinion, the auditor has to obtain a reasonable assurance that the financial statements are free from material misstatement. So to obtain the reasonable assurance, what all evaluation the auditor does? First, he will evaluate that he has obtained sufficient appropriate evidences by performing the procedures given under SA 330. Then as a part of SA 450, where he is communicating about the misstatements identified, he will see if there are any uncorrected misstatements, if individually or in aggregate they are accumulating and becoming material. Then also specific disclosures he will check with respect to the applicable financial reporting framework compliance. That means whether all the requirements of the applicable financial reporting framework have been complied with or not. Here you look into the qualitative aspect of the accounting practice. That means management bias should not be involved. You give 10 misstatements, only 5 have been corrected, 5 have not been corrected by them. So you have to look into for management bias. Then you will also do the evaluation with respect to the accounting, accounting things. That means applicability of the FRF. That is going to be whether you have the evaluation of appropriate accounting policies, whether selected correctly, applied correctly, consistently applied, reasonableness of the accounting estimates, adequate disclosures, correct? All of these you have to check whether adequacy of notes to accounts are there. Okay, when it comes to fair presentation framework, further you have to also check whether there is proper presentation, overall structure is correct or not, and also see that all the disclosures that are done there, they are adequate to support all the transactions and the events which have happened. Okay, finally you also talk about give a description to the compliance with the applicable financial reporting framework. A description or a definition has to be given that you have complied with applicable FRF, but that can be given only if you have done it. Otherwise, you cannot say substantially complied. You have to comply. Alright? That means applicable FRF includes all your accounting standards, Ind AS, IFRS, US GAAPs, whatever is applicable to the entity, that will be considered to be the applicable financial reporting framework. Financial reporting framework could also include the statutory requirements along with the accounting standards, like we have the Schedule 3 requirements of the Companies Act 2013. So depending upon the nature of the entity, objective of the reporting, the financial reporting framework would be different. Correct? Then we have the different types of opinion. One is the unmodified opinion, where the auditor is giving a conclusion that the financial statements are free from material misstatement. On the contrary, we have the other modified opinion, where the auditor is either concluding that the financial statements are not free from material misstatement, or the position is such that he is unable to obtain any evidence to give a conclusion on the financial statements. So in that case also we give a modified opinion, but when you give a modified opinion, the reporting that you will be doing is as per SA 705, correct? Then after this we study about the reporting of the opinion has to be reported. The audit report must be in writing or it must be in the electronic medium, alright? Both are acceptable. Hard copy and electronic medium, both are acceptable. In writing becomes mandatory, alright? Now, this standard 700 divides the audit report into 3 parts. First, audit report if the audit is conducted as per the standards on auditing. Audit report if the audit is conducted based on laws and regulations. Audit report if the audit is conducted by both the compliance of international standards on auditing and standards on auditing. Okay. So first we'll take up the first portion, that is regarding audit report with respect to the audit which is conducted in accordance with standards on auditing. So here the contents are first the title, which is clearly tell it's an independent auditor's report. Second, the addresses, that is basically for whom the audit is conducted. It could be the members, the shareholders of the company, the TCWG in case of partnership firms and all of that. So to whom we are addressing. Then we have the opinion. In the opinion, basically you have 2 paragraphs. One is the introduction, where you are going to give the identity of the entity. You will be telling that you have audited the financial statements. You will give the title of every financial statement, including the notes to accounts. Along with that, you will also tell which is the period covered by the financial statements mentioned above. Then you will be giving and expressing the opinion that is going to be to the best of your knowledge and information and the evidences that you have obtained. You will be giving the audit opinion. Since we are talking about 700, you will be giving unmodified opinion. So depending upon the type of presentation, your language will differ. So if it is a fair presentation framework, you will be writing, in our opinion, the accompanying financial statement in all material respects present fairly in accordance with the financial reporting framework. Or even simpler, in our opinion, the accompanying financial statement give a true and fair view in accordance with the fair presentation framework or applicable financial reporting framework. If it is a compliance framework, the language will be, in our opinion, the accompanying financial statement in all material respects comply with the applicable financial reporting framework. So basic idea is the word fairly will not be coming as a part of compliance framework, correct? So that is opinion section. After that, we have the basis for opinion. In the basis for opinion, you very clearly give that we have conducted the audit as per the standards on auditing. Then we have a separate section for the auditor's responsibility. So in this particular section, you give a reference to that section in the audit report. Then you also talk about that you have complied with all the ethical requirements regarding independence and all the other ethical requirements like integrity, objective. Also, you have done everything which is given in the code of ethics. You will also tell that we believe that we have obtained sufficient appropriate audit evidence on which the opinion of ours is based. Correct? So that is going to be regarding the basis for your opinion. Obviously, on what basis you give the opinion. Then we talk about the going concern paragraph, which will be coming into picture if only is required as per SA 570 going concern. Then we have the key audit matters, which is going to be as per the requirement of 701. Other information which will be as per the requirement of SA 720. Finally, we are going to talk about the auditor's management's responsibility, where we talk about very clearly that they are responsible for the preparation of financial statements. They are going to design the internal controls in such a manner that the financial statements will be free from material misstatement. They will be assessing the going concern assumption, correct? Also along with that, if it's a fair presentation framework, then they have to prepare the financial statements which give a true and fair view, okay, as per the required financial reporting framework. Also remember that this heading of the section should not always be management's responsibility. You have to look into the terms of engagement. If that is the responsibility of the TCWG, the heading will be changed as the responsibility of those charged with governance, or it will be management responsibility depending upon the terms of engagement. Alright, then. Moving on, next is the auditor's responsibility, and we have done a detailed discussion here where we have categorized the auditor's responsibility in relation to the auditor financial statement in 3 categories. One, purely the objective of the auditor. Second, regarding the audit procedure. Third, regarding the communication with the TCWG. So first, when we talk about auditor's objective, his objective is to obtain the reasonable assurance. Reasonable is going to be high level of assurance. It's not a guarantee, and he's going to issue an audit report which is going to include the conclusion therein. Along with that, you also tell the material misstatements could be due to fraud or due to error, but they'll be considered to be material only if they're going to have a influence over the economic decisions of the user. You also give a definition and a description of the materiality which is required as per the applicable financial reporting framework. Then you talk about the audit procedures, where you're going to very clearly mention about you exercising professional judgment and maintaining professional skepticism. You also talk about your audit procedures, where you're talking about the risk assessment procedure, where you have assessed the risk, responded to the risk, obtained sufficient appropriate evidence, and drawn the conclusion. You also give an information that the risk of identifying a fraud will be more difficult because there will be a collusion of employees, there could be all the manipulation factors, there could be forgery where top management could be involved, etc. Because of which it is not easy to identify a fraud, a misstatement which has a fraud. You'll also tell you'll evaluate the internal controls, but we are not giving opinion on the internal control unless our engagement is telling us to give opinion along with the opinion on the financial statement on the operating effectiveness of the internal control as well. Correct? Then, after that, we are also going to tell that we have evaluated the appropriateness of the accounting policies, then reasonableness of the accounting estimates and the disclosures as well. Then we'll say that we have also assessed the management's use of going concern, and if the material uncertainty was there, we have reported as per 570 or 705 as the case may be. But you be very clear that your responsibility is limited only to the date of the audit report, and if anything after that is happening, auditor will not be responsible. Along with that, if it is a fair presentation framework, you also have to tell you have a responsibility of evaluating the proper presentation, structure, content, everything has been properly checked by you, including the disclosure, whether they are adequately disclosing all the underlying transactions and the events, okay, which are reflecting through the to achieve the fair presentation. Also, you will talk about if your SA 600 is becoming applicable, then you will give a division of responsibility properly in this particular section. Then comes third one, where we talk about communication with TCWG. So we will inform the TCWG regarding our planned scope, timing and extent of our audit procedures. If any internal deficiencies or significant internal control deficiency we identify, we communicate with TCWG. Then we also give a statement of our independence to the TCWG, that, and if there is any threat which we have identified, we'll communicate that to them. Also regarding the safeguard that we have taken to eliminate those threat. Then if suppose in our audit report we have communicated key audit matters, then give the understanding of what are the key audit matters, what is your responsibility relating to key audit matters as a part of your responsibility. So these are the three sections in which you divide the auditor's responsibility. Then we have the other reporting and the regulatory requirements, where you are going to give the other reporting requirement. Basically for the companies it will be applicable, where we have the CARO reporting, we have section 143 subsection 3 reporting. So these are rule 11, that reporting also becomes very important here. So these are all the other regulatory requirements that we are going to have, which will be reporting as a part of our audit report. Then we'll have the signature. Signature will be the personal name of the partner. His designation will be written there. He'll be signing on it, the membership number, the firm's name, and whereas the firm's registration number which is allotted by ICAI, that also will be included. Place will be the place where the audit report has been signed, and the date will be a date which is not going to be earlier than the date of obtaining all the audit evidences on which the audit opinion is based. Along with that, you have to be very careful that the date should not be a date earlier to all the financial statement components are ready and they are approved by the approved authority. Correct? So that is very important for you to decide about the date. Alright? Then, when you talk about the second part of the standard, which is talking about audit report with respect to the audit conducted as per the law and regulation. So here you can give the reference to the standards on auditing. That means you have done the audit as per the standards on auditing. Only if the audit report which is coming in from the law and regulation has a minimum of these 13 contents. If these 13 pointers are included in the audit report, then only you can give a reference telling that the audit is conducted as per the standards on auditing. Otherwise, this phrase will not be included as the part of your audit report. On the same lines, if suppose the audit is to be conducted based on both international standards on auditing and standards on auditing, then you can refer that you have done the audit as per the standards on auditing in addition to international standards, only if there is no conflict between giving a difference of opinion or there is a conflict regarding use of emphasis of matter paragraph or other matter paragraph which is required by the essays. And the layout, that is the 13 pointers are minimum present in this audit report also. Only then you can give a reference to the standards on auditing. Otherwise, you simply tell it has been done as per the international standards on auditing. Clear? So these are the requirements given. One additional point is given here regarding supplementary information. Supplementary information is only the additional information which the management is presenting along with the financial statement. It could be in the form of supplementary schedules, in the form of additional notes, in the form of appendix. Okay, this could be given as a part of any way. Through any form, and this information could be either integral part. So if it is a part of explaining the notes, then obviously we will consider it to be integral part and our opinion will obviously be extended to that. But suppose if the information is something which is not an integral part of the financial statement, then you very clearly have to differentiate it from the financial statements that you have audited, so that the people don't get misinterpreted about the particular item which has not been audited. If you are not able to separate it like that, then very clearly label it as unaudited. First, you request the management that, look, management, you have to present it separately, present in a manner that people understand that these are unaudited. Suppose it is not possible, if the management is not willing to do it, then in your audit report, you have to very clearly mention that the supplementary information which has been attached is unaudited. So this will relieve you from your responsibility, but this will not relieve you from the responsibility that you have in SA 720, the reporting which happens there. Okay, so that is separately taken altogether. Alright. One more thing about the auditor's responsibility paragraph which we are going to do. There you need to understand the responsibility, either you give it in the body of the audit report or you give it as a part of appendix, that is you do an attachment there, or you could give it on a website and the link of the website or the address properly you can give in the audit report. So all the three options will be available to the auditor, but whatever you do, reference should come in the audit report only. Alright. So that is all about SA 700, forming an opinion and reporting on the financial statements. Having understood the SA 705 in detail, let us now take up a summarized approach of the entire standard so that the thought process will be even more clear. As we did SA 700 prior, where we understood how the auditor forms an opinion and gives a report. That means the basic elements of the audit report we study as a part of SA 700. But 700 specifically proposes or maybe specifically focuses only on an unmodified opinion. So the reporting that we study there is regarding the unmodified opinion, because of which we have the SA 705 which talks about modification to an opinion in the independent auditor's report. That means what we studied in SA 700, The basic elements of the reporting will remain as it is. But if suppose while forming an opinion, if the auditor comes across a modification or a reason for modifying his opinion, then in that case, there will be some modifications that he will be doing to his report under SA 700. So the basic elements will remain as it is, but there are going to be certain modifications because of the modified opinion which is given by this particular standard. So 705 does not give the entire audit report again. It only gives you the additional requirement which the auditor has to do when there is going to be a modification in the auditor's report. The first part of the standard talks about what do you mean by a modified opinion. So modified opinion, basically we categorize them into three parts. This is like a weapon in the hand of the auditor which the auditor will use whenever he comes across something which is not enabling him to give a true and fair view on the financial statements. Alright. So we have three modified opinions that we study. One is qualified opinion, second adverse opinion, third disclaimer of opinion. These opinions, when what we give, we need to do a detailed understanding of that. First of all, there are two reasons where modification will arise. First, when the auditor is going to obtain sufficient appropriate audit evidence that there is a material misstatement. Second, the modification happens because the auditor is unable to obtain sufficient appropriate audit evidence on which he can base the opinion. So there are two reasons for which we give a modified opinion, but the types of opinion we categorize into three because there is some element which we call it to be a pervasive effect of this misstatement on the financial statement. So what do you mean by pervasive effect? Pervasive effect means a widespread effect on the financial statement. So a misstatement is going to be considered to be pervasive or to consider to have a pervasive effect when that particular misstatement is going to significantly affect the financial statement as a whole. The standard gives a proper meaning for the word pervasive. It is used in the context of a misstatement. So when the auditor identifies a misstatement, then we are going to understand that this misstatement, it is material obviously, only then we are going to discuss about it. But the impact of this misstatement on the financial statement, how is it? If it is pervasive, we will give a different opinion. If it is not pervasive, we are going to give a different opinion. But then comes the question, what is pervasive? As I told you, simple English, it simply means widespread impact on the financial statement. This standard gives the definition as pervasive effect in the context of a misstatement is such that in the auditor's judgment, it is not specific to a particular element, an item, a transaction. That means you cannot locate it at one particular place. The misstatement is such that it is going to impact the overall financial statement, multiple items, multiple elements. It is going to have an impact many places. That is one thing. Second, if supposingly you are able to locate it at one particular area, so you can say sales are wrong. That means if it is wrong also, the item which is wrong is going to cover the substantial portion of the financial statement. So if you talk about a trading company, if suppose the buying and selling is the major business activity, if sales only are wrong, then we are going to consider it to be pervasive impact because it is going to materially affect the financial statements. Correct? Then, also when you talk about financial statements, pervasive impact will be that kind of disclosure, the non-disclosure of which would impact the fundamental decision making of the users. It will be fundamental to the user's understanding. The classic example is non-disclosure when the going concern is not appropriate. That is going to impact the decision making and that is going to have an effect on the overall financial statement. Got it? So this is the meaning of the word pervasive, where it is not something small, it is going to impact the financial statement as a whole. So when you talk about misstatement, obviously as auditors, we are not concerned with immaterial items, we are considered with materiality. So SA 320 talks about material level. So we will fix the materiality and only those items which are material, that means which has the power to influence the decision of the users, that is what we are going to consider. Along with that, we are also going to see whether the misstatement, is going to be pervasive or not. Correct? Now, two situations where modification can happen. One, you identified misstatement. One, you do not have identified misstatement. So when you identified the misstatement, obviously you are going to consider if they are material, pervasive or not pervasive. On the contrary, on the other hand, what we have, you are unable to obtain the evidences. So obviously when you are unable to obtain, can you say that that misstatement has a problem? No. You can only say that if suppose you could find out the possibility of that misstatement would be pervasive, or the effect of the possible effect of the misstatement would be either pervasive or not. So the word possible effect is when you are unable to obtain the evidence, because once you obtain the evidence you know whether it is or not. But you are not able to obtain, then you say the possible effect of that could either be pervasive or not pervasive. Correct? So 2 reasons for modification, but 3 opinions we are talking about. So what we say, if you have identified a misstatement, you say it is material but not pervasive, you will give a qualified opinion. If you say material and pervasive, you give adverse opinion. Correct? On the other side, if you are unable to obtain audit evidence and you believe that the possible effect of the undetected misstatement, if it is material but not pervasive, you will give qualified opinion. But if you say it is material and pervasive, you will give disclaimer of opinion. So basically, 2 reasons for modification, but 3 different opinions. 2 places we give qualified opinion, 1 adverse, other will be disclaimer of opinion. Got it? So this is the way you identify that how is it going to be a qualified, disclaimer or adverse opinion. Got it? Now, what would happen is where there could be a possibility of giving adverse opinion. Like suppose a disclosure is there, which it has to be there or it is not there. Like we study in Sep'25 where we talk about going concern assumption has to be, if it is inappropriate, you cannot prepare financial statement on going concern assumption. Correct? And if the management prepares, then the possible impact of this is going to be what? Pervasive. It is going to be pervasive. Correct? Here there could be a possibility that you have identified that uncertainties are there, you have obtained evidence and now you say that material uncertainty is existing. That means you have an evidence with you and you say going concern is inappropriate, management has not disclosed. So in this case, it is both material as well as pervasive. So you will give what opinion? An adverse opinion. But suppose a particular item has been misstated, then you say it is material but it is not pervasive, then you give a qualified opinion. Correct? Similarly, inability also the same. You will look into the materiality and the pervasiveness. Here the examples could be like, it is beyond the control of the management. Maybe the books of accounts are lost, the documents are destroyed, so they are not able to provide you with the evidences. Sometimes the documents could be confiscated by the government, wherein we don't even know when you are going to get it back. So in that case, you are unable to obtain the evidences. Sometimes management limits the scope on you. So in that case also, you will not be able to obtain the evidences. In all these cases, what you will do, you will see whether the possible impact of that is going to be material and pervasive or not. If it is not pervasive, give a qualified opinion. If it is pervasive, you will give a disclaimer of opinion. Got it? Now, this standard also describes about what will happen if there is going to be a limitation on the scope of the auditor after the audit has commenced. So when the auditor has started doing the audit, the management is imposing the limitation on the auditor. Look, you cannot check this document, you cannot visit this location, you cannot get this report, that particular branch of ours you cannot go. So they are trying to impose certain limitation. So when they impose a limitation, the auditor first have to talk to the management. Look management, remove the limitation. If the management refuses, you go and talk to the TCWG, tell them this is the restriction imposed on us, we are unable to perform our audit procedures. If TCWG agrees, they could remove the limitation. But if TCWG is also not okay with it, you then see whether is there alternative way for you to obtain the evidence, try to understand about the matter. If suppose you come to a conclusion, alternative also is not there, that means you are not in a position to obtain sufficient appropriate evidence. So if that is the situation, you will then see the possible effect of the undetected misstatement. You will see whether it is material and pervasive. If material and pervasive, do not go directly to disclaimer of opinion, because disclaimer is as good as no opinion. So you will first decide, can I withdraw from the engagement? If that is a possibility, withdraw. If you cannot, like for example, sometimes investigation has been audited and all, where there is a law and regulation which will prohibit you from withdrawing, then in that case, you will do the audit, but you will give disclaimer of opinion, which is as good as no opinion absolutely. Correct? But if you say it is material but not pervasive, you will give a qualified opinion. Whatever you do, you will communicate about this to the management and the TCWG. Clear? Then, moving on to the next part of the standard, which talks about the modification that you make to the report that you have studied in the SA 700. So, where the basic elements we have studied, what changes will you make? 3 different things that we are going to study depending upon the 3 opinions. First of all, title and addressee will have absolutely no change, but the opinion section heading will undergo a change because you will prefix depending upon the opinion that you give. So if it is qualified, you'll have a qualified opinion. If you have adverse, you'll have adverse opinion. Disclaimer, then disclaimer of opinion. Then, when you talk about qualified opinion, then in the opinion paragraph, the language that you are going to use is, except for the matters given in the basis for qualified opinion, the aforesaid financial statements give a true and fair view in accordance with the applicable FRF. Because here everything is not wrong, something is wrong which we have identified and it does not have a pervasive effect. So except for that, everything else is giving a true and fair view. That depends upon the fair presentation and the compliance framework, the language will change. Then in the basis for the qualified opinion, you will be first giving the reason for the qualification. If you are able to quantify, give the nature, description, everything, do it if it is not impracticable. Correct? If it is regarding any disclosure, see that if you are able to give the disclosure, but they should not be prohibited by the laws and regulations. Okay? Sometimes it is impracticable to give the disclosure, like it's too voluminous, then do not give it. Correct? Then, when it comes to basis for, first we'll discuss about opinion only. Then when you talk about adverse opinion, there the language will be that in our opinion and to the best of our knowledge and information that we have obtained, because of the matters, the significance of the matters given in basis for adverse opinion, the financial statements do not give a true and fair view. Correct? So, yes, straight the negative answer. Correct? Then, after that we will be talking about disclaimer where we are not able to give any opinion on the financial statements. Correct? So, that is one very important thing we need to understand regarding the opinion, where you are not able to give any opinion on the financial statement because you are unable to obtain sufficient appropriate audit evidences. Correct? So, that is about the opinion section. Moving on to the next one where you have the basis for opinion, you will be having basis for adverse opinion, basis for disclaimer, basis for qualified. Where obviously you are going to give the reason, the quantification if possible. If disclosure is there, give the disclosures. If they have not disclosed something, then you have to give the disclosures only if they are not omitted. Okay, if they are not prohibited by law, or you should also give a disclosure only if you have obtained evidence for it. Otherwise, you should not. If they have given any wrong disclosure, tell the reason why it has been stated as wrong. Correct? Then if you are not able to obtain the evidence, then give the reason that you were unable to obtain the evidence and reason why you could not obtain. Correct? So, all of this you will give in the basis for qualified, adverse or disclaimer or opinion. Then when you talk about we have done the audit as per the standards on audit and etc. Then in the last point, wherever we say if we believe that we have obtained sufficient appropriate evidence, we are going to simply prefix depending upon the evidence. Like for example, we believe that we have obtained sufficient appropriate audit evidence to give our qualified opinion. So, everywhere the opinion will be prefixed by the relevant opinion that you are giving. Correct? Then, when you talk about regarding the responsibility, then that will remain as it is except for disclaimer opinion. In disclaimer opinion, very clearly you will be having only 3 responsibilities. When you compare to normal, you will have all the responsibilities given in SA 700, but when it comes to disclaimer, you will have only 3. One, you will talk that what is the responsibility to perform the audit as per the standards and to issue the report. Second, you will talk about we were unable to obtain the evidence because of the reasons given in the basis for disclaimer. And then you will give a statement about your independence and all the other ethical requirements. Also remember, when you give disclaimer, you cannot introduce the key audit matter paragraph in the auditor's report. Got it? So, these are some important points that we have. But also remember one more very important thing. When you talk about opinion section for disclaimer opinion, we don't begin with we have audited. We use the language we are engaged or we were engaged to do the audit of so and so organization. Correct? And one more thing important is, in basis for opinion section, that is basis for disclaimer opinion, like always we are going to have 4 important things, like we do the audit as per standards on auditing, correct? Then we write about reference to the auditor's responsibility paragraph, then we talk about code of ethics, and then we talk about we believe that the sufficient appropriate audit evidences are obtained. Now in this case, the second and the fourth element has to get omitted from the audit report, correct? Then, apart from that, one important point, whatever you have decided to be your opinion, the opinion as well as the proposed wordings in your audit report, you have to communicate with the management and the TCWG. Okay, basically the TCWG. Correct? So, this is the way in which you understand SA 701 in detail. Understand only the focus is that the modification that you do to the report becomes important because the overall reporting will be 700 only, except for the modifications that are additionally covered by SA 705. Correct? So, this is all about SA 705. Modification to an opinion in the independent auditor's report. Now, having understood the entire standard, we will take up now 2-3 illustrations for our understanding. Two things will happen. One, you will get an insight of what the kind of questions would be appearing. And second, you'll also be able to realize whether you're able to interpret the questions correctly or not. Having understood the essay 701 in detail, it is now time for us to get a summarized understanding of this standard. This will ensure that your understanding or the thought process is in the right direction. Alright, so let us begin with a summary of essay 701, Key Audit Matters in an Independent Auditor's Report. The basic idea of the key audit matter is that these are the matters in the auditor's professional judgment which are considered to be very significant in the audit of the current period. Two important things we understand here. These are significant matters and it belongs only to the current period. So we have to very clearly understand if there are certain matters which are very significant but which belong to the prior periods which will not be included in the current year CAM paragraph. So this is compulsorily connected only with the current year understanding, okay, or current year audit period. Second, significant matters. That means during the course of the audit, the matters which the auditor considered to be very significant for the purpose of his audit, then those matters we call them or we have to report them to the end users so that they also understand regarding the significance of this matter and basically they will be able to understand the financial statements even better. So these matters, we have a separate section in the auditor's report with the heading Key Audit Matter where the auditor could introduce these particular matters and help the end users to understand about it. Alright, now for the listed entities, it is compulsory that they have the Key Audit Matter paragraph in their audit report. Second, if suppose the law and regulation requires a matter to be brought in the Key Audit Matter paragraph, then obviously the auditor's report will have the CAM paragraph. And also understand, it is not only the listed entities or the laws and regulation asking you to introduce this paragraph. Sometimes if the auditor in his professional judgment while doing the audit of a client which may or may not be a listed entity, if he determines that this particular matter is very significant, which he believes it has to be communicated to the end users so that they understand the significance of this matter and basically they'll be able to understand the financial statements even better, then those matters he can, by applying the professional judgment, can introduce in the section called as Key Audit Matter. Therefore, understand only listed entities or law and regulation is not the only criteria. But if the auditor also believes by his judgment that this we have to introduce in the CAM paragraph, then in all the other entities also in the audit report, he can bring up a paragraph called as Key Audit Matter and there he would give the importance of these points and also give the explanation as to why he calls these points to be Key Audit Matters. Alright, now this standard very clearly gives an understanding about what should not be a misconception regarding the Key Audit Matter. That means every person should understand what basically is the Key Audit Matter. Key Audit Matter is not a substitute for 4 of the important things which have been discussed. First, it is not a substitute for the disclosure which has been required to give in the financial statement as per the applicable financial reporting framework. That means what disclosure has to be done by the management in the financial statement that cannot be done if the auditor does it in the CAM and it is understood that yeah, this is what we have to disclose. No. Management's responsibility should be dealt separately by the management and this purely is telling that look, this particular matter in the financial statement is something that we have already communicated to the TCWG and we believe it to be extremely significant so that you have to know about it. Then that can come in the CAM. So CAM is not a substitute for what? A disclosure requirement by the applicable financial reporting framework. Clear? You cannot say if it is come in the CAM, let it not come in the notes to accounts. That cannot be an understanding of it. Second, whatever item is considered to be a reason for the modification, like if I say there has been an overstatement of inventory and this overstatement is so pervasive and so material that I'm going to end up giving an adverse opinion, then the reason for the adverse opinion, though it is a key audit matter, that will not be taken in the CAM paragraph, that will go to where basis for adverse opinion paragraph. Got it? That means This is not going to be a substitute for the requirement that is given in the SA 705, that is, those items which are the basis for the modified opinion should go where it has a separate heading given by 706, that is, basis for modified opinion. This will not come as a part of CAM, correct? Then, similarly, third, it is not a substitute for the requirement given by SA 570, okay? When we study SA 700, we know we have a separate section called as the going concern paragraph, where if the auditor believes there is a material uncertainty regarding the entity's continuation or the ability of the entity to continue as going concern, this matter we bring it where? In the going concern paragraph in the independent auditor's report. This is by very nature a key audit matter. But by bringing this in the key audit matter, it will not be a substitute for what we require to present as per SA 570. Clear? Then, last, very clearly the standard says that we are going to give opinion on the financial statement as a whole. That is, the entire general purpose financial statements will have a single opinion given, and the opinion will be given separately in the opinion paragraph. That is for the financial statement as a whole. That means what we are bringing in the CAM paragraph is not we are telling that it is a separate opinion for the individual items. No. The opinion that we give is going to be for the entire financial statement taken as a whole, and these items are only the significant items that we have encountered. We do not intend, or it is not a substitute, giving separate opinions for these individual items. So it makes a very clear understanding that when the user is reading the CAM paragraph, they do not get misunderstood by what is given in CAM. They should not consider that this particular item, if it is coming in CAM, there could be a possibility that this is the reason that something is wrong, but they have given a true and fair view. No. Understand, if true and fair view is given, the only understanding to it will be that the auditor has obtained sufficient appropriate audit evidence, okay, for the purpose of drawing this conclusion. While drawing this conclusion, there have been certain important matters which the auditor came across. This auditor is not considering it to be a reason for giving a modified opinion, or these are not that material to make it a modified opinion, or maybe these matters are actually correctly recorded. But still we call these matters to be so important that we want the people to know about it. So that is the reason we bring it where? In the key audit matter paragraph. Got it? Then, one very important understanding is, we do SA 260 where we talk about communicating the matters with TCWG. Understand, if suppose in an entity there has been multiple factors which have been discussed by the auditor with the client, that is the TCWG, only out of those matters which you have communicated to TCWG, only out of those matters you have to decide which will be reported as a key audit matter. If you talk in the passive voice, it simply says nothing in the key audit matter could come apart from those which are actually been spoken with, discussed with, or communicated with those charged with governance. So understand, the first step to bring something in the key audit matter is to discuss this matter with whom? Those charged with governance of the organization. So the board of directors, the audit committee, the senior most members, or the highest hierarchy that you have. Okay, you have to communicate with them the matters, discuss with them the matter, understand the situation, and then if we believe it to be very significant, we will introduce where? In the CAM paragraph. Alright, now, this standard also gives an understanding of why did the institute, or why did we believe to have something new like this called as the key audit matters. Reason being, this would enhance the communicative value of what? The financial statements, or even the auditor's responsibility. Earlier, the auditor was only supposed to give an opinion and also talk about some matters in the EOM paragraph and the OM paragraphs. Alright, now, suppose apart from this also there is something very important for the auditor to speak to the end users so that they understand things better, there gets the benefit of CAM. That means this has enhanced the transparency, enhance the communicative value of whom? The auditor towards the respective or the users that are going to read the audit report. This would also enable the users to understand the significant matters such as significant management judgments, okay, in a better manner. Also, this is an additional information which we are going to report. So they would get a basis for a further communication or a further engagement with that of the entity, okay, with that of the auditor, with that of the audit reports understanding. So they would get a basis for further enhancing their communication or engaging themselves in understanding things better. Alright, so these are the reasons that we have the key audit matters to now be introduced in listed entities compulsory and other places where the auditor in his professional judgment believes it to be introduced. Alright, now in this standard they have given you an understanding of which are those matters which could be considered to be CAM, or which are the factors which would be determinant that these particular items could be considered to be CAM. Alright, now thumb rule is these matters have to be communicated with whom? TCWG. That means without the item communicated with TCWG, there cannot be a CAM. So first it has to come from where? From those items which you have communicated with TCWG, that is those charged with governance. Out of them, we have to understand those matters which in the auditor's judgment are considered to be having high assessed risk of material misstatement. That means these are the areas which are extremely risky. High risk of material misstatement, where the auditors would involve more applied procedures, more substantive checking, more auditors' attention, more procedures to be performed. So this becomes a significant matter with respect to the auditor's work. Correct? So those areas where there is going to be a high risk of material misstatement, where the auditor believes we require more than persuasive audit evidences. Okay, we have to obtain more evidences. The number of evidences have to be more. They need to be more persuasive than the usual ones. Then in that case, we call this matter to be a significant matter. Alright, then. Second we talk about is where these are connected with that of the judgments made by the management. Obviously, management judgment by very its nature itself is an area of significant risk. That means when management is making a judgment, it could be the useful life of the asset, it could be regarding the provision, it could be the bad debts, anything. So these are the items where purely a judgment of the management is used. So these by very nature are significant risk. So the way the auditor has responded to these particular understanding of the judgment of the management, the way he has given the understanding of these being reasonable or not, that also will be considered as what? The key audit matter. Correct? Basically, those estimates which have high estimation uncertainty would be considered as key audit matters, right? Then, third we talk about is where there has been certain events or transactions during the year because of which that has affected the audit that we have conducted. That means our procedures were enhanced, we were exposed to new risk, we were exposed in doing detailed checking because of something new that happened during the year. Maybe a new line of business was taken, new accounting policy was adopted, okay, there has been a change in the policy. All of these which have been something which are very significant. So these events and transactions, okay, though these are considered to be a part of the routine, okay, but this has impacted the way we have done the audit. So if the audit procedures have enhanced and we have to give our more attention towards these particular items or transactions, they also will be considered as what? Key audit matter. Alright, now, as I told that this particular standard not only talks about how to determine a key audit matter, it also talks about the reporting requirement of the CAM paragraph. That means how do you report an item which is determined as key audit matter in the independent auditor's report. So in the audit report, we have the opinion paragraph, then we'll have basis for opinion paragraph, and then we'll introduce this paragraph called as CAM. Basically, if there is going to be going concern, it will come before that. Otherwise, we'll have a next heading as key audit matter paragraph. Alright. So these matters which are determined to be key audit matters, that is in the current year, which are considered to be most significant out of those matters communicated with TCWG, we are going to introduce a subheading in the audit report, a separate section altogether with a heading called as key audit matters. And the introductory line of this particular item in the audit report would be, these are the matters which in the auditor's professional judgment are considered to be most significant in the audit of the current period. You should also tell that this is the opinion that you are giving in the audit report is with respect to the entire financial statement taken as a whole, okay, and we are not giving a separate opinion on these particular matters. Alright, so this has to be an introductory line so that even the users are very clear with their understanding that if something has been introduced in the CAM paragraph, what it exactly means. Understand, everybody is not going to be a commerce professional who is going to read the audit report. So don't you think they should also understand what exactly you mean by the word key audit matters? So it is basically very important to give an understanding in the beginning of what we mean by the word key audit matter. Alright, then. Second very important thing is that when we understand that there is a material uncertainty existing regarding the entity's ability to continue as going concern, or Suppose there has been a particular understanding of a particular item because of which we are going to end up giving a modified opinion. Then these two matters, though they are considered to be extremely significant, they are key audit matters by the very nature. They are important, they are very significant, and it very much involved the auditor's extra attention during the course of audit. That means auditor's extra attention or more focus was on these matters, correct? So these matters have to be shown separately in basis for modified opinion or going concern as the case may be. That means the matters which are going to affect the going concern as per 570 reporting or the matters which are going to be the reason for modification as per 705 should not be brought in the CAM paragraph even though they are considered to be key audit matter by the very nature. Key audit matter will not be a substitute for the reporting under 705 or 570. Clear? Then, after that we need to understand that suppose if there is a particular matter which we have communicated with the TCWG, and in this communication, through a reasonable understanding of it, we have understood that this cannot be disclosed to the public at large because this would outweigh the interest, of the people. That means this matter would detrimentally affect the interest of the users in the financial statements. Or maybe there could be a possibility that the TCWG calls this information to be extremely confidential and do not disclose it to the outsider. Or maybe the law and regulation is prohibiting the auditor from disclosing this kind of information because there could be a possibility that this would not have that good effect which it has to have. The intended reason is what? Through users to understand the things better. But if suppose this is going to outweigh the interest, it is going to become actually the working in the reverse order, then it will not be allowed or it is prohibited from introducing these matters in the CAM paragraph. Alright. So you have to very clearly understand whether this matter is going to be really beneficial and also see whether law and regulation permits you for the disclosure of the matter as key audit matter. If it is not permitting, then this matter, though considered to be key audit matter, will not be brought in the key audit matter paragraph and will not be disclosed by the auditor. Alright. Then, one very important point you need to understand here is, whenever the auditor gives a disclaimer of opinion, we mean what? That there is no opinion absolutely. When disclaimer of opinion is given, the very meaning of it is what? We are not in the position of giving any opinion. That means we have not obtained sufficient and appropriate audit evidences to support our conclusion. So when we are not in the position to give an opinion, do you think we'll be able to give additional information to the users? Will it be possible? No. So understand the logic very clearly that when the auditor gives a disclaimer opinion, the CAM paragraph should not be introduced in the audit report. That means there must be no element or no item to be considered as CAM in the independent auditor's report. Alright, then. One important point regarding the listed companies. As we know, listed companies, there is a compulsory requirement for what? To introduce the CAM paragraph. So understand, there could be a possibility that sometimes the auditor has actually not come across any item or any transaction or any event which he considers it to be so significant that it has to be a part of key audit matter. Or maybe he has found out a particular matter, but this has been prohibited by the law or regulation. Correct? Or yes, particular matter has been found out, but that matter has become a reason for the modification. Or it is something connected with the uncertainty as to going concern, where the reporting has to go as per 570. Correct? In all these cases, we know that there is absolutely no key audit matter. But in the listed entity, understand, even if you don't have a key audit matter to be disclosed or to be informed to the end users, even then you will have a separate section in the audit report which we call it to be key audit matter. And here you have to give a statement very clearly that during the course of the audit, there were no matters other than the one which you have already disclosed in going concern paragraph or maybe basis for modified opinion that we have not come across any other key audit matter. So whether you have it or you don't have it, you have to have this paragraph in your audit report. If you have it, you write them one after the other. If not, then you will also tell we have not come across any item which we call it to be what? A key audit matter. No matter we have come across which is so significant which we need to report as per key audit matter. Alright, now when you are going to introduce the key audit matter, under that one by one we are going to add on the points. That means suppose the auditor, out of all the matters which are communicated to TCWG, he has considered 4 items to be CAM, key audit matter. So there could have been a change in the accounting policy, there could have been a change in the depreciation method, or there could be a inventory valuation which has undergone a change, a new undertaking which has been taken over, there has been a discontinued operation. So like that, there could be multiple items which the auditor considered to be extremely significant. So this he has shortlisted and brought it where? To the CAM paragraph. When you write an element in the CAM, you will write it one after the other. That means point 1, 2, 3, 4 that we have the list. Every pointer is going to tell why did this particular matter been considered as key audit matter by the auditor. Moreover, don't only tell this is key audit matter. You should also tell why did the auditor call it to be key audit matter, and also how did the auditor deal with it while the performance of his audit in the current period. See, understand, when we are going to write something in the key audit matters, what is the meaning of it? It was very significant matter for the auditor. That means while we were doing the audit, this matter became very significant for the work of us. Correct? So obviously you have to also tell how did you as the auditor actually reacted or responded to this particular matter while performing your audit of the current period. So you will write why and also how did you deal with it while the performance of your audit. That means what procedure did you adopt? How did you identify whether they were accurately done? How the testing was conducted by you? What procedures did you perform on it? Everything has to be properly given. Before we bring anything in the key audit matter, paragraph in the audit report, communication to the TCWG is important. Alright, that means when you determine a particular matter to be CAM, you have to communicate it to the TCWG. Second, if suppose the circumstances are such that, the facts of the case are such that we have not come across a key audit matter or we are not reporting a key audit matter, then that also should be communicated to whom? The TCWG. Alright. Finally, about the documentation we have discussed in detail. What we are understanding by the standard is what we document. Why a particular item key audit matter? Okay, then if there is any matter which is considered to be a key audit matter but not disclosed, the rationale behind the same, and those matters which are key audit matters but which are reason for modified opinion, where we can find it in the audit report. So all of these are going to be the part of documentation that we are going to do. Very simple. This standard to be understood is quite simple, but understand for the examination, this is one of the most important areas which has been tested. Rather, I would say from the time 701 has been introduced, there has been like the frequency of the questions from this topic being really good. Okay, so I would consider this to be an extremely important standard for the examination point of view. Your understanding has to be really perfect. So with this, having understood it in detail and got the summarized approach, I am sure you will be in a position to understand and interpret which would be a key audit matter. So now, let us take some illustrations and get the concept even better, and you will get an idea how the examination questions would look like and how are we going to interpret them to be a key audit matter. Having understood the SA 706 in detail, it is now time for us to take the summarized approach of the standard. Very simple, the standard talks about two different paragraphs in the audit report, one with the heading emphasis of matter and the other with other matter paragraph. This is a very simple standard which talks about additional requirements of reporting in the independent auditor's report. When we mean the word additional, we simply say that the regular audit report will look as it is, but if the auditor in his professional judgment believes of introducing some more paragraphs or some more matters in the audit report, then we will bring it through the EOM and OM paragraph. But any matter anyhow cannot be introduced. This standard gives a very specific idea of which matters to be introduced in the EOM paragraph and which have to be brought in as the OM paragraph. So let us understand the EOM paragraph. EOM paragraphs talks about those matters which are already presented or disclosed in the financial statements. And these are appropriately disclosed in the financial statements. With respect to this matter, there is no absolute doubt regarding giving a modified opinion. Even then, the auditor believes that this matter should be brought in the attention of the users because he believes it is fundamental for their understanding of the financial statement. It is very important for the users to focus their attention on this particular matter because according to him, he believes that to understand the financial statements in an even better manner, they have to keep their mind or focus their attention on this item in the financial statement. So there could be, like for example, a kind of litigation going on where the auditor believes there is a significant uncertainty existing. or maybe there has been a major catastrophe because of which the impact is still existing. There could be a litigation, the uncertainty of which the probability the auditor is assessed, and because of which he wants to highlight that particular area in the financial statement. Got it? So these matters very important according to the auditor, which he believes that it has to be intimated to the users in addition to whatever opinion you have given. So this matter he will place in a separate section which is called as the EOM paragraph. Three important conditions here. First, matter should already be present in the financial statement, either presented or disclosed. Second, you should not have any kind of misstatement in that matter. The matter should be appropriately disclosed by the management as per the applicable FRF. Third, if you end up giving a modified opinion, this particular matter should not be the reason for the modification. If all these three conditions are satisfied, then we bring in the EOM paragraph a separate section in the audit report. Apart from not to be a modified reason, there is one more element we have to consider, that is, this particular matter which we are going to introduce in the EOM paragraph should not be identified as a key audit matter as per SA 701. That means those matters which we have communicated to the TCWG and call it to be a key audit matter, that matter should not be included as a part of emphasis of matter paragraph. Keeping into mind all these criteria, when we finally conclude that yes, this particular matter is an EOM, then we will bring it in a separate section in the audit report with the heading emphasis of matter. Or to make it more differentiated, we could write the element also as an introduction. That means emphasis of matter, you could just give an introduction like it could be subsequent event, it could be change in the accounting policy, it could be about a major catastrophe, okay, anything like that, you could also give an introduction to it. That is the way you give the heading of this section. Next, the content of the section should very clearly give an indication or the reference to the place where you could find this particular matter in the financial statement. Which item of the financial statement or which note number in the financial statement is talking about this particular matter. And third, very clearly you will tell that look, we are not giving a modified opinion because of this matter. And supposingly that a particular report has been modified, then you very clearly mention that the report has been modified not because of the reason which is given in this particular paragraph. That means this matter is not the reason to be given as a modified opinion, or for this matter we are not giving a modified opinion or a separate opinion altogether. Clear? Then. Second we talk about is the emphasis of other matter paragraph, which is again an understanding that there is a particular matter which is not presented in the financial statements nor it is disclosed. Even then the auditor believes it is very important for the users to understand not about the financial statements but about the audit report, about the audit work, or maybe the auditor's responsibility. So for the users to understand about the auditor's responsibility, the audit report or the audit, he wants to highlight some important matters, and that he will bring in which paragraph? The other matter paragraph. For example, when a particular aspect is not audited by us, it is done by some other auditors. Or maybe a particular indication regarding a matter which is going to talk about our scope of audit, then these we bring in the other matter paragraph. When we bring a particular matter in the other matter paragraph, two things you have to understand and remember as per this standard. This particular matter should not be prohibited by the law or regulation to be disclosed. Second, it should not be identified as a key audit matter. If both of these things are satisfied, we will bring this matter to the other matter paragraph. Once we decide a particular matter to be introduced in the OM paragraph, we will have a separate section in the audit report which will be called as the other matter paragraph. It should be before the other legal and regulatory requirements. But suppose our other matter is somewhere connected to our other legal and regulatory requirements, then we could club it together, and this other matter we could introduce as a part of other legal and regulatory requirements. Got it? So this is the basic idea about what we mean by the EOM paragraph and other matter paragraph, a very important one for our understanding. This is only additional reporting, additional paragraphs to be introduced by the auditor in the independent auditor's report, just to focus the user's attention One, if he believes to understand the statement, financial statement, this is important, then we bring in the EOM paragraph, which is a matter already discussed where? In the financial statement. If it is not a part of the financial statements, even then the auditor says, no, to understand my work, these people have to be aware of this matter, then in that case, he will introduce this matter in the other matter paragraph. So the basic idea is two different paragraphs to be introduced, emphasis of matter and other matter paragraph. Now, before I end up, one important thing I want to highlight. Emphasis of matter paragraph is not going to be a substitute for some important things that we need to understand. You need to very clearly see that when you bring an emphasis of matter paragraph, this is additionally to be done. This should not be substitute of something which is required to be done. Got it? Now, first the substitute is that you cannot introduce a paragraph as EOM paragraph when you tell that this particular reason is the reason for the modification in the independent audit report. That means there is a particular matter because of which a report has become modified. This matter you cannot bring in the EOM paragraph. This should definitely go to which paragraph? Basis for modified opinion. That cannot be substituted, brought it here, that no, we are bringing it where? In the EOM paragraph. Very important. No. The reason for the modification should go to the separate paragraph, not in the EOM paragraph. Second, EOM paragraph will come only when the matter is already existing in the financial statement and it is appropriately reported by the management. So you cannot tell as the management that look, auditor is given in the EOM paragraph. Let me not disclose it in my financial statement. Wrong. It cannot be a substitute for the management's requirement for disclosure. Management has to do their duty regarding the disclosure requiring the presentation as per the applicable financial reporting framework. Management cannot take the support of the EOM paragraph and say, auditor is disclosed, na? Then why will we separately again disclose in the financial statement? Let that only be. No. EOM paragraph is in addition to what the management has to do. And understand, EOM is auditor's responsibility. Disclosure is management's responsibility. You cannot club it together. Got it? So it cannot be a substitute to the management's responsibility. Third, regarding the going concern uncertainties. If a matter has to be reported separately, as per SA'570, in the going concern separate section, that cannot be brought to emphasis of matter paragraph. Got it? So emphasis of matter cannot be a substitute for the reason that you put in for the modification, for any requirements which are to be done by the management, and also if there is an uncertainty regarding the going concern which has to be introduced as a separate section in the audit report, that cannot be brought in the emphasis of matter paragraph. This is a very important understanding and an examination question as well, basically for the entire level. Got it? So with this, we have successfully completed Essay 706, emphasis of matter paragraph and other matter paragraph. Therefore, the basic idea, just have an imagination in your mind, or you could just understand by the level which I am giving now, that if suppose we have both emphasis of matter paragraph and other matter paragraph in the audit report would look like this in the sequence. So first we'll have the heading, that is the title, Independent Auditor's Report. Then we'll be having to whom we are addressing, that is the addressees. Then we'll have the opinion paragraph where we give the opinion. Then we talk about if it is a modified opinion, the basis for modified opinion. Then we bring in the emphasis of matter paragraph. Then we are going to bring in the key audit matter. Then we'll be having any other information that has to be placed if it is required by the other standards. Then we have the management's responsibility. Then we will be having auditor's responsibility. Then we'll be having other matter paragraph. And then we'll be having other legal and regulatory requirements. And then obviously we'll be having all the signing, the designations, the membership numbers and all to be written, and the date and the place requirements that are there. So this is the way in which we would be introducing at the proper places if we bring in the EOM paragraph or the other matter paragraph. This is the way in sequence is the right position for us to introduce these paragraphs. So I believe you will now be able to understand first when to introduce these paragraphs, what should be the content, and also the positioning of these paragraphs in the independent audit report. So with this, we have now completed Essay 706, that is emphasis of matter paragraph or other matter paragraph in the independent auditor's report. Having understood the Essay 710 in detail, it is now time for us to get the summarized approach of the standard so that the thought process is very simple and clear. Alright, now the name of the standard, Essay 710. It is talking about comparative information, that is corresponding figures and comparative financial statements. Comparative information are those amounts and disclosures which are included in the part of the current year financial statements because they are required to be shown or disclosed as per the financial reporting framework. So basically what happens is that for the purpose of comparison, when we are looking into a financial statement of a one particular period of the current year, that is 21-22, there will be certain information given or certain amounts and disclosures reflected even of the prior period or prior periods. These informations are for the comparison purpose and these are reflected because they are required by the applicable financial reporting framework. Then we call to be comparative information. Alright, now this standard talks about the auditor's responsibility with relation to this comparative financial information. Also, we talk about the reporting responsibility of the auditor with respect to the comparative information which is presented in the financial statement. Alright, now first thing is that we will talk about the comparative information. First thing is where we are going to understand that whether the auditor is going to first obtain the sufficient appropriate audit evidence relating to a fact that the financial statements, whether they include the comparative information which is required by the applicable financial reporting framework. So maybe if the financial reporting framework require that the particular financial statements have to include the previous year or maybe past 2 years figures together with the current year financial statements, whether the current year financial statements actually include those details or not. Correct? So the auditor is going to check, evaluate whether the comparative information which is given in the financial statements, whether it is as per the requirements of the financial reporting framework. Along with that, the auditor will also check whether the amounts and disclosures of this comparative information, whether they really match with the prior period amounts or not. Because understand, comparative information is nothing but the prior period figures. So the previous year's figures, what they are reflected in the current year financial statements, they should be same as they were appearing in the prior period financial statements. Correct? So when you say that reserves were 50 crore, so when I am writing a figure in the previous years for reserve, it should be 50 crores only. So obviously I'll be checking whether the amount or the disclosures whichever are given, whether they are actually matching with the previous year's figures and amounts or not. Correct? So basically we see whether copy and paste is happening correctly or not. Then, with respect to the comparative informations, we will look whether the accounting policies, whether what they were used there are consistently applied or not. And if there have been any change, whether adequate disclosure of the same has happened in the financial statements or not, whether disclosure has been given or not. Correct? Also understand that when you do the comparative information checking, if you come across an evidence which is indicating to a material misstatement, you will perform additional procedures to understand what the misstatement is all about. Correct? Now, this is the part about the comparative information, how the auditor is going to check the appropriateness of the presentation classification as per the FRF. After that, the auditor will be talking about the standard will be talking about the reporting responsibility. What is reporting responsibility? That means in the audit report, how will you going to report about this comparative information which is available? So for the purpose of reporting, we have two different approaches. One in the form of the corresponding figures, one in the form of comparative financial statement. Now, corresponding figures, that means those comparative information which is given as an integral part of the financial statements and they should be read only in comparison with the current year financial statement. Like the simple example is of the Schedule 3, the FRF, which requires that the company's financial statements should disclose the current year figures along with the previous year's financial statements, previous year's figures as well. Now this you see will be introduced as a column in the current year financial statement. So you'll have a separate column called as the previous year where the previous year's figures will be shown. These are called as the corresponding figures. Correct? Now, The reporting responsibility here is that when it comes to corresponding figures, the auditor's responsibility regarding the opinion will be with respect to only the current year financial data only. That is, only with respect to the current year figures, the auditor will give his opinion. Understand, when you are going to do the audit of the year 21-22, you have to give the audit opinion only for the year 21-22. You are not referring your opinion to any of the corresponding figures. Clear? But there are certain circumstances where in the auditor's report, that is the reporting done by the auditor, will also give reference to the corresponding figures, that is the previous year's figures which are appearing in the financial statements. Two places we are going to give reference. First, suppose if in the previous year when the audit was conducted, the report was modified. That means it was either qualified, it was adverse, or it was a disclaimer of opinion. And the reason for such kind of modification is something which is still unresolved in the current year also. So what happens is, if in the current year also that particular information is unresolved, and suppose the effect of the misstatement or the possible effect of the misstatement is such that it is impacting the current year financial statements also, then in the current year you are going to give a qualified opinion or an adverse opinion or disclaimer of opinion depending upon the same. Now tell me, in the basis for the modified opinion paragraph, are you not going to now refer to the corresponding figures also? Yes, because the reason for you to give a qualified opinion or the reason for you to give the adverse or disclaimer opinion is not only the current year figure, but also it is connected to the corresponding figures misstatement, which has impacted the opinion of the current year. Sometimes it is also possible that you may not give a reference directly to the previous year's figures. Rather, you would say that because of the comparative information or because of a misstatement, the comparability may not be appropriate, okay, between the 2 years figures. Correct? So, some reason or the other, you would give a reference to the corresponding figures also in the audit report. Similarly, like that, suppose if the previous year's figures or the previous year's financial statements were audited and the auditor had given an unmodified opinion. But in the current year, while doing the audit, the auditor came across a misstatement. And the reason for the misstatement is such that he believes it to be material and he thinks because of this, the previous year's financial statements actually had to give a modified opinion. But now what happens is, this particular information which you have identified in the current year, this information has enabled the auditor, because what happens when the information is obtained by the auditor will go to the management, and if the management is not ready to resolve it also, then the auditor in the current year is going to give a modified opinion. Now this modification is not for the reason which is a misstatement in the current period. This misstatement belongs to the previous year, the corresponding figures. So in this case also, you will be giving a reference to the corresponding figures. Apart from this, there is not going to be a situation where in the case of corresponding figures, the auditor's opinion will be referring to the corresponding figures. Understanding? Now, is there a possibility that the previous year's financial statement or the corresponding figures were actually audited by a predecessor, another auditor? Yes. So in that case, in the current year audit report, the auditor could also give a reference to the previous year's figures. That is, in the other matter paragraph, he would give an additional information regarding the corresponding figures or the corresponding figures audit report if it is done by the predecessor auditor. That first of all, you would give a statement that it was done by the other auditors. Second, you will talk about the type of opinion given. If it is a modification, give the reason for it. And also you are going to give the date of that audit report. It is also possible that the previous year's financial statements remain unaudited. That means the corresponding figures are unaudited. In that case, in the other matter paragraph, you will be giving a very clear understanding that the other matter, that is the other matter paragraph, you very clearly give an indication that the previous year, that is the corresponding figures are unaudited. But always remember, only because you are giving a statement like this in the other matter paragraph, it will not relieve you from your responsibility to obtain the sufficient appropriate audit evidences regarding the opening balances, that is nothing but the corresponding figures. Clear? Then, the last part of the standard talks about the reporting responsibility in connection with the comparative information in form of comparative financial statements. So, comparative financial statement is not introduction of a separate column in the current year financial statement. It is the presentation of the previous year as a complete set of financial statements. So, when the audit is conducted for the current period, this current year financial statement also includes the previous year's financial statement for the purpose of comparison. Here, because it is a part of complete set of financial statement, it is a comparative financial statement. The auditor's opinion will be referred to each of those financial statements. So, the auditor will give opinion on each set of financial statements. Understanding? So, here the reference to the opinion will be, if suppose audited, all the previous years getting audited, then you are going to give opinion for the individual financial statements which are presented. Now, sometimes there is a possibility that the previous opinion given for the previous year financial statements was different, and now what the opinion you formed could be different. So, what you do is, as the purpose of your reporting, in the other matter paragraph, you will give a substantial detail of the reason why there has been a change of opinion from the previous year to the current year that you are changing. Got it? Now, here also there could be a possibility that this comparative financial statements, that is the previous year financial statements, were audited by another auditor. So, you will give in the other matter paragraph regarding the information that they were audited by another auditors, the type of opinion given by them, and also about the fact that, also about the date of the audit report. And if suppose there has been a difference in what report they had given and what report you are giving, that is if the opinion is mismatching, then you communicate about the matter to the TCWG, and if also permissible, see that you communicate this matter to the predecessor auditor or require the management to communicate the same with the predecessor auditor. Alright, then it is also possible that the previous year's financial statements could remain unaudited. That also information you should give in the other matter paragraph, where you will talk very clearly that the previous year's financial statements remain unaudited. And as I told you, in India, the comparative financial statement as a part of doing the statutory audit, very rarely you see. In fact, I would say you would not see it very regularly. It is something which is required for a specific consideration, for a limited purpose when the financial statements are done or special purpose financial statements are prepared. That time this kind of information is given to the auditor. Otherwise, in India, the actual practice is about the corresponding figures, where we give opinion only for the current year, and we'll be having this kind of information presented in the financial statements, and we'll be reporting or referring to that particular corresponding figures only in certain circumstances that we have discussed. And when it comes to like the example I gave about IPO, or maybe there could be some other requirements where you prepare particular information for the purpose of submitting somewhere. Maybe the bank requires you to give 2-3 years financial statements in line, and they should be all audited. So in that case, if you are approaching a different auditor, you could go to that auditor and say, we require the audit to be conducted for all the 3 years. So these two another years which we are having with us, they are comparative financial statements. Now in this case, if that auditor is going to do the audit for all the 3 years, obviously his opinion will be referred to all the 3 years, correct? And if suppose already the prior periods were audited by another auditor, there could be a possibility of mismatch, where in the other matter paragraph, you could give the reference of the same. So comparative financial statements usually will not come across in the practical scenario, but definitely corresponding figures is going to be the daily thing. Because when you do the audit of any company, be very sure that the company's financial statement, which are prepared as per Schedule 3, the corresponding figures will be reflected. Either 1 year corresponding figures will be given, or they could be multiple. 2-3 years figures also could be given for the purpose of comparison. Basically, the comparative information, why it is given, for the purpose for the users to understand how to do the comparison. Like to understand, like suppose sales last year were 1000 crores. This time it is 1200 crores. So we'll be able to compare and make sense out of the data. Correct? So basically the comparative information is given like that. But as an auditor, you have some responsibility towards this comparative information. This comparative information could be corresponding figures or comparative financial statement. But I personally recommend or personally feel, when you will actually enter the field of doing the audit, you would more come across the corresponding figures, and very rarely for the limited purposes, you would come across comparative financial statements. So with this, we are completely closing the essay 710, that is comparative information, corresponding figures and comparative financial statements.